They are implemented come August 1st, and BASF, that chemicals producer, of course, out of Germany, cutting its full-year guidance. Tariffs and impact, energy costs have been a challenge for BASF as well, so 3 stocks, or at least 3 baskets to focus in on come the open. Pretty.
Does it show up on a sectoral basis? Does it show up on a regional basis? Are more countries exposed to the kind of 30% than others? That's going to be the conversation. I think what was so stagnating is that difference between the FTSE 100 and the Stock 600 in terms of futures pricing right out of the gate. The FTSE 100 is flat at the moment, and I think this really speaks to the sensitivity that we're seeing, at least on the continent, when it comes to that 30% threat from Donald Trump when it comes to those tariffs. Should an agreement not be reached right out of the gates, down about 0.4% on the Stock 600, but look at where the pain is. It's the IBEX down 0.8%, because remember, he didn't just say 30% on the EU. He said 30% on Mexico as well. Lots of Spanish companies have a footprint in Latin America, and specifically in Mexico, and even the CAC 40 down about 0.7%. We're going to wait just a little bit to see how the DAX opens up. But in the meantime, Val, walk us through some of those early movers.
Well, when it comes to the sectors, we have them all in the red this morning. All 20 sectors seeing declines. We have 442 stocks in the red, only 55 higher this morning. It does seem like some of those trading higher this morning are some defense names. Dassault Aviation up 1.5%, one of the biggest gainers, but many stocks to the downside this morning as we continue to open up. When it comes to the sectors, we are seeing technology at the bottom of the basket, also autos at the bottom of the basket. I wonder if that's around the new number for the EU from the US when it comes to those tariffs. We're seeing many of the auto names in the red so far this morning, but all sectors seeing declines.
The FTSE MIB is plummeting 1% right now. The DAX has yet to show us a print. The IBEX down 0.8%. To some of the individual names, having touched on the sectors then. Bottom of the list, you do have the likes of BE Semiconductor. So Val was talking about the tech space and tech sector being under pressure. That stock, BE Semiconductor, currently down 2.6%, amongst the worst hit right now. In terms of some of the gainers, you have some in the financial space amongst the insurers, but also AstraZeneca in terms of pharma, 1.3%. Prudential, talking of insurers, up 1.2%. Standard Chartered, a gain of a little over 1%. Dassault Aviation maybe getting a bit of a lift on the back of the French spending pledge around defence. That company is up also 1%. Raiffeisen Bank, interestingly, in Austria, down close to 2%. So we're seeing, of course, the pressure coming through on the headline basis is the tariff impact and how markets are adjusting to that on an individual company basis as we start earnings season as well. Let's get a broader picture now, right now, because we're hearing, I believe we're still hearing from the EU Trade Commissioner, Maros Sefcovic, who is speaking. We're taking live pictures right now. That's in Brussels. He said he will be reaching out to his US counterparts, of course, on the back of this letter that's been sent to the EU with this 30% tariff. Let's take a listen in. Those tariffs expected to take place August the 1st. Let's listen in.
From the United States, it has more or less the same effect. So it's practically, it prohibits the trade. So if you're talking about 30% or 30% plus, there will be a huge impact on trade. It will be almost impossible to continue the trading as we are used in a transatlantic relationship. And if you look at the impact this would have, so I have to say the transatlantic supply chains would be heavily affected on both sides of Atlantic. They definitely don't want it. Show me one industrial leader who is happy about this tariff policy. So therefore, we feel the huge responsibility for the biggest trading relationship on this planet. $1.7 trillion, $400 billion flying across the ocean every single day in the form of goods and services. So therefore, we are showing this enormous patience enormous creativity to find the solutions. But if it stays 30 plus, simply the trading as we know it will not continue with a huge negative effect on the both sides of the Atlantic. And therefore, I think we have to do, and I will definitely do everything I can to prevent this super negative scenario. Thank you very much. I have to see you at the press conference. Bye-bye.
All right, Maros Sefcovic there, the EU Trade Commissioner, talking about perhaps the response. He has a fairly measured approach, but as we know earlier, he did say he's ready to brace for potentially imposing those countermeasures. We know the anti-coercion tool is something that Emmanuel Macron has been pushing the European Union to utilize. In the meantime, let's talk about how these markets are reacting. Sharon Bell, senior European equity strategist over at Goldman Sachs, joins the table this morning. Sharon, walk us through this market reaction. I mean, clearly right out of the gates, we are seeing a fairly large one for the Stock 600 relative to the FTSE. But for the first time, we're actually seeing a reaction, whereas for weeks and arguably months, we haven't.
Well, I think the markets had got a little bit optimistic in the last few weeks. Particularly last week, there was expectations that perhaps some framework would come out, which was a bit more positive between the EU and the US. That hasn't arisen yet. And instead, we've got this 30% tariff threat. So I think it is a little bit of a knock. I mean, if the market really genuinely believed in the 30%, it would be down a lot more. So I do still think there's an element of, do we believe this will be the case? Is this a negotiating tactic? Is this a first move, etc.? But yes, I'm not surprised at the negative reaction.
When it comes to the negative reaction, though, I mean, it feels like it's also, to your point, just a little bit of a retracement as well. Coming to August 1st, how do you brace for August 1st?
Yeah. Look, if we're at August 1st and nothing has happened and the 30% arrive, then I think the market will be down between now and then. I mean, I see this as just part of a negotiation back and forth. It is tricky. One thing I would say is that in the last few months, not only has the market positively moved since Liberation Day, and we've recovered most of those losses, if not all of them, but cyclicals have also done extremely well. So I think there's a little bit of an element of the market being perhaps a little bit too complacent in the very near term on the risks around all of this. I mean, if there is a great deal, then, and you've got this defence spend, we've just heard from Macron on even more sooner, you've got fiscal policy, all that's fantastic. But of course, if there isn't a good deal, and that's the danger.
But you mentioned the cyclical outperformance. How much of that is it fair to say that was more of a rotation rather than a fundamental shift in optimism around the European growth story?
Oh, I mean, cyclical outperformance has been true in the US and Europe in the last couple of months. And I think it's to do with the fact that at Liberation Day, people were very negative, looked at the economic implications, and cyclicals had underperformed very sharply. So it was a bit of a bounce back in that type of performance. But it is also a genuine reflection in Europe of a bit more fiscal spend, a bit more defence spend, a bit of expectation of a cyclical pickup in 2026, which I think is there, provided you don't get the harsher tariff scenarios.
Sharon, you mentioned there that the market doesn't believe it. You know, that's what I see even in the FX markets this morning. They don't seem to be believing this 30% number. But in that framework, is this just a dip to buy? Are you adding to some of your long positions here that might be in the red?
Yeah, I understand what you're saying, but I think that the market has done well. The European market trades on a PE of about 14 and a half, so which is sort of 70th percentile of its historical range. It's not as expensive as the US, and we still think there's relative value in the market, and we still like the idea of diversification. But markets have all bounced. And there are still risks around the impacts of some of these tariffs. And even if you don't get the 30%, even if it's a negotiation tool, it may still mean that the sort of people's expectations for the baseline is also going up.
And we're about to head into earnings season. At least the U.S. kicks off in full force with banking earnings. Is there any sectors you specifically have your eye on for any clues about how these corporates are dealing with this tariff back and forth?
Yeah. So, I mean, I guess it will be the more international sectors. I mean, European earnings season is also really kicking off this week. We have about 10% of companies reporting this week, so it's quite a big week in Europe too. I think it's got to be the more international companies, hasn't it? The ones which are exposed to global trade. So industrials, chemicals, but also even things like consumer staples, etc., which in Europe tend to have very global footprints as well.
Sharon, how much of a catalyst can dividends and share buybacks be for European stocks through the second half of this year?
I mean, they've been a huge catalyst for banks, for example. I mean, if you take the bank sector across Europe, so the stocks Europe bank sector has about 9% return to shareholders each year from dividends and buybacks. Dividends about 6%, 3% on top of that in buybacks. So it's a really big deal for certain sectors. It's one of the reasons I think banks have done very well. I mean, will it compensate if there is a big tariff and a big hit to growth? Absolutely not. But I do think it's a big help. European companies are making good amounts of cash, and they're giving a slice, not all of that, back to shareholders. I would say that you've also seen it pick up in other uses of cash too. M&A, for example, has definitely picked up this year. So again, all those uses of cash I think are helpful.
Is M&A what draws you maybe to European small caps, the prospect of M&A around the small cap space? Because that outperformance has been there for European small caps. Does that have sustainability? Does that have further to run?
We do think so, yes, perhaps a little bit further to run. European small caps have done well, very much in contrast to US small caps, which haven't done well. And I think, so it's been the large caps, the mega caps that have done so well in the US. Small caps have done well in Europe because they're a bit more domestic. They're a little bit less exposed, directly anyway, to the trade tariffs. They also benefit from the euro rising versus the dollar because they're not dollar earners in general. They also have floating rate debt, and interest rates at the short end have generally been coming down. So all of that mix, not bad for small caps. And as you say, M&A plays into that as well. You've seen it pick up in M&A, and they're the targets.
Can you just talk to us about this kind of rate differential here? We had UBS's Banu Baweja come on the show earlier, and he said, look, there is a inflationary impulse naturally coming from this tariff effect as well, but he still thinks there's going to be a dovish Federal Reserve. How dangerous is it to kind of double down on a dovish take or a dovish sentiment when inflation is still potentially an issue in the short term?
Yeah, I mean, we do. We also put in extra rate cuts from the Fed relatively recently. We now expect 3 this year and 2 more next year with a lower terminal rate forecast. And some of that is because the tariff effects have fed a slightly less through to inflation than we expected. And a little bit, to be fair, less through to growth than we expected. But growth is likely to dip. It is a bit weaker in the US than what I would consider trend growth. And because of that, and because rates are a little bit above what would be the neutral rate from the Fed's perspective, we think that they will cut. But, you're absolutely right. There is risk if lots more tariffs will be inflationary. And on top of that, of course, the dollar falling is inflationary for the US.
Sharon, are you worried about the level of euro dollar here at all, affecting European growth or maybe inciting worries about deflation, or are we not there yet?
I don't think we're there yet. And actually, but European inflation is a very different place, I would say, than US inflation, because you don't have tariffs pushing it up in the same way. And you've had the euro stronger, and that will push down on inflation. So I think inflation is well under control in Europe, I would say. I don't worry about the risk of deflation. What I do worry about, though, is that the earnings of European companies with a lot of dollar exposure, and there are many, many of them, but about 50% of European company earnings are outside of Europe, easily, maybe even closer to 60%. And a lot of those are dollar denominated. Just merely translating them back into euros takes a hit to earnings. Earnings growth this quarter, year on year, we think was basically flat in Europe, and that's largely because of the stronger euro.
Flat earnings growth as a result of strong euro. I want to loop back to the top of conversation. I think we've kind of almost got there, which is around the tariff impact. You said you would see, so when I get to a point where 30% is implemented on August the 1st, you say you would see a drop in European equities. Not controversial, that view.
No.
Give us the kind of size and scale of what the kind of move would be.
Yeah,
in that
so
scenario.
our economists are saying that if you got the 30% tariff and that was implemented, we'd see about 1.2% hit to GDP. Which would happen relatively soon, within the next year or so. That's quite big. Bear in mind that Europe trend growth is probably 1 or maybe slightly sub 1 in Europe. So that's taking away a year of GDP. It really is quite a huge hit to GDP growth. And earnings hit as well. You would then see a negative outcome for earnings, probably single-digit negative, but still negative earnings growth this year, probably into next year. And with valuations already up at 14 times PE, that would be very difficult to justify with that type of tariff. And, of course, on top of all of this, if there was a 30% tariff, there's a much higher chance of Europe retaliating. So then you get a more of a trade war. But, all of these, I think, they're scenarios rather than what will be our base case.
Fascinating to find out how these markets react, or if they do or continue to sell off. I think we're about 2 weeks out from that August 1st deadline. Sharon Bell, Senior European Equity Strategist over at Goldman Sachs, telling us and walking us through some of those scenarios. Let's get a quick check on those core 6, the heavyweights, of course, that move the market in a very big way. This is a surprising one. I thought Novo Nordisk would get hit harder on the idea that it is one of the key places that would be affected by pharmaceutical tariffs and, of course, the 30% from the EU in terms of exports to the United States. The market is doing the opposite, down about 0.7%. One of your sole outperformers this morning, and I wonder how much of that is retracing some of the pain that has been priced into the stock. LVMH also taking a hit, down about 1.3% as well. Ferrari down about 1.5%, and ASML, I think, is also a key one because it's actually one of your biggest weights on this market, even though it's only down about 0.4%. The tech trade is not doing well, but keep an eye on Novo Nordisk, higher by 0.7% this morning. That is your core six. Let's go check out some of the other individual stocks on the move. Chloe Melly has that for us. Chloe.
Good morning. Let's start with some French defense names this morning. So Macron announced that he would double the annual defense spend in France by 2027 rather than 2029 as originally planned. This morning, that is moving some key defense names in France higher. Thales and Dassault Aviation in particular. Safran not so much, but Safran is not as exposed to defense. It also has quite a big exposure to civil aerospace, so it's not seeing as much of a benefit. But Dassault in particular up 1.4% this morning. Moving on to chemicals. We had a couple of names this morning that are affected by a guidance cut. So BASF was down a little bit more at the open. It cut its guidance on the back of tariffs and the uncertainties created, and that was the same for a smaller company, Brenntag, and it is seeing quite a bit of weakness this morning, 2.6% on the back of those guidance cuts due to tariffs. Then also speaking about tariffs, we have got car makers, and we have a wall of red this morning from those German car makers, Volkswagen, Mercedes and BMW. There is obviously the tariff rate of 30% on the EU and Mexico, and that's having some impact on those car makers that have those manufacturing facilities in those regions. So the one worst hit so far is Volkswagen at about 1.3% down this morning. Let's move on to a pharmaceutical company, AstraZeneca. It said that it had a blockbuster potentially on its hands with a drug that helps with high blood pressure. That's moving the stock up as much as almost 2% this morning. And then finally, we have got a rating cut at Hermes. So Hermes has been cut from buy to hold by Jefferies. Jefferies said that the company would maybe not see as much of a significant growth uplift going forward. Hermes has been outperforming its luxury peers so far, so that is sending the stock down a little bit, as much as 2.2% this morning.
Okay, Chloe Melly from our equities team on some of the stocks on the move this Monday. Thank you. Coming up, the EU and Mexico lay firmly, of course, in the tariff crosshairs. We discussed the outlook as the auto sector awaits clarity. We're seeing pressure, as Chloe was saying, on some of the automakers on the back of this news. That conversation coming up next. More details, more analysis. Stay with us. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. There is caution in these markets, but certainly no sense of panic, with European stock 600 down just 0.4% on the back of the tariff news. Of course, 30% threatened by President Trump on the EU and Mexico, with August the 1st, the new deadline.
Absolutely. We're going to keep a very close eye on the read-through there and dive into that trade story. But in the meantime, something else brewing on continental Europe, and that, of course, is the banking consolidation story. UniCredit says it will assess the next steps on its takeover plan for Banco BPM. This comes amid doubts over whether the deal will go ahead following a ruling by an Italian court. Let's bring in Bloomberg's Italian bureau chief, Chiara Albanese. Chiara, can you just walk us through this court ruling? Can you walk us through the challenges that Andrea Orcel faces?
Yes, good morning. So the Italian government has applied really tough prescriptions on UniCredit to continue a plan to take over Banco BPM, which is a smaller lender based in Milan. Now, the bank led by Andrea Orcel, UniCredit, appealed to those decisions to an Italian court, and the court actually took a midline on the government position, deciding that some conditions are too tough, but others remain in place. So UniCredit will now have to decide whether it can still seek to buy Banco BPM with complying with those conditions, or instead will just drop the offer.
Chiara, what are the key steps ahead that the market is watching out for?
So there are several pieces of the puzzle that will influence UniCredit's decision on top of the court ruling that we just mentioned. The first one is that the European Union is also expected to speak and send a letter on the same prescriptions, and also that the timeline of the offer period is quite tight, and it has to be done and started by July 23rd. So UniCredit only has about a week to clear its mind, announce to the market what it's going to do, and also understand whether these prescriptions will have to hold or not.
Okay, Bloomberg's Italy bureau chief, Chiara Albanese, thank you very much indeed with the update there on UniCredit and the Banco BPM potential deal, with some question marks that still remain, of course. Now, key sectors, meanwhile, away from banking, including autos and chemicals and defence, are continuing to monitor the potential fallout after US President Donald Trump dialed up trade tensions by announcing a 30% tariff on goods from the EU and Mexico. For more, let's bring in Bloomberg trade czar Brendan Murray. Brendan, we're seeing autos the worst performing sector so far in the session, down 1.1%. On a sector-by-sector basis, how significant are the details that we're getting in terms of a headline tariff of 30%? To what extent is this still a sticking point in terms of negotiations, the sectoral tariffs that the EU wants to avoid?
Yeah, well, this is everything for the European Union. There are steel and aluminum tariffs. There are the ones on cars. You're also looking at the threat of pharmaceutical tariffs that the president raised last week at something like 200%. So the European Union is looking at all these, going, these will crush our industries. We can't stand for this. So we're going to have to come up with some solution. Now they can negotiate a solution, or they can fight back. They can retaliate, and they're weighing both of those options. They're saying, we want to talk. We want to keep at the negotiating table. But there will be a time that comes when these tariffs, if Donald Trump can be believed, will take effect, and then the European Union is going to have a tough decision to make about how hard they strike back, what industries they strike back at when it comes to U.S. exports. The Mexico and the EU, this is 1/3 of all U.S. imports. So this is a huge escalation if they go through, and there's a lot at stake economically. I think markets are still thinking maybe it's a bluff at this stage, but if it's not, it's a huge economic headwind.
So there's been some immediate reaction here that, okay, if 10% flat line rate wasn't that, it's a scary number, but it's not that scary. It's not as cost prohibitive. Okay, 30% may not be as cost prohibitive, but if you stack them on top of each other, the country tariffs plus the sectoral tariffs on, say, a Mercedes that is potentially getting shipped to the United States, have we gotten into cost prohibitive territory?
Yeah, absolutely. I mean, there's no way that you could raise the price of a Mercedes in the U.S. By 50%, and their market share would take a severe hit. So yeah, this is the big sticking point with Donald Trump is he wants Mercedes and Volkswagen and all these European car makers to come make those in Alabama or other places where perhaps they already have a facility, but they're already making vehicles there, and it's going to be those are economic decisions on that the companies have to make that take a while to do. So we could be headed right down to the final day before August 1st, before we could see anything that resembles a compromise. At the moment, there doesn't seem to be that much common ground in between the two sides.
Brendan, do we know or not whether the Trump administration imagines these reciprocal tariffs stacking on top of these sectoral tariffs, especially the one on cars? Have they mentioned that specifically? Yeah, that's the way it would work. A reciprocal is just 10% or 30% or whatever the rate is across everything, and then you get an extra 25 for cars or an extra 50 for steel. It compounds on itself, and that's why it would be so economically damaging to those countries that export those goods to the U.S.
Bloomberg's Brendan Murray walking us through that as the story develops. We are just over 2 weeks away from the August 1st deadline. We thank you so much. Coming up on the program, we're talking about maybe how the United States and the EU should approach these tariff negotiations, tariff diplomacy, if you will. The EU looking to step up engagement with other nations hit by Trump's levies. Meanwhile, actually within the company or within the country, within the bloc, I should say itself, talking about potentially using the anti-coercion tool. We know that's something that Emmanuel Macron has been talking about for some time. We'll see if that actually comes up. Is that even a viable tool?
He is trying to put that on the table, the French president. Ursula von der Leyen, we can see pictures of her on the screen right now, has said, we are not there yet. That would be a measure that would talk to a particularly acute moment in terms of trade negotiations. So it seems broadly across the bloc they're opposed to that, but it's not insignificant that the French president is pushing for that tool and a tougher line in terms of these negotiations.
A lot of interest, a lot of people talking about their own interest in these negotiations. A lot of confusion, I guess, on who to listen to.
Absolutely. We're going to digest all of it. Anthony Gardner joins us next. Stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite, Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome back to the opening trade. About 30 minutes into today's session, you're seeing the markets off of their lows. In just 30 minutes, we opened the market with almost 1% declines on the DAX and starting to pare some of those losses, but we are still firmly in the red. The FTSE 100, though, firmly in the green, I think, higher by 0.2%. I think that dispersion between the indexes, Tom, tells you this idea that the EU trade story is really what's driving markets this morning.
Banu Boyeja of UBS telling us that there is complacency in these markets. He thinks there will be an impact, that tariffs are something to be concerned about. But to your point, so far that concern is not fully reflected in the market moves. The European Commission, meanwhile, saying that any escalation of trade disputes should be avoided while calling for a level playing field. Competition Chief Teresa Ribera spoke to us earlier.
Trade provides prosperity, and I think it is a good thing. And in general terms, the global value chains are so obviously important for anyone that we should avoid any type of trade escalation, trade war among the different countries between the different geographies. But of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States. China is a great country. Of course, we need to be sure that investments flows are fair and that we do not harm each other.
When it comes to fair trade, what sort of message have you given to Beijing when it comes to overcapacity, not only on clean technology sectors, but also, of course, on rare earth exports?
There are two things that you are mentioning in your question. One of them is, yes, we need to ensure that the overcapacity, the production beyond what it may mean, the domestic demand could overflow over markets. That could be pretty harmful for those that also produce in other geographies. So we need to be responsible, and these formal and informal conversations between the different governments is going to be key. Then there is another issue that you are raising in your question. What about the availability of rare earths, raw materials that may be critical for the new economy, both in terms of the renewable energy solutions or in terms of the digital transformation of our economies? And it should not be a bottleneck killing the possibility of prosperity all over the world. So that is another bullet where we will still need to talk, to discuss, to avoid harm.
When it comes to competition itself, given Washington's tariff threat of 30% by August 1st, is that going to hurt Europe's ability to compete in global markets in the United States? What are your expectations of what that could do to trade flows?
I think it is very bad news. I cannot understand how any country can think that getting isolated from the rest of the world is a good thing for its economy. To what extent fixing the way they want to produce, sell, and cut the ties with other providers, suppliers all over the world is not good news for anyone. So I think that it is not good for Europe, it is not good for the United States, it's not good for anyone in the world, because the size of the American economy is so important that it would have an impact, of course. But it is also true that it represents more or less 17% of world trade. So we need to pay attention, to prepare, to be sure, to the extent possible, that this does not become a reality. But if it finally pitifully becomes a reality, we need to keep on working to build resilience and to build partnerships with the other partners, the other allies in the world.
European Commission Competition Chief Teresa Ribera speaking to Bloomberg earlier. Joining us now for more is an expert on trade with deep expertise in diplomacy, but also in business and investing as well. Tony Gardner, US Ambassador to the EU from 2014 to 2017, serving, of course, under President Barack Obama. Currently senior advisor at the Brunswick Group and with a background in business and finance investing as well. Tony, what do you think is the likelihood right now? The market's right to be kind of looking through this 30% threat from President Trump. The known unknowns are there. How should we be thinking about the reality of what is finally going to be implemented in terms of Trump tariffs on the EU?
Well, I think that there's too much complacency in the market. The problem is that the EU is projecting weakness and fragmentation. And let's remember that the EU is, after China, a very, very significant partner to the United States in trade. It has real leverage, but it's sending signals of division and weakness, with every member state practically pleading for protection of its export industries. And Trump, of course, is seeing these signals. So he's pushing for more and more. It's feeding his appetite. And this causes a very negative dynamic here, because some of the requests or demands from the United States are very, very broad. It covers not just tariffs, as your listeners will be aware. It covers taxes and digital economy issues and even food standards. And this is very broad. And probably also it includes some of the demands made of other partners like the UK and Vietnam to strip out China from its supply chains. Now, those things are very difficult, if not impossible, for the EU to accept. The real question is, will the EU use the tools it has at its disposal? And I think you were saying beforehand in the program, the EU does have serious tools, recent tools in its arsenal, including anti-coercion, including restricting access to its very significant public procurement market. The question is, will it use those tools?
Tony, to be clear, you think the EU should now be dusting off that anti-coercion tool. It should be lining up tougher measures and communicating that to its US counterparts. This is an EU that needs to be taking a much tougher line right now.
Well, it should, I'm sure it has been, but should be looking at what China did. It met Trump tariff for tariff all the way up 115%. And then led Trump to back down entirely and cut 150% both sides, and they ended up in the same place. That was a big success for China. The EU should be looking at that and saying, well, could we be doing the same thing? Of course, it's much more difficult for the EU to do that because China's an autocracy, the EU is a democracy, and its decision-making processes, of course, are rather slow and cumbersome. So it's difficult for the EU to follow China that way, but China succeeded There is no cost-free way out of this. Some export industries would take a very significant hit, and that's not negligible. But the EU should convince the White House it does have tools and it's willing to use them.
Tony, talk to us a little bit about the impact, though. China was able to meet that Trump tariff eye for eye simply because they felt like they were able to digest the impact of it. They had that fiscal cushion. They had still a thriving export market that didn't just depend on the United States. Can you say the same about the European Union?
So you're right. So there will be a significant impact, and particularly on certain export industries. And I think cars were mentioned before, which is obviously a big deal for Germany. And the Italians are very concerned about their food exports and luxury goods exports and so on. So I don't want to minimize that at all. But the EU has been very successful in diversifying its trade relationships around the world. Of course, the United States is important, but it's been signing a lot of agreements around the world. It will take time for those to show results. But as I said, there's no cost-free way out of this. And let's not minimize the impact as well on the United States from some of the things the EU could do. Public procurement is one thing I hadn't mentioned yet. A potential tax on tech companies' revenues from selling ads, or moving against IP rights and doing many things of that kind. The U.S. has a surplus in the services trade, which Trump never mentioned. He just talks about goods trade, where the U.S., of course, has a deficit. So there are serious tools, but I don't want to minimize the impact. My point simply is that there is no cost-free way out of this, and by projecting weakness, it just feeds into a worse outcome.
So, Anthony, talk to us about some of those fines there, specifically in the tech space, because when we've seen this come up before when it comes to, say, the digital taxes, the digital fines put on Apple, I'm going to use that as a case study here. Apple kind of reverberated by just saying, okay, I guess then we won't put AI or Siri services or the latest technology for products that are then shipped to the European Union. Is that a viable way around this for American companies that operate in Europe, that they just limit their exposure to Europe?
Well, some have said that. I know that's what Apple did, but there's also been a lot more bark than bite. I mean, a while ago, you remember when the EU rolled out its GDPR privacy rules, a number of the tech companies said, we're out. We can't deal with this. This is way too expansive a regulation. And then, as you probably remember, a few years later, they said this is the gold standard, which we're going to be rolling out worldwide. And that's not the only example. So the EU has the Digital Services Act, the Digital Market Act. There have been a lot of complaints about that. And I would be surprised that in many cases, that regulation will be used as a gold standard for many countries around the world. So it's not just privacy, it's also digital. On AI, indeed, there are a lot of complaints that the AI Act is too expansive. And indeed, the EU now has to look at its implementing regulations to see whether they can be somewhat diluted.
Tony, we heard from the EU Trade Commissioner Šefčovič earlier this morning saying the EU must prepare well-balanced countermeasures against us. So in your view, the EU should actually be looking at unbalanced countermeasures in order to project strength. Is that correct?
Completely. Yes, asymmetric measures using the areas where the EU has an advantage, and services, of course, is one of them. There are lots of things that the EU could do that will hurt the United States more than the EU itself. Of course, that's the main point of this, is to reduce as much as possible the pain on EU citizens and minimize pain against the United States. But of course, this is a very sad place to end up. Let's be clear. We should not be in this place. For many, many decades, Republican and Democratic administrations were seeking to increase trade across the Atlantic, increase the bridges across the Atlantic, because that's how we create prosperity. This is a tax on consumers. It would be bad for both sides. And the other important point is there is a positive agenda that we could be entering into with regard to China. And I'm not just talking about reforming the WTO, but looking at being more serious about foreign subsidies. The EU has a new tool on foreign subsidies regulation, which is beginning to use. We've been cracking down on overcapacity. We can be working together more successfully on sanctions, on screening foreign direct investment. The list is very long. And also working together on writing together the rules on trade in these very specialized technical organizations around the world, which are very significant because they set the standards by which exporters have to respect, including on video surveillance and facial recognition and other important areas. So instead of dealing with these positive things, we are now in a vicious cycle of tit-for-tat retaliation potentially, which serves no one's interests.
Tony, in your mind, could the EU be using some of those tools in order to protect its industries that we know it wants carve-outs for, whether that's autos or pharma? Could there be maybe another solution using different tools than just asking the U.S. for carve-outs?
Well, as I said, I think what we should be doing is to say, look, the United States, we can be helpful to you in the areas that you are concerned about, particularly on China. Why don't we actually work together on the technologies of the future? AI is one of them, but there are others as well. Why don't we work together to ensure that our supply chains are indeed resilient? It's a major issue for both economies. We both woke up after COVID and realized that we're way too dependent on, well, China in particular, for not only rare earths on semiconductors and certain kinds of chemicals and so forth. So that's what we should be talking about. Instead of carve-outs for specific industries and so on, let's define a positive agenda.
Tony, before we let you go, on current trajectory, what does the US's trading relationship look like in 2 to 3 years' time with its major trading partners?
Well, unfortunately, I'm not very optimistic. You know, I am rather puzzled. Obviously, it's been clear from what I've said at the trajectory of where we're going. And I say that because, you know, as a former diplomat whose job was to promote the interests of the United States and of our exporters, I cannot see how this is going to benefit us in the United States and our exporters, who should be given a chance to compete fairly worldwide. And by that, I mean entering into agreements like the rest of the world to ensure that there's beneficial access of our exports all over. Now, I'll give you a couple examples. How is it possible in our interests that we have stepped aside from free trade in the TPP? Others have moved ahead in Asia through the CPTPP. Those exporters have beneficial access to a very large Asian market when we do not, relative to them. How is it of interest to us that the Canadians have a better access to the EU market in some instances than we do? Because there's CETA, the Canadian free trade agreement with the EU, and we stepped aside from the TTIP agreement that I helped to negotiate, and we failed. And there are many other examples. So when we go away without leave, and other countries move ahead in signing these agreements, let's be clear, we lose out. We, our exporters, lose out. Our exporters lose out. And we pay more for our inputs, which are often go into our exports. We become less competitive. So for me, I'm very puzzled. I do not see how this ends up supporting our ultimate objectives.
All right, Tony Gardner, former U.S. ambassador to the EU, a senior advisor at the Brunswick Group, and I believe executive advisor at Brookfield Asset Management as well. We thank you so much. Coming up on the program, we're going to talk about the reaction function to policy out of Washington as well. President Trump says the U.S. will send more Patriot air defense batteries to Ukraine to help defend against Russian attacks. More on the defense conversation next. Stick with us. This is Bloomberg.
Why is Baltimore so important to you? It's our state's largest city.
And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Agreed on the number yet, but they're going to have some because they do need protection. But the European Union is paying for it. We're not paying anything for it, but we will send it. It'll be business for us, and we will send them Patriots, which they desperately need.
President Trump there saying the United States will send more Patriot air defense batteries to Ukraine to protect against Russia's ongoing airstrikes. It all comes as Axios reports that Donald Trump will also announce a new plan to arm Ukraine, possibly as soon as today. For more on the topic, we're joined by Keir Giles, Senior Consulting Fellow over at Chat the Mouse and author of, quote, Who Will Defend Europe and Russia's War on Everybody. Keir, pleasure to have you on the program. From your perspective, can you just walk us through where you think this 180 in policy out of Washington came from?
Well, it's very hard to tell at the moment just what exactly the 180 is going to look like. We've heard various previews of what might possibly be happening later on today. And so often before, of course, those previews have been disappointed. There's been a wave of optimism after Donald Trump expresses frustration with Russia and promises to take action when actually it comes to nothing. But what we have at the moment is a combination of indicators that there might be more to it than the usual flash of irritation from Trump followed by no follow-up. There is this statement that there will be Patriots sold to Ukraine. Not quite clear who's supposed to be paying for them, whether it's NATO, the EU, individual countries. All sorts of ideas have been floated. And there's also the visit of NATO Secretary General to Washington, D.C., scheduled for today and tomorrow with no explicit purpose for it. So all of these indicators suggest that something might actually finally have changed in Donald Trump's policy towards Moscow. What lies behind that, of course, is far harder to divine. It could be that Trump's patience at being made to look foolish by President Putin has finally come to an end, but we'll have to see later on with this promised big announcement from Trump.
Yeah, Keir, this promised big announcement with Axios reporting that it could be something, quote, very aggressive. Do you see any room for the fact that maybe the Trump administration could be starting to offer offensive weapons to Ukraine?
Well, that certainly hasn't been mentioned yet, and we should also bear in mind that previously when very aggressive action against Russia has been taken, it's ended up meaning no action whatsoever. So there's really a huge scope for what the Trump administration could decide to do to Russia, including, of course, supporting the proposed sanctions, the bill that's currently working its way through U.S. legislation to impose heavy sanctions on countries that buy Russian energy and therefore support the Russian war machine. But all of these things are currently in play. And as I say, there have been so many previous occasions where there have been big promises which haven't actually turned out to be very significant at all.
So yes, Keir, we see if, of course, this change in tone from the president is matched by action on the ground. On the sanctions package, Keir, and good morning, how significant would that be if he does go down that route?
It would be a huge change, not just in US policy, but also for the whole of the coalition backing Ukraine. Because this has been one of the key loopholes that's been identified a long time ago in trying to persuade Russia not to wage its war against Europe. The fact that so many countries around the world are actually supporting this war by buying Russian energy and pumping funds into the Russian economy so that it can keep going. That would be a major problem for Russia in a way that previous support to Ukraine has been more of an irritation than obviously a major problem that's stopping them waging the war. But, of course, there are other things in play as well. We have seen no indication that Trump is actually going to fully back this package, and without his support, it's unlikely to go anywhere. There's also still the question hanging of Russia's frozen assets abroad, where the interest from them has been used to support Ukraine, but actually confiscating assets and putting them towards the damage that Russia has done in waging its war still seems a long way off. So we have lots of promises in the air at the moment for things that could be done to try to change Russia's policy on Ukraine, but whether it will come true, of course, we still just don't know.
Well, Keir, the sanctions package, to follow up on Tom's question there, if it does indeed go through, adds a lot of pressure on China and India at a time when trade negotiations are still ongoing with the United States and New Delhi, as well as Beijing as well. How much kind of enforcement capability does the United States have on the likes of China or India if the sanctions package goes through?
Well, of course, this would also cause a lot of economic repercussions, not just with those countries that are primarily targeted because they're buying Russian oil, but around the world. And that, of course, has been one of the reasons why there has been hesitancy about exactly how much pressure you can exert on those major economies. And, of course, we have to bear in mind that this is very much in Trump's house style of imposing random numbers of tariffs to try to influence the behavior of the countries, not necessarily with a particular outcome in mind, as we have in this particular case. But it might be that the design of this package is calculated to appeal to Trump because it's something that he's already doing all the time anyway. So again, we simply do not know at this point how it is going to play out and what Trump's attitude to this is going to be today.
How much of an advantage does Russia have right now, Vladimir Putin have right now in this conflict? How well positioned is Russia, particularly when it comes to its partnerships with North Korea and indeed the trade that it has with China?
This is one of the key questions that is unanswered about why Putin has not seized the opportunities that the United States under Trump has presented to him. Putin and those around him have concluded that it is better for Russia to push on at the moment, to continue pummeling Ukrainian cities, to try grinding forward on the front line at the cost of massive casualties, than accepting a ceasefire agreement and pocketing the gains that they have. Now, Russia may be right or wrong about that, but in terms of the support that they're receiving from their partners, the pattern that we've seen over the last couple of years is that those coalition partners that are backing Russia have been far more steadfast and far better at providing aid and assistance than those that were backing Ukraine. Russia has benefited from support from North Korean troops, from Iranian drones, from Chinese equipment and technology, where there's been the hesitancy on the other side from the countries that are backing Ukraine, which has seen them existing on a shoestring, and as we see at the moment, critically short of air defense assets in order to prevent those Russian missiles and drones from night after night pummeling those Ukrainian cities.
All right, Tom Giles, on that kind of sad note, I have to say, walking us through those dynamics between Washington, Moscow, and several other capitals around the world. Senior consulting fellow at Chatham House, we thank you so much. As we look to the week ahead, there's plenty going on, lots of inflation data on both sides of the Atlantic, plus bank earnings, specifically in the United States as well, all leading us to, of course, that G20 finance ministers meeting on Thursday, and on Friday, that's UMich consumer sentiment data. In the meantime, these markets, they continue to sell off. Although off of their lows, the outperformer this morning is, of course, the UK. Is that a risk gauge, though, as Valerie Teitel mentions? That remains up for debate today. However, green on the screen for London buyers, higher by about 0.2%. Your underperformer is the DAX. It does it for the opening trade. The Pulse is up next. This is Bloomberg.
the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai, in for Francine Lacqua, and these are your top stories. Brussels delays retaliatory tariffs after President Trump threatens a 30% rate on goods from the EU and Mexico if better terms cannot be agreed by August the 1st. Stocks fall as Washington escalates its trade war, with investors bracing for a flurry of data that's expected to offer an early read on the impact of tariffs. Plus, President Trump says the U.S. will send more Patriot air defense batteries to Ukraine to help defend against Russian attacks. All right, let's get you up to speed on how some of these markets are faring. We are seeing S&P futures dip a little bit this morning, down 0.4%. We are gearing up for a major week in terms of data, with U.S. CPI coming out tomorrow, in addition to the kicking off of the earnings season. So watch out for banks' earnings this week. This as Wall Street downgrade their estimates for EPS growth year-on-year, lowest level since 2023. 10-year yields up 1.5 basis points today, 4.42, but building on from losses on Friday, we're up about 7 basis points as we keep a close eye on the inflation situation. Euro not doing a whole lot this morning, 116.86 is where we're at. And then Brent, we continue to see gains in the energy complex. Brent sitting at $71, up 1%, as we talk about the potential announcement from the U.S. later on Russian sanctions. But the main story today, European markets, as you can see, the UK is the outperformer, but the continental Europe, all a deep sea of red on back of the latest tariff threats and the possibility of European tariffs going up to 30% on August the 1st. Our top story today. Now, the U.S. president says talks with the European Union are continuing after he raised tariffs on the EU and Mexico to 30%. The higher rate will kick in on August the 1st if trade talks fail. The EU said last week that the framework for a deal was close and has extended the suspension of countermeasures while the talks continue. Donald Trump says trading partners must open up.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
All right, let's get more from Bloomberg's TradeStar, Brendan Murray, TradeStar. So you must be busy, Brendan. Maybe let's just start with the latest news this morning and the fact that the U.S. now has sent a letter to the EU. There's a real possibility of a 30% tariff rate. This despite the fact that the EU were attempting to have negotiations with the U.S. around a trade deal. What are the main sticking points?
Yeah, well, up until a couple of days ago, things seemed to be moving relatively quickly toward an agreement. But then we heard from the president this new 30% tariff threat, and that really is going to add new urgency to the discussions in Brussels that we're seeing today. And they are really under the gun now to figure out how much of an imbalanced arrangement are they going to be willing to accept, because they've already pretty much accepted that they're going to have some sort of reciprocal, sort of universal tariff that they're going to have to withstand. But the real sticking points come down to what are the tariffs going to be on autos and steel and aluminum and pharmaceuticals, these sectoral tariffs that the president has threatened alongside these universal tariffs. So there's going to be a lot of discussions going on in Brussels today about whether they should respond with retaliatory measures, these countermeasures, to hit back at what the president is threatening, or whether they really feel like they have enough time to negotiate less than 2 weeks now before the new deadline.
Yeah, there's an interesting story up on the terminal today saying that the EU is looking to engage with other nations also hit by U.S. tariffs. And I wonder if that gives us some insight into how the EU could potentially counter these tariff threats. What are their options at this point?
Well, what a lot of these countries are coming to the conclusion of that these one-on-one negotiations with Trump, they're not going to win them. He is going to wind up with a tariff on your imports into the U.S. And so I think what we're hearing are sort of the early rumblings of maybe if we all got together and did this in a collective way, then that could be a way to stand up to the sheer clout of the U.S. economy that Trump is using as leverage. So we don't know whether there's some grand plan yet for countries to strike back together in the trade sense, but what we're hearing are a resignation that the U.S. is going into trade wars individually with all these countries, and all these countries can't fight back individually, so maybe they need to team up to do so.
Yeah, well, certainly it's having an impact on European markets today. Most of those indices down about 0.8%. Bloomberg's TradeStar, Brendan Murray, thank you so much. Let's get more on the market impact. We're joined by Modupe Adegbemo, an economist at Jefferies. Good to have you with us. Earlier on the show, on the earlier shows, we had some comments come through from the European Trade Commissioner, and he essentially was saying that a 30% tariff rate would essentially disrupt trade between the EU and US. And we're talking about a non-negligible size here, around $400 billion worth. How disruptive do you think a 30% tariff rate would be for the European economy if indeed it does come to pass?
If a 30% tariff came to pass, I think it would be a real challenge for European manufacturers to deal with. I think one of the things that we also have to consider when you look at European exports to the US is that they're already kind of on the higher cost side. So they don't necessarily have a strong kind of buffer that they could erode into when you start to get to this level of 30%. I do think we hear people suggest that, if you get to the 10% kind of level of tariff, that's something that exporters could deal with. It would be a very big challenge to them, but they could kind of find ways, cost cutting and other ways of kind of saving funds that would allow them to absorb around a 10% kind of tariff. But yes, 30% becomes extremely prohibitive. And I think that's when you start to see a sharp reduction in exports, and that will have a real impact on the Eurozone economy.
Yeah, I mean, that's the thing, right? Like, you look at the ECB's GDP projections for this year, they're sitting at 0.9%, about 1.1% for next year. And over the course of the weekend, I've already seen growth downgrades come through if this 30% tariff comes into fruition, anything from 0.5% to 1%. Could this actually be the catalyst that tips the Eurozone into a recession?
Absolutely. I think it could be. And I think this is what we were kind of fearing, because we knew that the kind of trade negotiations would be difficult. But I think broadly there was an expectation that, we wouldn't necessarily see these tariffs being implemented. But if we were to see these 30% tariffs being implemented, I think there is a good chance that we could see a recession in the Eurozone. And I think particularly because of Germany, already growth in Germany, most people are seeing it kind of flat. That's where we expect it to be. We think Germany will really struggle to grow significantly this year, but a 30% tariff would make it a lot more likely that we see negative growth in Germany. And if the biggest country in the Eurozone is struggling in that way, it's hard to really see significant growth outside in other pockets.
Yeah. So it's interesting you mentioned Germany, because as we speak, German bond yields continue to rise higher. You look at 10-year bonds, we're up about 20 basis points over the course of this month. And if it's not necessarily to do with the growth outlook, because the growth outlook is dimming, is it because investors continue to price in a higher fiscal premium out of Europe and specifically Germany here?
I think we are seeing that. We're definitely seeing significant fiscal expansion. Of course, we've talked about the kind of infrastructure, defense, but also towards the end of last week, we saw the kind of tax breaks for firms also being implemented by the German government. So there's a significant fiscal expansion going on there. And I think it's taking time for investors to kind of, understand and get used to this new reality. It's a complete shift from what we've seen over the last kind of few decades. So it will still take time to feed through to markets. And of course, when we look across other markets, not just Germany, I think investors are really focused on the fiscal outlook. And even though I think Germany's on a much more solid footing, with debt to GDP around 65%, I think markets still are acknowledging that there'll be more issuance, more for them to take down, and that will have an impact on yields.
Yeah, I mean, there was a lot of commentary around 5-year OATs overtaking 5-year BTPs in terms of yields. And I just wonder to what extent the investor focus is going to move away from just focusing on the growth outlook towards fiscal premium, and not just specifically amongst European bond markets, but also in the US. You've got long end yields moving higher, and of course, the JGB is the long end as well.
As we kind of move into Q3 right now, I do think that, potentially after the summer break, that's something that we see as a really key theme. As you mentioned, from the US, there's a lot more focus with more fiscal expansion on the US, but also we can see from the UK that there's been a lot of attention around fiscal sustainability. And I think what's important about kind of Q3 is that's when we really start to see more discussions around next year's budgets. And we've seen a commitment for a lot of European countries in particular to increase their defense spending. But the key question is how a lot of these countries that are a bit more constrained actually end up doing that. And so I do think we will see more and more focus kind of around the fiscal path and the fiscal outlook. And that is quite challenging because, at least from the US perspective, I do think there, of course, is a sharp kind of set to be a sharp increase in US deficits. But from the US perspective, there still is quite a strong growth kind of underlying drive, which I think is important. It's helpful from a fiscal perspective. But actually, for the Eurozone and for Europe in general, trend growth is lower. And so when you see these upticks in borrowing, you see this increase in issuance, it can have more of an impact on markets.
Yeah, Ned, can I just ask you what you think this all means for the ECB? At the latest meeting, the signaling was, I would say, a little bit more cautious or less dovish than it's been as of late. And I wonder whether the new information around the tariffs could actually incentivize them to once again turn more dovish again because of the worsening outlook.
Yeah, so in terms of the next kind of meeting, I do think there's a likelihood that we see more of a dovish shift from the ECB. The kind of risks around growth are beginning to crystallize. So a kind of weakening trade relationship with the US, the potential 30% tariffs will be kind of extremely important to their kind of thinking and their rationale at that moment. But I also think one of the things that we haven't talked about, but the kind of currency as well, the currency impact, that's something that ECB members have also been quite open and vocal, talking about the fact that a stronger euro is also going to have deflationary impacts. So yeah, I do think we are kind of setting ourselves up to potentially see a bit of a dovish shift. And I do think we see the ECB deliver one more cut this year, so bringing rates to 1.75%. But I think the challenge for the ECB is that they also are very, very conscious of the fact that they want to keep essentially keep powder dry, because they have this fear around tariffs, which of course is true, but their worry is if they cut too fast, if the kind of actual outcome doesn't end up as bad as they are anticipating, have they done too much? Have they not allowed themselves enough room to maneuver? And I think that's one of the things that they'll be weighing up as well.
Yeah, no central bank wants to reverse course. Modupe Adegbemo, an economist at Jefferies, thank you so much for joining the Pulse today. Now, coming up, as President Trump ramps up his global tariff threats, we'll speak to the foreign minister of Panama, a country whose famous waterway has drawn the attention of Washington. That's next. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
China's export growth has accelerated for the first time since March, driven by demand from key markets and helped by the trade war truce with the U.S. Exports in June were up 5.8%, while imports rose 1.1%, both figures beating estimates. Let's get more from James Mager, Bloomberg's senior Chinese economy and government reporter. So surprising data to the upside coming through from China overnight. And I wonder what sort of read across that has to the GDP data that's expected to come through tomorrow morning.
Well, I think the first thing to look at is that there was a $590 billion surplus in the first half of the year, which is a massive amount of money. It's a huge surplus. And that is really going to help drive growth in the data that we're going to get tomorrow. My calculation is it's probably about, that surplus is about 6 point something % of GDP. And that is going to be a record in the data that we have. So even if the domestic economy is weak and you saw weak import numbers, that really strong export performance is really going to help push GDP probably a little bit higher than expectations.
Yeah. What could be the potential impact if things all of a sudden deteriorate once again? Because the truce or the language around the framework, things seem to be stagnating ever since it was achieved in Geneva or in London. If things take a turn for the worse again, how is that expected to show up in Chinese data in the coming months?
I think the first thing you'll see is a drop-off again in exports to the US. But the thing to really to look at in the Chinese trade data is that it's not just exports to the US. Exports to Europe are growing again. Exports to ASEAN are growing again. Exports to Africa are at a record. South America. Everywhere in the world, at the moment at least, companies all around the world are trying to buy as much Chinese products as they can, whether it's EVs, solar panels, steel, toys, furniture. Everything that China makes is going out the door. And part of that is, I guess, price deflation. These products are becoming cheaper because you have China itself is in deflation. But even if the trade directly with the US starts to shrink or falls because of these tariffs that we're seeing, it's really going to take a bigger shock where global demand starts to fall before you're going to see a real drop-off in Chinese export numbers.
Very fair. Watching out for those GDP figures then. Tomorrow, Bloomberg's senior Chinese economy and government reporter, James Mager. Thanks so much. Now, European Union officials are meeting with the foreign ministers of Central American countries today as President Trump's tariff threat looms over Brussels. Amongst the countries attending the talks is Panama, which has been removed from an EU list of so-called high-risk regimes. We're joined now from Brussels by Panama's Foreign Minister, Javier Martinez Acha Vasquez. Really good to have you with us. Good morning to you. You're talking to us from Brussels, so I want to start off by asking you about the significance of being removed from the EU's list of high-risk regimes. I'm assuming a lot of work has gone into this moment. How much of a milestone is it for Panama?
Good morning. It is a milestone indeed. We were removed from a list that we consider very unfair because Panama has shown through the years that we are a reliable partner. We have gone through a process of reform in recent years. We are a very, pro-Western country. We have a very solid jurisdiction in terms of our service economy. And the European Union recognized that by removing our country from such a list. And we are very glad, the horizons right now are very, very attractive for everybody, for the European countries, for European companies, and for Panama. We hope from now on to work closely with the European Union, with our partners, as well as with the United States, because we are committed to transparency and also to cooperate with the European Union and with all democratic countries that shares our values.
Yeah. Well, Panama, you mentioned the United States. Panama found itself at the center of the news a couple of months ago. And even on the campaign trail, President Trump talked about taking back control of the Panama Canal. And of course, your president quipped that sovereignty was not up for discussion. Can I just start off by asking you today, at this point in time, how is Panama's relationship with the United States?
Well, right now, our relationships are very good. We have gone through a period of complex relationship, but so far, with the new administration in different levels, we have developed a very close and fruitful relationship. We have been visited by major officers from the United States, Secretary of Defense, Secretary of State, the head of the CIA, and also the Secretary of Homeland Security. That shows the interest of the USA in Panama. There is a fact. The USA is our principal ally in terms of commerce and also in terms of security. But this is a historical fact. It is not an event that has developed since the new administration in the USA. Right now, I can reassure you that we are working together in different fronts, in cooperations, to tackle organized crime as a medical threat, but always with respect to our Constitution and to our neutrality treaty that guarantees the neutrality of the Panama Canal for all the countries in the world.
Yeah. What you haven't mentioned, though, is the links to China, and that is a serious point of contention that the U.S. has, especially the Chinese-linked infrastructure. On the back of your discussions with the United States, are you re-evaluating the economic arrangements that you have in place with China?
Well, let's be clear on this issue. there is no Chinese influence in Panama or in the Panama Canal. We do have 2 ports that were handed to companies, because the ports belong to Panama, at the end of last century. In those days, Hong Kong was part of the UK. And then Hong Kong became part of the People's Republic of China. So they are now part of that country. They have zero influence in the canal. They have a port operation within the canal in the Atlantic and in the Pacific. So I can, be very sincere and also make a steadfast affirmation that the Panama Canal is run by Panamanians in a very efficient manner without interfere from any country in the world.
A few months ago, there was a report that came out saying that BlackRock were reportedly in talks to acquire 2 of those ports under L.K. Hutchison's control. But recently, there seems to be some noise around it because of the uncertainty vis-a-vis the tariff regime between U.S. and China. Can you give us just an update of where things stand with those discussions?
Well, that is a private operation between BlackRock and MSC and the current owner, Hutchison Port. So I cannot comment on the negotiation because that's so far a private transaction. I believe the deadline that they established was at the end of July. When that deadline expires, our country will, have the right to take some decisions in the best interest of Panama.
So let me just go back to what I said to you at the beginning, which is...
It's very important to remark that BlackRock is trying to buy the whole operation of Hutchison in the world, not only the 2 Panamanian ports.
Yeah. Let me go back then to what I was saying about Panama finding itself as a geopolitical hotspot around the world. And now the news cycle has moved on. So many countries around the world are having discussions with President Trump. Is there any advice that you would give other leaders, foreign affairs ministers, in terms of how to deal with the Trump administration to move towards a coordinated response and one that is reliant on mutual respect and cooperation as opposed to mutual threats?
Well, you have to understand that the Americans elected Mr. Trump in a very clean elections, and he put forward his plan. So he's not doing anything else than what he promised. From that point on, we need to engage with the USA in a very sincere and frank manner, and the personal interactions really helps. I have had the opportunity to meet with different very important officers from the American administrations within the room when we explain to them our reality, our constraint. They are very, very, they comprehend what we are doing in Panama. We feel that the personal touch really help to develop a very strong and beneficial relationship between both countries.
Yeah, certainly. Appears to be good advice. Panama's Foreign Minister Javier Martinez Acha Vazquez, thank you so much for taking the time to speak with us today from Brussels. Well, coming up, we will be taking a look into India's push into clean energy with the chairman and CEO of Indian renewable company Renew. That's next, and this is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai in for Francine Lacroix, and these are your top stories. Brussels delays retaliatory tariffs after President Trump threatens a 30% rate on goods from the EU and Mexico if better terms cannot be agreed by August the 1st. Stocks fall as Washington escalates its trade war, with investors bracing for a flurry of data that's expected to offer an early read on the impact of tariffs. Plus, President Trump says the U.S. will send more Patriot air defense batteries to Ukraine to help defend against Russian attacks. And a look at markets today. The big news, obviously, tariffs, the latest tariff threats out of the U.S. towards the EU and Mexico. S&P futures down 0.4%, coming off those all-time record highs. Big week coming up in terms of U.S. CPI and the beginning of earnings season. So watch out for that in the coming days. 10-year yields up about 1.5 basis points. Of course, we are up 7 basis points. We were up 7 basis points on Friday as we continue to put a lot of focus both on the inflation outlook and the fiscal premium amongst many yield curves around the world. Bitcoin, I just wanted to flag this morning, we are through $120,000 for the first time ever, so up 3% in trade, but notable because it is at an all-time record high. And then silver as well, it hasn't got as much love or as attention as gold, but today you can see up 1.3%, the highest level in 14 years for silver, so just sitting shy of $39 today. But back to one of our other top stories this morning. President Trump says the U.S. will send more Patriot air defense batteries to Ukraine, which Kyiv says are needed to protect against Russia's ongoing airstrikes.
I haven't agreed on the number yet, but they're going to have some because they do need protection. But the European Union is paying for it. We're not paying anything for it, but we will send it. It'll be business for us, and we will send them Patriots, which they desperately need.
This comes as Axios reports Trump will also announce a new plan to arm Ukraine, possibly as soon as today. Let's get more with Bloomberg's Russia economic and government editor Greg Sullivan over here with me in Dubai. Greg, what do we know about Trump's plans to assist Ukraine with its military equipment?
Yes, so President Trump has agreed to provide these Patriot missile barrages that Ukraine says they need for their protection. He wasn't specific about how much he would supply, but he did say that the U.S. would not be paying for it. They would be paid for by European and NATO allies. But Ukraine has said that they need these. The Pentagon had been supplying air defense missiles and artillery shells, but then they halted it, saying that they needed to assess their own stockpiles. This appears to be a shift back to us.
Why has there been this shift in thinking from the U.S. president's perspective? Because it was only a couple of months ago he was ruling out the possibility of further military aid to Ukraine.
You're right. This is a big shift from President Trump. He's been very reluctant to aid Ukraine. He campaigned saying that he didn't want to. But there's a number of factors at play. One is that during his campaign in the first months of his term, he was adamant that he could bring about a peace deal. So far, Russian intransigence on that matter has frustrated him. To the missile and drone barrages over.
And he also teased on Friday that there's a big announcement coming this afternoon. Some people have taken it to are inferring that it could mean another round of sanctions on Russia. What do we think?
It could be a number of things, but two things that we'll be watching very closely are weapons supplies. Are there more to this weapons delivery than has been previously announced? And two, as you said, sanctions. So far, he's been reluctant to impose sanctions on Russia, but this could be a moment to announce a shift in that. There's obviously legislation working through Congress that he might cast his support behind. So those are two things that we'll watch carefully in this announcement.
Greg, thank you so much. Bloomberg's Russia economic and government editor, Greg Sullivan. Now, Iran's foreign minister says the U.S. is trying to restart nuclear talks, but stressed his country is in no hurry to engage. He said in televised remarks that Iran had received multiple messages and is weighing options. He added that Iran needs guarantees it won't be attacked again if the talks don't succeed. And Jane Street Group has paid $564 million to an escrow account to comply with an order from Indian regulators. The U.S. trading giant deposited the funds after a ruling from the Securities and Exchange Board of India last week. The SEBI temporarily banned Jane Street over allegations of index manipulation, which Jane Street disputes. Now, India is making significant strides in its energy transition, embracing clean and efficient solutions to reduce its reliance on fossil fuels and imports. This strategic shift is crucial as the nation currently spends an amount equivalent to 5% of its GDP on importing fossil fuels. Joining me now is Sumant Sinha, Chairman and CEO of Indian renewable energy company Renew. Really good to have you with us on the program. Before we talk about your own company's plans, I do want to ask you perhaps a broader macro question as it pertains to India, because we know many countries around the world, India included, are having discussions with the U.S. about a potential trade deal. To what extent do you feel like the fate of your own company's operations are linked to what happens with those discussions and whether India can actually seal a deal?
Yeah, hi, thanks, Jumana. Look, I think that the Indian clean energy sector within which we operate right now is mostly domestically focused. We have a lot of growth in the Indian electricity system. We're growing at about 6 to 7% every year. And that's on top of a fairly significant market size, which is the third largest in the world. And so therefore, our company's future really is tied into the growth of the Indian market. We don't have that much essentially to do with the US. And so therefore, really, for us as a clean energy player, the trade deal with the US really doesn't matter as much. Of course, we are also a solar panel manufacturer. So to that extent, to the extent that they are willing to import, or the US is willing to import solar modules from India, I think that, of course, can then become an additional market for companies like ours, which are also manufacturing solar panels. But other than that, there is no real implication for Indian companies.
Yeah, I was going to ask you about that, because the U.S. is looking to protect its industry from Chinese manufacturers. I do wonder whether Indian manufacturers actually sense a window of opportunity and economic opportunity to fill that void.
There might very well be. I think we have to look at the fine print of the big, beautiful bill to see exactly what it says around imports from other countries and what sort of imports are permissible and so on. And of course, we also have to see what the reduction in the IRA benefits that were there earlier essentially means for future capacity addition of solar power in the US. So I think we'll have to look at all of that, and I think some of that will become clearer in the next couple of months' time as the details of the bill are something that we begin to absorb and assimilate. I think we'll find out as we go forward.
Have you had to rethink your own supply chains and where you import your crucial raw materials from? In a world where protectionist barriers are going up, have you had to sort of rethink your own process of where you import some of those materials?
Yeah, absolutely. I think, what has happened is that the Indian government has taken a very strategic view that we don't want to essentially, exchange one kind of energy dependence, which is really today on oil and gas, to another kind of energy dependence, which is importing equipment for making solar panels or wind turbines from other countries. And so therefore, there's a very strong decision taken to essentially try to make sure that we localize and indigenize all the manufacturing for clean energy within the country itself. So wind turbines are mostly made in India, and solar panels now, we have a very active solar module manufacturing industry in the country. We're also making solar cells, and over time, the intention of the government is essentially to localize the entire solar manufacturing chain as well in India, and essentially allow India to emerge as an alternative supplier to the rest of the world beyond China, which is, as you know, today is supplying almost 80-85% or more of all the clean energy equipment.
Yeah.
So I think that is the view that the Indian government has taken, and we've actually, as a company, been working with the government on making sure that we set up solar manufacturing within the country. And so we have now set up about 6.5 gigawatts of module and cell manufacturing capacities in the country at this point.
Sir, I was at the OPEC seminar in Vienna last week, and there are a lot of conversations being had about long-term energy and what that supply mix looks like. And many of the speakers there cautioned that if you move too quickly with the energy transition, you're going to imperil both energy affordability and energy reliability. And the takeaway is that hydrocarbons will essentially continue to be part of that mix. What is your response to that? Was the world moving too quickly on the transition?
I don't think so, Jumana. Right now, what's happening is that, electricity today accounts for only about 20-25% of the entire energy mix. So it's a relatively small part. And within electricity, renewable energy accounts for only about 15% in most geographies around the world of electricity. So as a percentage of energy, renewable energy or clean energy is still a very, very small percentage. So to say that we are moving really fast in that transition, I think is really not right. On the flip side, if you look at what we need to do from a carbon emissions reduction standpoint, we actually need to move a lot faster, which is why at COP28, all the countries came together and said that we need to triple renewable energy capacity by 2030, which essentially we need to do. And we need to electrify the global economy as fast as possible so that we have more parts of the energy value chain moving to electricity. Now, if you look at India's long-term plan, by 2047, the expectation is that we will essentially electrify a part of the energy system from the current 17% to about 34%. And within that, increase the renewable energy mix within electricity from about 15-20% right now to about 50%. So I think those are the kinds of changes that we need, and we need to really move at scale if we have to bend the trajectory down in a way to keep the temperature change increase from being below 1.5, which seems increasingly unlikely, and essentially now below 2 degrees centigrade.
Yeah. You talk about the COP28 commitment to triple renewable capacity by 2030. What happens to that target, to that commitment, once the world's largest economy, the U.S., pulls out of the Paris Accords?
Well, I think it's something that we have a template for from the last time that the Trump administration was there 5 years ago. I think the rest of the world just carried on. And I think, of course, it's not great for the world's largest economy to be pulling out of the Paris Agreement because it is the second largest carbon emitter. And of course, it sets an example for the rest of the world. But I think what was very clear from the last time was that the rest of the world is going to be staying committed to the path of carbon emissions reductions and is going to stay committed to the path of whatever was agreed at the COP agreement. If you look at countries like India, for example, we have a pretty aggressive plan to move our energy system from the current system, which is based on fossil fuels, mostly towards clean energy, using things like green hydrogen, using nuclear, using hydroelectric power, and of course, clean energy through renewables to fundamentally reshape our energy system. Now, I think that's the way of the future.
Yeah.
And I think countries that move faster in that direction, I think will be rewarded in the long run. And also keep in mind that countries like India actually don't have a choice because we don't have a lot of fossil fuels within our country. So it's a question of also energy security. And there's a very strong commercial implication because renewable energy at this point is cheaper than the alternative, which is fossil fuel-based power.
Yeah. Final Renew specific question for you. A consortium towards the end of last year proposed taking the company private and delisting it from NASDAQ. Can you give us an update on how those discussions are going and the plans to delist?
Yeah, Jumana, you know, because that transaction is ongoing and because I'm an interested party in that transaction, being a member of the consortium, it's probably best for me not to comment on what's happening right now. But I think if you look at the latest filings that the company has made, the consortium has made an offer, which is a sort of a final non-binding offer of a certain price. And I think the board or the special committee of the board that has been set up to look at this is probably actively considering that offer that has been made. So I think that's really where things are. And I think that the company will, in fact, update the market as and when things progress forward. But thank you.
Okay. I look forward to getting that update, sir. Thank you so much for joining us today on The Pulse. Sumant Sinha, Chairman and CEO of Indian renewable company Renew. Now, Wizz Air says it's suspending operations in Abu Dhabi effective September the 1st and wants to pull out of its joint venture there. The budget carrier has faced challenges, including engine maintenance issues and what it calls hot and harsh conditions, as well as geopolitical volatility and regulatory barriers as it tries to keep costs under control. And coming up, Donald Trump's allies seize upon a new way of criticizing the Fed Chair Jerome Powell, the cost of the renovation of the Fed's headquarters. Details next. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States.
That was European Commission Competition Chief Teresa Ribera speaking to Bloomberg. Now, the EU is said to be preparing to step up its engagement with other countries hit by President Trump's tariffs. Meantime, EU foreign ministers are meeting today to discuss progress on trade talks.
An idea of 30% tariff rate is effectively prohibitive to the mutual trade. we remain convinced that our transatlantic relationship deserved a negotiated solution, one that builds the basis for renewed stability and cooperation, and that is why we continue to engage with the United States administration and prioritize negotiated solutions by the new deadline of the August 1st.
We're joined by Antonio Barroso, Bloomberg Economics, Senior Geoeconomics Analyst for Europe. Antonio, so these EU foreign ministers are meeting today to discuss the trade talks with the U.S., but of course the goalposts have just shifted. They thought they were working around a 10% baseline tariff rate. That is now shifted to 30%. How do we get back to 10%?
Well, that's exactly what the EU negotiators are trying to figure out. I think the problem here is that it's very difficult to know at this stage what Donald Trump actually wants. EU negotiators and US negotiators have been talking for weeks now, and they have been discussing very difficult concessions, especially on the EU side. So it makes it very difficult for the EU to essentially continue negotiating, but that's what they want to do. Clearly, Brussels doesn't want to engage in a escalatory spiral. There are reports that they were willing to accept a 10% blanket tariffs from the U.S. in exchange for some sectoral concessions. I think that's what they're going to aim for. But then, as I said, the main challenge is to know what Donald Trump actually wants. And a second challenge is, should the EU actually signal more forceful retaliation? Because, there's the short-term risk that Donald Trump might get even more angry and might actually make the negotiations more difficult. But maybe that's what you need. You need to retaliate, to signal that you will hit back strongly for the U.S. to actually give some concessions. So I think the EU right now is in a very difficult spot.
Yeah, and it's difficult also because growth is still at a very low level. You compare it to China, China is still growing at 5%. So there is a bit of cushion there and a fiscal cushion from China's part to play hardball. But speaking of China, there are also tensions between the EU and China. It's not just the EU and the US right now.
Yes, the EU is in a very difficult geopolitical position because there is a summit between the EU and China. This is expected to happen at the end of the month. And basically, the EU was expecting to iron out some of the differences that remain between both sides. But from the point of view of Brussels, China is actually not moving in some of the issues that concern the EU the most. For example, China has continued to support, according to the EU, the Russian war effort in Ukraine, and that's a very big problem for different European capitals and from the EU as a whole. But also, Brussels claims that China is not doing enough to stop overcapacity coming out from China, Chinese goods to be exported to EU markets and to flood EU markets. Several EU firms are worried by this, but China is not doing enough according to Brussels. So I think what you're going to get in the summit is a lot of words, but nothing actually to solve those irritants that really are a problem for the EU-China relationship. So the relationship is going to get worse, not better.
Yeah, and obviously a lot of attention as well on Europe's fiscal plans. Another story that caught my eye over the weekend, President Macron saying that he wants to double the French defense budget. Do they have the fiscal room for that?
Well, that's the question that everybody's asking. I think Macron has a very good point. President Emmanuel Macron of France has a very good point of promising to increase the defense budget. Is in line with the compromises and the different things that have been negotiated at the latest NATO summit. The question is, first, will he actually have a government in place to deliver such an increase in the budget for defense? You're going to have the budget negotiations for next year accounts now in October that will start, and there is very well the possibility that the government of Prime Minister François Bayrou might fall over the discussions on this budget. It's very difficult. You're going to have to increase the defense budget, and to do that, you can do three things. You can cut spending, which is not very popular. You can increase taxes, that is not very popular with voters, or you can actually increase debt, that is not popular with markets. So it's not a very good situation for France in that regard. And in politics, we know one thing: it's very easy to promise things, it's much harder to deliver them.
Yeah, and as you're speaking, we're just showing some live shots of Bastille Day celebrations as they are taking place. So there is a picture of President Macron with his wife standing by, and others in attendance as well as we talk about Bastille Day. commemorations. So there you have it, some pictures live from Paris. I do remember, actually, a couple of years ago, he brought in a whole musical group to play renditions of Daft Punk. That was very memorable, if anyone recalls that from a few years ago. Anyway, that was Antonio Barroso, Bloomberg Economics Senior Geoeconomics Analyst for Europe. Now, UniCredit says it will assess the next steps on its takeover plan for Banco BPM amid doubts over whether the deal will go ahead following a ruling by an Italian court. The court struck down 2 conditions imposed by Italy on UniCredit to complete its bid. However, it left in place other requirements that CEO Andrea Orcel had previously said could halt his takeover plan. Now, there's lots of data out this week, which may give a sense of the impact Donald Trump's trade war is having on the global economy. First up, it's U.S. inflation data due tomorrow. Let's get more on what to expect with Bloomberg MLive strategist Ven Ram. So much going on in terms of data this week, but U.S. CPI is always the big one. And just looking at analyst expectations, most people seem to be expecting an uptick, both on core and on the headline figure.
Morning, Jemana. Good to be here, and great stuff out of Vienna last week, I thought. Look, I mean, I think the point of the inflation data that's going to come out for June is that there's going to be an uptick in inflation, as you mentioned. And I think that we are going to get inflation data out of the UK as well, day after tomorrow, and that's also supposed to show that inflation is going to be elevated. So basically, we are in a world where we are looking at 2.6 to 2.7% on core PCE, which will come out later this month in the US. And of course, inflation in the UK is elevated as well, 3.5% thereabouts. So all these factors suggest that, look, the terminal rates are kind of mispriced going into many of these markets, particularly in the UK, because I think that the markets are thinking that, the terminal rate could be lower than 3.5, which I think is unlikely because the inflation uptick in inflation is simply not going to give the BOE sufficient headroom to cut rates as much as they would like to.
Yeah, and meanwhile, President Trump and his allies are stepping up their criticism of the Fed chair, Jerome Powell, taking aim at his handling of the expensive renovation of the Fed's headquarters. It all coincides with Trump's relentless calls for the U.S. Central Bank to lower interest rates.
I think if Jerome Powell stepped down, it would be a great thing. I don't know that he's going to, but he should. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
So I saw a comment from Deutsche Bank's George Saravelos over the weekend saying that the market is underpricing or underestimating the real risk that the Fed chair gets forcibly removed or dismissed.
Well, I think Saravelos is absolutely right. I think the markets are pricing 2 rate cuts by the end of the year, which is according to the Fed median dot plot. But I think that the markets are underpricing that risk. Why do you say that? Because the Fed has got 4 more meetings to go. In July, they're not expected to do anything, but they've got 3 more meetings after that, September, October, and December. And if we get Powell as ousted, then I think there is a real risk that we'll get someone who's dovish and who's willing to cut rates as Trump wants, which means that 3 rate cuts is very much a possibility. And if you look at the Fed's dot plot, the lowest end of the range for this year was 3.6, which would tally with 3 rate cuts. And I think that the markets shouldn't be discounting that possibility.
Yeah, not least some questions about the central bank independence also, Ven, so perhaps bigger existential questions around the U.S. as well. Bloomberg MLive strategist Ven Ram, thank you so much for joining us on The Pulse today. But that was it for our show. Obviously, tariffs dominating the news agenda today as we continue to monitor the price action in European markets, most of them declining, led by the autos, tech, and consumer goods sectors. That was it for The Pulse. Up next, Bloomberg Brief. This is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
It's
structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. More letters. President Trump warns the EU and Mexico they'll face a 30% tariff. The EU plans to step up trade deals with other nations. Laying the groundwork, a White House probe over Fed renovations fuels speculation that Trump may attempt to fire Chair Powell. And the view from corporate America, Wall Street braces for the weakest earnings season in 2 years. So did I miss anything in the week that I was out? Gained by new highs in the market, both in the S&P and the DAX. Maybe I didn't really, but you had 30 hours from the Trump headlines, from the letters coming to the EU and Mexico that there'd be more tariffs to try to decide and sit there. What would the market reaction be? Maybe this is anticlimactic in light of that. Yes, we are down across the board, but not dramatically so, down about a third for both the S&P and NASDAQ. Now, for this bond market, the pressure does continue there. Bonds have been under pressure, be it from the better economic data or from these renewed threats as concentration on the renovations to the Eccles building. Is that cause for trying to oust Powell? 2-year yields, those are a little change. Your 10-year yield up by 1 basis point, but you can see on the bottom of your screen, it's Japanese bonds that are really under pressure this morning. A story familiar around the globe that it is concerns of fiscal, of deficits, of spending. That has Japanese 20-year yields at their highest since 2000. Those are your overall markets. Let's get you some stocks to watch. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start in the tech space. We've had Synopsys rising nearly 4%. This is on the back of the Chinese regulator giving them the green light for their $35 billion acquisition of Synopsys. These two companies are very active, very massive when it comes to the computer software simulation industry. Next, let's move on to defense. Boeing was upgraded by Bernstein on the street. There's also some more speculation about this major announcement that Trump is due to make today around Russia. Does that include more defense support for Ukraine? So defense stocks are in the green this morning. Lastly, let's end in the consumer space. Kraft Heinz up 2.5%, adding to Friday's gains. This is on the back of a Wall Street Journal report that the company is looking at a breakup of its business lines. Danny.
Valerie, thank you very much for that, and we'll catch up with you later in the hour. Also in this hour, in just moments, we'll be speaking with Isabel Mateos-Ilago of BNP Paribas, who joins us on her read on the current impact of trade uncertainty, and Sarah Bianchi of Evercore ISI joins us for analysis of the political risk as letters get sent out to trading partners. Now, on that, our top story, trade uncertainty is the focus, the dominant theme for investors. Isabel Mateo-Ilago, chief economist at BNP Paribas, writing, the outlook for U.S. tariffs is worse than we hitherto anticipated in our central scenario. While the extension until August 1st of the 10% universal baseline tariff window is in some ways welcome, the letters sent by the White House last week prolong uncertainty and suggest an increased likelihood of tariffs eventually setting closer to the Liberation Day level. I'm pleased to say that Isabel joins us now. Isabel, it is a market that maybe doesn't want to get fooled again, in the words of Peter Scheer, quoting the song, or maybe just thinks that Trump will back off. Is that a mistake to assume that the current levels being sent out now are going to be lessened down the road?
Good morning, Danny. Look, I think the market has initially reacted to the only hard news we have, which is that the window for talks has been extended until August 1, which is definitely positive. And I think the market has also learned that there's an element of Trump negotiation tactics, which is to hike the pressure when you come into the final stretch. So it seems that the fairly moderate or insignificant, frankly, market reaction we've seen so far is this assumption that, don't pay too much attention to the headline numbers. However, that may be complacent, and I think our central scenario, and I think which was pretty consensus, was that we would settle around an average external tariff for the U.S. that would be around 15%, which is still very high, and it now looks perhaps more realistic that it will be higher than that. Quite simply because President Trump may have decided that markets can stomach this, and the U.S. economy needs the revenue. So I'm not sure markets have fully priced that in yet, and that will be important to see how much progress can be made in the next few weeks until August 1 to lower down these headline level tariffs.
So if it is a president, Isabel, that's emboldened by a lack of market reaction, it goes further than that. It's also a lack of anything showing up in the economic data, which also has been supporting the markets. At what point does that change if we do settle around a tariff level that's above 15%, or even if we just get more uncertainty?
Well, uncertainty itself is a factor, and you're starting to see this from the reactions that, from the corporate sector in the impacted areas, notably, copper recently. Like, people are saying, just give us certainty, give us a number, and then we can adjust. And that, unfortunately, has been lacking. Now, you're right, the global economy and all its parts, frankly, have been very resilient in the face of all the shocks we've had so far. And I think one reason for this has been actually the resilience of global trade, because we've seen a lot of front-running of tariffs that led to surge in exports from everywhere in the world to the U.S. We're expecting some pullback, but actually so far the pullback has been fairly minimal. And as well, we've seen a lack of retaliation from the vast majorities of countries, and more trade deals being discussed or concluded between other countries. What that means is that global trade has remained incredibly resilient, and it's true so far we haven't seen too much of an impact from the ramp up in U.S. tariffs level. But I think it would be not just premature, but frankly wrong to assume that there's going to be no impact. We're just still waiting for the dust to settle, with, of course, the concern that President Trump himself may be drawing the lesson that the market is fine with all this and the global economy is going to be fine with all this. And I think that would be drawing the wrong conclusion.
Isabel, what does that mean for your assumption tomorrow when we get CPI data? Will any of the creep of tariff-related inflation show up?
We should begin to see some of that tariff pressure show up. It hasn't so far, but there were a few reasons for this. The main one probably being the large inventory level, which could take, frankly, all the way until the end of August to clear out, judging from inventory to sales ratios currently. As well, the effective tariff actually collected until June remained quite a bit lower than the statutory rate. So June is really the first month where they're close to one another. And companies generally, while signaling in surveys that they fully intend to pass on additional costs from tariffs, have had reasons to be patient while waiting for clarity about the final level of the tariffs. So we do expect to see first signs of pass-through, and in line with your consensus, expect CPI around 0.3, both for core and headline, which would be a significant leg up. But we think the bulk of the impact is going to manifest itself in July and August.
It has been pretty remarkable, though, Isabel. It's not just the headline data that's looked really strong. What we've heard from corporates as this earnings season starts in earnest this week, but we heard from Delta expecting more passengers. Amazon, for their Prime Day, had the biggest Prime Day that they've ever had. We're going to get the banks, JP Morgan, Wells, Citi, all reporting tomorrow. What are you looking from to corporate America to signal the state of not just consumers, but this overall economy as the trade headwinds start to hit?
Yeah, well, I mean, you have to remember the tariffs only apply to goods, and the U.S. is primarily a service-driven economy. So, you know, Delta is not impacted by tariffs. The banks are not directly impacted by the tariffs. A large shares of the U.S. economy are not directly impacted by the tariffs. So we should expect, and the economy has been holding up remarkably well. So there's no reason to expect bad news all around. And then even the manufacturing sector, you know, looking backwards, has been impacted by tariffs at 10%. And in some sectors which have been exempted so far, none at all. So the question is going to be not so much the backward-looking impact on earnings, but really the guidance. What are they signaling? And in those sectors that will be impacted by the tariffs, how much are they signaling it might impact their margins? But so far, all the signals are that the margins indeed have not been impacted, and the economy has been holding up well. So earnings should be pretty good.
All right, it's going to be a busy week between that and CPI, as you mentioned. Isabel, thank you so much for joining on this Monday morning. Isabel Mateos y Lago of BNP. Now let's get you some other top stories that are trending on the terminal this morning. Bitcoin has hit another record, topping $120,000 for the first time. Progress on crucial crypto legislation is adding fuel to that rally. The House will debate and possibly vote on legislation this week. President Trump and his allies have seized on a new way to criticize Fed Chair Powell, the renovation of the Fed headquarters. The construction project offers the clearest example yet of how the president and his team are looking for every opportunity to scrutinize Powell's leadership. Powell's term as chair ends in May of 2026. And President Trump also says the U.S. is sending more Patriot air defense batteries to Ukraine. He told reporters on Sunday that the EU will shoulder the cost. The remarks are likely to set the scene for what the president described would be his, quote, major statement on the war in Ukraine sometime today. Coming up, countries jostled to cut a deal with Trump. We're going to bring you the latest trade update up next on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
President Trump speaking on Sunday. Sources tell Bloomberg that the EU is also preparing to step up its engagement with countries hit by Trump's tariff regime. The bloc's trade chief told reporters earlier that he's still in talks with the U.S.
An idea of 30% tariff rate is effectively prohibitive to the mutual trade. And that is why we continue to engage with the United States administration and prioritize negotiated solutions by the new deadline of the August 1st.
Joining us now is Brendan Murray, who leads our global trade coverage. Brendan, this is becoming something of a trend. Announce above consensus tariffs either on the weekend or after the market close. It's enough to keep your head spinning. Where do we stand with these letters that the Trump administration has been pushing out?
Well, we saw the flurry of them come out starting last week, and we expect more to be released this week. For the European Union, though, this is really coming down to crunch time. They're gathering in Brussels today. There'll be a lot of back and forth about what they should do to respond to President Trump's latest threat of 30%. You heard the trade minister there talk about how that was prohibitive, essentially saying that will destroy trade between the U.S. and the European Union. So not something that they could live with. And so the negotiations will continue later today. They have talks with their U.S. counterparts. And so they will really have to decide how much of a pain threshold they're willing to take. The baseline is 10%. President Trump is now saying 30%. You know, could they meet somewhere in the middle? We will find out. But in the meantime, there's a lot of anxiety about how much of an economic headwind this could be for both economies. Really, this is the largest trade and investment relationship in the world, the transatlantic U.S.-EU relationship. So there's a lot at stake here. There were countries last week who received their tariff letters, but none that are as big as the economic relationship between Europe and the United States.
Well, Brendan, on that point, this headline coming out just about 20 minutes ago, an EU official saying that the EU's Ursula von der Leyen and from Canada, Mark Carney, will be meeting and will be speaking rather today. Brendan, what is the EU doing, and really all these nations, maybe to look beyond the U.S. and strengthen trade relationships elsewhere?
Well, up until this point, you basically had two options in dealing with the U.S. administration. You negotiate them, and you negotiate a deal that does not benefit you. Or you retaliate, and almost none of the countries that President Trump has targeted are retaliating. So they've been all of these discussions that have pretty much gone nowhere. We don't have barely any deals signed by the previous deadline or now the new August 1st deadline. And so what countries we're likely to see are they're going to start talking to each other about, can we coordinate a response here? We can't win the one-on-one fight with the U.S. economy because we're so reliant on it. So maybe, and we'll have to figure out what the details are of this von der Leyen-Carney conversation, but perhaps we might begin to see countries start saying, you know what, if we do this together, we might have better success.
Will be interesting to see how that goes. Brendan, thank you so much for your coverage. That is Bloomberg's Brendan Murray. Now, in the meantime, China's export growth accelerated for the first time since March as factories rode out the tariff roller coaster. Exports in June were up 5.8%, while imports rose 1.1%, both figures beating estimates. Let's get more with Bloomberg China economy editor Alan Wong. Alan, what does the data tell us about how China has been dealing with the latest tariff headwinds from the U.S.?
China's data is telling us that China's export machine is humming along rather nicely despite all the tariffs and the trade war that is still continuing. Don't forget that despite the trade truce, we're still looking at tariffs as high as 45 or more on Chinese products entering the United States. And that's not counting certain tariffs that apply to different products and materials. And so the number is telling us that China has managed to find markets to sell its wares, even though exports to the U.S. in June fell more than 10%. And the previous month, when the 145% tariffs were in place, the fall in exports to the U.S. was even more severe. And being able to find new markets for Chinese exports is important, also because domestically China has an overcapacity issue. So if manufacturers could find new customers outside the U.S., then China's export machine is in safe hands. But there are lots of uncertainty with tariffs, which we have discussed extensively, including how the coming negotiation between China and the U.S. and a potential summit between President Xi and President Trump will pan out, because those will decide whether the two countries can have a lasting trade agreement that can ensure at whatever level of tariffs that trade can remain flowing between the two biggest economies.
Alan, another concentration of Trump's tariffs had been Southeast Asian nations, and we're still getting the details worked out there. Vietnam had been surprised by a 20% tariff placed on them. But if a lot of these exports, it seems, are going to Southeast Asian nations, what does that suggest about how various operators are getting around the China tariffs? Will we continue to see a fueling of goods there that still make its way to the U.S.?
Yeah, it's worth noting that in June, China's exports to Southeast Asian countries, the ASEAN countries, jumped more than it did the previous month, which meant that a lot of the goods that China is selling globally now goes to Southeast Asia, but we don't know if those products are meant to be consumed by those countries. In fact, there's a very good chance that those products or parts are assembled there and then shipped along to other countries, such as the United States. And what it's going to be very interesting is to see, with all the letters that Trump is sending to different countries, whether he can manage to convince other countries to curb Chinese transshipment, however that's defined, and to use higher tariff rates on those transshipment to deter such practice. And that will have a major effect on China's export and, by extension, its economic outlook.
Yeah, a lot of confusion as to exactly how that will take form. Alan, thank you so much. Bloomberg's Alan Wong. Now, a quick check on currencies this morning. And likewise, you aren't seeing much reaction across markets into what was announced over the weekend, a new 30% tariff rate with an August 1st deadline for both the EU and Mexico. Little change for your dollar, your euro, and your yuan. Coming up, former President Biden calls President Trump and other Republicans, quote, liars when it comes to some of his clemencies. We're going to have the details for you next and your front pages. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
You're watching Bloomberg Brief with Danny Berger in New York. Let's get you some front page news. Here's what the major publications are running with this morning. Now, on the Wall Street Journal, the federal government retreating from student lending. President Trump's tax and spending law includes new restrictions on how much students can borrow and how they repay. The provision reverses the government's near takeover of the $1.7 trillion student lending market over the past 6 decades. Now, next up, the Financial Times has this on their front page, that investment banking is on course to extend a record streak of underperforming. Now, they looked at consensus data compiled by Bloomberg, where analysts forecast investment banking revenue to fall almost 10% to $7.5 billion. It continues to be the bank's traders holding up the results. Finally, on the New York Times, former President Joe Biden has been breaking his silence on his clemency decisions. In an interview with the Times, Biden said that he personally approved all of the pardons and communications. Now, that refutes Republican claims that he might not have been in control of the decisions. Biden said that he had directed his staff to use the auto pen because he, quote, had granted clemency to so many people. Now, elsewhere in D.C., it is so-called Crypto Week. Will we get more legislation that helps solidify the more mainstream use of crypto? The market seems to like that. Higher by 2.5% for Bitcoin. It goes record after record. We are above $122,000 this morning, leading some to say maybe crypto is a hedge as the rest of risk assets are weaker this morning. But can you trust that with it being dominated by news in D.C.? Also want to show you what JGBs are doing this morning. 20-year yields suffering, higher by 10 basis points, trading at the highest since 2000 as concerns over growing debt and potentially more spending from Japan, a story we've heard elsewhere in the world. Now, coming up, Sarah Bianchi of Evercore ISI will join us on the latest on trade and President Trump's criticism of Fed Chair Powell. All of that coming up next. Stay with your Bloomberg Brief.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like
years.
hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I
so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday. More letters. President Trump warns the EU and Mexico that they'll face a 30% tariff. The EU plans to step up trade deals with other nations. Laying the groundwork, a White House probe over Fed renovations fuels speculation that Trump may fire Chair Powell. And we get the view from corporate America. Wall Street braces for the weakest earnings season in 2 years. So you had about 30 hours to wait this weekend to see what the market reaction would be to another tariff letter bomb dropped over the weekend, this time EU and Mexico. Maybe in that context, this reaction is underwhelming, down about 1/3% for both the S&P and NASDAQ futures, but that comes off the back of record highs last week, not just for the S&P, but for European equities too. Bond markets, those continue to be under pressure. Last week, it was about better economic data and continued pressure on Fed Chair Jay Powell. It is the 10-year and the 30-year yield. It is duration that's coming under more pressure this morning, up a basis point and 2 basis points, respectively, but maybe that has to do with what's happening in Japan. You can see at the bottom of your screen fiscal concerns there. Are they going to be spending more? Higher by 10 basis points for the 20-year yield, for the highest since 2000. Those are your markets. Let's look at some of the individual stocks on the move pre-market. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start in the tech space. We're seeing Synopsys. Those shares rise just shy of 4%. That's after these China regulator has given them the green light for their acquisition of Ansys. Now, some are reading through this that it's the easing of those U.S. export restrictions on chips is actually leading to better coordination, better relations between the U.S. and China. So we're seeing Synopsys rise some 4% in pre-market trade. Let's move on to defense. We're also seeing some positive stocks in the green when it comes to defense. One of those is Boeing, up near 2%. They had an upgrade by the street, but there's also some speculation that this big Trump announcement later tonight could entail more defense spending, at least when it comes to Ukraine. Lastly, let's end in the consumer sector. We're seeing Kraft Heinz rise yet again this morning, up over 2%. This is after a Wall Street Journal report that the company is eyeing a breakup of some of its key businesses. Danny.
Valerie, thank you very much for those updates. Valerie Teitel. Now let's turn our focus back to our top story, tariffs and President Trump's latest ultimatums. He spoke to reporters on Sunday where talks with various nations stand.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
With the latest, let's bring in Bloomberg's Tyler Kendall in Washington. Tyler, more letters over the weekend. Where do we even stand at this point?
Yeah, hey, Danny, good morning. More letters. Now we're up to about 24 letters that the administration has sent to trading partners. Many of them have to do with the so-called reciprocal tariffs, but now we can add Canada and Mexico to the list as well. Of course, those negotiations had been on a totally separate track, but they are still now being tariffed and faced with that August 1st deadline to make a deal. Importantly, we did hear from the EU's chief trade negotiator earlier this morning, who did say that he will speak with his U.S. counterparts, as this 30% tariff letter from over the weekend really does dampen what was seen as relative progress for the trading bloc, which had moved up in line essentially to strike a deal with the United States after what had been previous frustration by this White House. Now, if you ask the administration, they would say that 30% is lower than the 50% tariff that the EU was facing. But of course, it is still a very high barrier. And you had the German Chancellor Merz over the weekend, for example, saying that 30% would hurt the German economy, the largest economy in the EU, to its core. Now, people familiar do tell Bloomberg News that EU negotiators are focusing in on those sector-specific tariffs, particularly when it comes to autos. These are those tariffs, as you well know, Danny, that were enacted under Section 232 on the basis of national security concerns. They weren't originally intended to be part of these negotiations, but they have made their way into the conversation in a really meaningful way for multiple trading partners beyond the EU. You also had President Trump mention there Japan. We know that autos for Japan is also a major sticking point.
Tyler, also over the weekend, the other development was more pressure, it would seem, on Fed Chair Powell. The NEC director, Kevin Hassett, spoke to ABC over the weekend on this point and whether the White House would explore firing Jay Powell. Here's what he had to say.
Yes or no answer. Does the president, in your view, have the authority to fire the Fed chair?
That's a thing that's being looked into, but certainly if there's cause.
Tyler, they're looking at it. What kind of pressure is the Fed chair under right now?
Right. I mean, an enormous pressure, Danny, and the administration really does appear to be coalescing around a different sort of argument here when it comes to applying that pressure. You've heard President Trump elevate this accusation that really started with his head of the Federal Housing Finance Agency, Bill Pulte, who is accusing Powell without evidence that he misled members of Congress when it came to his testimony about some recent renovations at the Federal Reserve. Now, we should say that Powell has maintained that those renovations were not extravagant, but you still have President Trump saying that if true, that could lead to his firing. And other administration officials, including the OMB director Russ Vought, as well as NEC director Kevin Hassett there, have also started adding to this criticism. Now, Bloomberg News did pull some of the Fed budget documents, which does show that cost estimates for the project did rise to $2.5 billion this year, compared with $1.9 billion that was originally projected in 2023. But the Fed has said that they have been in compliance and that they will comply with the information that the administration is seeking moving forward here. Danny, it really is just the latest argument that we're hearing beyond that they want the Fed to cut rates. Another one I'll put on your radar, of course, is that the administration has really also coalesced around this idea that higher interest rates are hurting the costs that the U.S. government has to pay when it comes to servicing its debt.
Tyler, thank you very much for that. That is Bloomberg's Tyler Kendall. Now, Sarah Bianchi, Evercore ISI Senior Managing Director and Chief Strategist of International Political Affairs and Public Policy, does see that trade risk growing. She writes, quote, "Our top-line view remains that markets should not dismiss Trump's latest statements and that the next actual moves on tariffs are likely to be up." I'm pleased to say that Sarah joins us now. She also served as a deputy U.S. trade representative from 2021 to 24. Sarah, great to see you this morning. So as we sort through the letters and threats, how do you view as to what actually sticks and what gets lessened?
Well, certainly a lot of this is not going to stick. I think the administration is frustrated with the pace of the deals. As you all have mentioned, I think the sectoral tariffs, autos, other things are proving to be a real sticking point for a lot of these countries. And these deals aren't getting across the finish line. I think for those of us who've done trade negotiations and know how difficult they can be, this doesn't come as a huge surprise. But even we're hearing some of the deals that have been inked, like Vietnam, may not really have true alignment. So I think there's frustration. But our point is, even if some of these ones come off, if the EU, Canada, all these ones get resolved. Still, we're seeing a higher a direction. The Vietnam tariff coming in at 20, the copper tariffs from last week, we assume others. And so we're already at 15% weighted average. And again, we think the next arrow points up.
But what even serves as a circuit breaker, Sarah, at this point to lessen some of those tariff levels? If it's a market that continues to reach new high, and it is various nations who don't seem to be trying to enforce any types of retaliation.
I think there is a challenge. You know, we wrote back earlier this year about how what was the Trump put? What was the point where the market reaction was too much for this White House? Obviously not the only thing driving them, but certainly relevant. Now I'm almost wondering if there's a Trump call, if he's going to keep escalating because the markets are not responding really. And I guess they don't believe he's going to put all these into place. Now, nor do we. But again, these are really elevated tariff rates, nothing our country has seen. And so that's really the challenge. I assume the administration will try to get some resolution in the next few weeks on with some of these countries. But again, there's really challenging political sticking points. They're not as easy as you think.
Well, on that point, Sarah, we even heard literally hours after Trump announced the letter going to the EU that there was according to sources speaking to various outlets, that EU officials viewed this as just a negotiating tactic, the 30% from August 1st. If everyone, including markets, including trading partners, thinks that Trump is bluffing, just how many concessions are they willing to give this administration?
It's a real challenge, you know. It is a real challenge. I do think these countries are negotiating in good faith. There's no question it is better to get all of this resolved if you can. But at the same time, when it comes to sticky things, again, like Japan and autos, they're not going to give just because of this bluster. They have real political considerations at home, and they can't just move on all of this. And right now we're seeing the administration being particularly tough on these sectoral negotiations. And I think that is what is gumming up some of these deals.
In an overall view, Sarah, what Trump campaigned on was something that looked like 10% tariffs for everybody and then something higher for adversaries like China. Instead, we've seen some of the various trading partners have similar levels of tariffs to China, where it seems that more negotiations are happening with the Chinese. How much of a shift does this represent? And to what end? What do you see as the purpose of playing hardball with these countries, with blocs like the EU?
You're right. This is far more than he did talk about in the campaign. This administration has been very, very aggressive coming out of the gate. I think they came out, the problem for them is they came out too aggressive and then they pivoted back. And now everyone is confused and it's a little bit hard to say where the bottom line is. I think most people who look at this think that perhaps a fight like this with the EU is a distraction from some of the real concerns about China. But this president solves for a lot on trade. He worries about the trade deficit. He worries about fairness. So he's willing to play ball, and especially when he's not seeing at this point the impact from the economy and the impact on the markets. Remember, this is a president who's coming off some pretty big wins on foreign policy and legislation, so he thinks he's got some room here to gamble a bit.
Does that mean, Sarah, that the logical conclusion of this is just tariffs lessened once you start to actually see economic impact? You start to see the white of the eyes of what eventually may happen from higher tariff levels?
It's interesting. Right now, we aren't seeing some of the impacts in the economy, and even some of the impacts in terms of tariff revenue is not matching the rate. So there's definitely some stuff going on with the data that people are watching. But I think it's premature to conclude that going from a 2.5% tariff rate weighted average to 15 or higher is not going to have some economic impact. I do think the administration would like to ink some of these deals before some of that data comes through. But they're having trouble. Even the ones that were supposed to be easier have become much more complicated.
To that point, Sarah, again, you as someone who's been very experienced with working on various trade deals, August 1st, a new deadline for a lot of these countries. What is your expectations on whether more deals can be inked or whether we see more can kicking as we head into the next month?
Oh, I think we're going to see both. Look, they've got to get somebody over the finish line here, or this is, becoming a little bit, we're just kind of playing the same game. So I assume in the month of July, they will get somebody over the finish line. Again, these are really still pretty high level, even the deals we're talking about. Even the UK deal, it's not really what we call a trade deal. It's a framework. But I do think they're going to have to do more can kicking. Again, you look at some of these countries. Japan has a really important election coming up. They can't really move before that. South Korea, very well-intentioned, but a very, very new government there. So, and India, even though that one was supposed to be going better, again, you can get stuck on, really technical ag issues. Trade is very granular, very technical, and there's sticking points between these countries that have persisted for years because there's real political and economic forces behind them.
Sarah, this was so fantastic. Thank you so much for getting up early and joining us. Please come join again soon. That's Sarah Bianchi of Evercore ISI. Coming up, earnings season kicks off this week. We're going to preview the big banks and the others reporting tomorrow. And your week ahead, that's coming up next. Your Bloomberg Brief.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Tesla CEO Elon Musk has suggested in a new post on X that the EV maker's shareholders will be polled on whether to invest in xAI. This is after reporting that SpaceX might make an investment in xAI. Bloomberg Tech Europe anchor Tom McKenzie joins us now. Tom, what is this all about?
Yeah, Danny, as you say, Elon Musk getting onto X, the platform, and saying And responding to a post saying, look, we could put this to shareholders, to a poll for shareholders at Tesla as to whether or not they want to invest in xAI, which of course is the company behind the chatbot Grok. He said that he's made it pretty clear as well in the past he would like that to happen, but he says it's not up to him, it's up to the board, it's up to shareholders, and that they are looking to put that poll to them. So we'll see if indeed that comes through and what it would mean. As you say, on the back of reporting from Wall Street Journal that SpaceX, another, of course, of Elon Musk's companies, could be looking to put $2 billion into xAI. We know that xAI is raising and looking to raise money at a pretty rapid clip as they put out new models and new chatbots with a valuation potentially, according to Bloomberg reporting, of around $200 billion. But it's a reminder of just how interconnected these parts of the businesses overseen by Elon Musk are now gradually becoming.
It wasn't that long ago, Tom, that it was Musk who was threatening to leave just for his AI startup if there weren't various pay packages enact. Just how closely is xAI connected to the other companies? How important is it for shareholders that there is some sort of integration, that this isn't a Musk who, already distracted, is whisked away by xAI?
Yeah, and I'm thinking of the note that Dan Ives of Wedbush put out last week, of course, saying that the board and the team, the shareholders, key shareholders at Tesla, should put in place a new incentive package to make sure that Musk is focused on the business and autonomy and robo-taxis and xAI and less focused on politics and setting up that new US political party, of course. In terms of how enmeshed these companies are already, we'll see if SpaceX invests in xAI. You had xAI, of course, that was set up, then merged with X, the social media platform. That has happened. That's now a holding company. You have xAI is a customer of Tesla, so buying their utility storage companies, that's a linkage there. And you do have investors and analysts saying that it would be a good idea if Tesla did get closer, did invest in xAI, particularly along the autonomous push. You have the likes of Gene Munster, for example, saying if Tesla truly wants to be autonomous, then this really makes sense in terms of getting closer ties, closer financial links between xAI and Tesla. Musk has already said that xAI will be used and the Grok chatbot will be used in Tesla vehicles going forward. And you're right. Many investors, given the plummeting sales of Tesla, particularly here in Europe, countries like Germany and France, they want to see that connectivity between xAI with the AI capabilities then embedded in future Tesla cars.
Tom, thank you so much for that. That is Bloomberg Tech Europe anchor Tom McKenzie. Elsewhere, U.S. equities have swung back up from April lows to fresh highs. Now the market optimism faces a new test. Corporate America will be releasing second quarter earnings. It unofficially kicks off with Wall Street banks reporting tomorrow. For more, Bloomberg senior strategist for equities, Neil Campling, joins us now. Neil, it is a market that's continued to go higher, but you have had some of the big bank CEOs like Jamie Dimon warn of complacency. What's the view from corporate America, from the banking sector, likely to be this week?
I think the main thing for the banking sector this week will be a combination of fairly solid earnings, given that you have net interest income should be positive for the big banks, and also the trading volumes as well, given the volatility that we've had in the equity markets during the quarter. Offsetting some of that, obviously, the investment banking revenues for many expected to be lower. So the Bank of America CEO came out recently and cautioned on that, given some of the uncertainty in the markets. I think one of the most important things, Danny, is going to be key to hear from the CEOs in terms of their outlook, what they're hearing from clients, and just the general trend in terms of what the backdrop is for the economy going forward. So there'll be a barometer, I think, of test in terms of the message from the companies will be as important as the earnings itself.
Even though there are so many unknowns, Neil, just how much of a tailwind are some of these corporates going to get by the fact you have seen the dollar weaken in reaction to the policy coming out of Washington, D.C.?
Yeah, absolutely. I think the dollar weakness, which has been in focus this year, should certainly provide a decent tailwind for many of the international and big corporations of America, which is something that's a reverse that we've seen in recent years. So certainly that should be a benefit. As we get into earnings, clearly there'll be some impact from tariffs that we didn't have in Q1 earnings season. However, we're still in that kind of wait-and-see approach for many of the corporations to know exactly what the impacts will be from a variety of the tariffs that are still uncertain at this stage. So I do wonder whether we'll get a continuation of what we had after Q1, which was basically that companies were effectively sort of deferring on what the impacts will be, because there is that uncertainty. But against that, you also have some pretty low expectations for actual profit growth for this quarter. I think from the Bloomberg intelligence data, less than 3% of earnings growth is expected for Q2, the lowest number since Q2 of 2023.
A low bar. We'll see if they can beat it. Neil, thank you very much for joining us. Bloomberg's Neil Campling. Coming up, we're going to set you up for your big week ahead, including those earnings and a whole lot of data. You're watching Bloomberg Brief.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading week. Crypto Week kicks off in Washington, D.C. today. That has fueled a new record high in the price of Bitcoin, trading over $122,000. President Trump is also set to deliver a major statement on Russia today as the U.S. boosts its support for Ukraine. And then it is a big week with the big bank earnings. Those begin on Tuesday. J.P. Morgan, Citi, and Wells will all report tomorrow. We're also going to get a fresh read tomorrow on inflation. That comes with U.S. CPI data and more earnings throughout the week. Okay, some individual movers to focus on. We are looking at Tesla shares. Those are under a microscope. Elon Musk suggesting that a shareholder vote on investing in XAI is in the works. Those shares up 1%, 2% for Kraft Heinz. A report from the Journal on plans for a breakup. Finally, Synopsys, those shares rising 3.7%. It has won approval from China for its $35 billion takeover of Ansys. All right, that's it for your Bloomberg Brief Surveillance. We'll take the reins from here. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view of Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Investors are saying that everything is awesome and there's not a lot of risk.
We have a stronger stock market at this point, so that does embolden the president to go forward and be more aggressive now.
There will be very big differences if the tariffs come out at the higher level.
What the market is telling you is that, yes, we're expecting volatility.
We could spend a lot of time thinking about the noise, the volatilities out there. It hasn't paid off to just say, I'm going to stay off the markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, full court press.
I think if Jerome Powell stepped down, it would be a great thing. I don't know that he's going to, but he should. Jerome Powell's been very bad for our country.
The Fed has a lot to answer for.
What we need is regime change at the Fed. It's about breaking some heads, because the way they've been doing business is not working.
Fed Chair Jay Powell facing pressure from all sides in Washington, D.C. As President Donald Trump ramps up the rhetoric on trade partners, equity markets are facing down a week, absolutely full with event risk. Bank earnings and CPI are just around the corner.
Yeah, it's often we come to the week and say this is going to be a big week. This one truly will be pivotal because we'll understand how tariffs are getting trickled out, whether it's with consumer prices, with CPI, or whether it's a hit to corporate earnings from some of the earnings that we get across the board. And that's not even including the increasingly heated discussion around tariffs, what the tariff rate is at a time where Jay Powell said that he had to hold off until he had some certainty around just what the level of those levies would be.
This week is a big week. This weekend was a big weekend. Equity futures are down just 0.25% on the S&P 500. Bond yields are higher by about a basis point.
And it's a big weekend considering the president came out when it comes to the European Union and Mexico saying there's going to be a 30% tariff rate. I look at what Kevin Hassett said, though, over the weekend, the NEC director. He says, well, these tariffs are real if the president doesn't get a deal that he thinks is good enough. But, conversations are ongoing. It feels like the president, 2.5 weeks out from August 1st, is still right now in negotiating mode.
Pressure up on trading partners, pressure up on Chairman Powell. What is the price of firing Chairman Powell? George Saravelis of Deutsche Bank with this to say. What is the cost if you were to force Powell out of his job? The next 24 hours would probably see a drop of at least 3 to 4% in a trade-weighted dollar, and for bond yields, a move of 30 to 40 basis points in a fixed income sell-off.
So it goes to really the implication that you had. We had all of these fireworks over the weekend, whether it's around finding backdoor ways to fire Jay Powell, or whether it's the increased rate that was given to the European Union and to Mexico. Why are stocks not responding? Why are we not seeing yields in the United States creeping higher than they are just globally with a global bond yield sell-off? These are some of the big questions that I have. Why are people so sanguine at a time of such heated rhetoric?
Markets are looking through the threats. Now, is it justified based on experience, or is it complacency going into a big week ahead?
Well, Trump feels encouraged, and he said this to NBC News on Thursday. He said they think the tariffs have been well received. The stock market hit an all-time high today. So basically, he's looking at the market and he's saying they're not pushing back. We saw him reverse course when the markets pushed back. They haven't yet, so he feels almost emboldened. And when it comes to Jay Powell, they're going after what the Fed is doing in terms of refurbishments, and they're calling it Versailles. This has been going on for a number of weeks now. But I think the real issue this administration has right now is that when you repeatedly hear from Jay Powell about whether or not he'll stay on after his chairmanship is ended through 2028, he doesn't give an answer, and I think that bothers them.
Lots of drama over the weekend. No drama whatsoever this morning. Equity futures down by about 0.25% on the S&P 500. Coming up this hour, we'll catch up with Peter Chair of Economy as President Trump escalates tariff threats. We'll speak to the former senior White House trade advisor Kellyanne Shaw on the EU's response, and Leo Feller of Numerator as investors await key inflation data. We begin this hour with our top story. President Trump threatening 30% tariffs on the EU and Mexico. Our team coverage starts right now with Bloomberg's Brendan Murray from London, Tyler Kendall in Washington, D.C. Tyler Kendall, what is the latest on the trade front?
Yeah, hey, John, good morning. Well, two fresh tariff threats over the weekend, as you were discussing, 30% now from Mexico and the European Union. When it does come to the EU, we heard from their chief trade negotiator earlier on this morning, who did confirm he has plans to speak with U.S. officials to keep the negotiations going, because ultimately this does seem to put a damper on what was seen as relative progress for the EU, considering they had moved up in line, was our understanding, after previous frustration from the White House. Now, if you ask the administration, 30% is lower than the 50% tariff threat that they were facing. But of course, it is still a very high number. And we heard from the German chancellor over the weekend, for example, who said that if a 30% tariff was enacted, Germany's economy, the largest economy in the European Union, would be hit to its core. That raises questions here about what sort of concessions could be on the table and what are those sticking points. Of course, we know that EU negotiators seem to be zeroing in on those sector-specific tariffs, particularly when it comes to autos. And we know that the U.S. has raised concerns about market access for U.S. agricultural goods. John, there is, of course, a range of issues here, particularly when it comes to the EU, but I'm going to put another quick one, another aspect to watch out for on your radar, which is how the administration often talks about defense spending coming into these discussions. We heard from President Trump yesterday saying that the U.S. is preparing to send a Patriot missile battery, perhaps multiple. He said they haven't decided on a number, to Ukraine. We could get that announcement later today. But when asked who is going to pay for it, his answer was Europe.
Europe in focus, Brendan Murray. Let's sit on Europe. The response so far, cool, calm, collected, and the prospect of coordination between the European Union and other countries. What are we learning about that this morning?
Yeah, essentially, up until now, you had two options in dealing with the Trump administration. You could negotiate, and you were going to have to basically accept a deal that was unfair to you, a baseline 10% tariff or something higher, or you could retaliate. And we've seen no country really come back and retaliate. But this third option seems to be coming more and more into focus, and that is, what if we band together and we coordinate a response against the U.S.? We can't win the fight one-on-one with Donald Trump. He's always going to have more leverage than we do, but perhaps some of these countries, Canada, the EU, some countries in Asia could come together and put pressure on collectively. Now, we don't know what the details of any sort of coordination would be at this stage, but it sounds like there's growing acceptance that this third path is really the only way to stand up to President Trump and all these high reciprocal tariffs. The European Union said today that would essentially cut off transatlantic trade, so that's a non-starter for them. And talks that were looking pretty optimistic just a week or two ago look to be heading in the other direction now.
Hey, Brendan, appreciate the update alongside Tyler Kendall in London and Washington, respectively. Brendan went through the three choices here: negotiate, retaliate, coordinate. That third choice is something we're exploring this morning.
The idea that maybe countries are going to get together, creating a framework outside of the United States. They cannot replace the United States consumer, but there is this feeling maybe there needs to be stronger coordination. I'll just say, there is a real question about what kind of consensus there is there and just how much is going to be the Europeans absorbing some of the excess supply that still keeps getting exported out of China.
And we saw that today with the China trade numbers. What I find so interesting, though, this is counter what some Republicans actually want to see this administration do. And we heard that from his former vice president, Mike Pence. It's collectively find a fair trading balance with your partners and then isolate China, not the rest of the world working together to isolate the United States.
If you are just tuning in, welcome to the program. I'm sure you heard all the threats over the weekend. Interested in how this market was going to open this Monday morning? Here it is. Equity futures down by about 1/3% on the S&P. Here's the view on Wall Street so far this morning. Peter Chia of Academy writing the following. While the market is right not to get too concerned at the moment, there is a risk that it's being very complacent. Pete joins us now for more. Pete, good morning.
Yeah, good morning.
That risk always exists. Let's talk about whether the base case right now is justified or complacent.
I think it's heading towards complacent. I think the administration seems very comfortable with tariffs. They're coming out talking about them. Let's not forget, Trump, he really liked tariffs, and I think this whole taco thing is overdone. I think he pivoted, right? It wasn't going well, stock market was coming down, he had other things to focus on. He pulled back. Now he's had a few big wins. I think the success that we had in Iran, very positive for him. Getting NATO to agree to 5% except for Spain, that was very positive for him. Getting the big, beautiful bill turned into an actual law was positive. I think he's going to take another cut at this, and the problem is, I think for markets, we're not going to get a quick reaction. We might not even get a reaction after August 1st, assuming the tariffs go in. Because last time the tariffs were actually in, I believe, for some number of hours before they pulled back. So I think this could drag on. I think it's going to be more of a slow bleed, unfortunately.
There's a larger question here. Is this just the market saying, look, we've been fooled before. What are you doing? We're not going to buy into these rates actually going through. Or is this a market saying, we've seen how companies absorb these tariffs, and it isn't going to be as big of a hit as many people initially thought?
I think it's the former. I think people are just like, we got fooled by this. We all got panicked. We all believed the Main Street versus Wall Street, the rhetoric that was coming out of the administration that they would go forward. I think when you start seeing this, one, it's too early to expect much of a hit onto Wall Street, right? Even at 10%, one, companies had a lot of ability to pre-order stuff. That helped take care of it. You've seen a lot of USMCA goods get compliant, approved as USMCA compliant. That's reduced effective tariffs. And you look at the tariff revenue, I think it's about $80 billion over the last 3 months. That's a drop in the bucket in terms of inflation or anything. So I think we will not start seeing the inflation effects or the impact on corporate earnings until a few more months down the road.
Which is the reason why we've been talking about how pivotal this week is. How much are you concerned about it being a head fake if we don't see the real ramifications from tariffs, either in consumer inflation or in bank earnings in particular?
I'm not as worried about the earnings. What I'm looking for a little bit is, what are people seeing globally? What's the global economy looking like? We talk so much about the domestic economy. What's it like? What's spending going on? And are any of the U.S. brands seeing a pullback in spending? That, to me, is one thing. We've seen it in tourism. Is it more widespread? Because that would be a bigger concern to me, that you're starting to see this kind of pulling away from the American brands, which would be very consistent now with what you're reporting this morning, that other countries are trying to figure out, okay, what trade deals can we do away from the U.S.?
So what do you like then in this moment? If you don't think the president is just in negotiating mode and potentially some of these rates can stay?
So I still like anything that's really involved around national security, national production, right? And I think last week we saw MP, with ticker symbol, got an investment from the Department of Defense. It was a little bit ad hoc that the Department of Defense had that money, but maybe we start seeing the sovereign wealth funds, that we talked about at the start of the administration, start turning into something where you start seeing investment where the U.S. public actually gets to take advantage of the growth. We have to have rare earths and critical minerals, and not just the commodities, the processed and refined versions of those. We need chips, we need pharma. All those things, I think, that's where I want to focus, because the president could juggle two things, right? Push hard on tariffs on the one side, domestic growth, and those things do take away jobs from China. They bring jobs to the U.S., so they fit a lot of agendas. A lot of it's deregulation, which, again, is right up the president's alley. So that, to me, is a positive. That last week in that investment by the Department of Defense is just the tip of the iceberg.
So you think the 50% tariffs on copper is good and it stays?
I don't know that it's good at all. Again, it's something we import a lot of, and we need to, and we're not going to be able to turn it back. But yeah, I think he stays. I think he tries to grow some domestic businesses around that. But it's going to come through investments, not going to come out through handouts or subsidies.
Quick final word on CPI tomorrow morning. We've had a string of softer than expected reads. Do we get a fifth tomorrow morning?
I don't think so. I think we've kind of bottomed out on it for a little while. I think there's been some pressure on, through some of what's been going on in the USMCA. I think people push some prices through. So I'm not alarmed, but I don't think we get a good number.
You're going to stick with us. Need some comments on Fed Chair Jay Powell and his future a little bit later in the program. Peter Schiff Academy there. Sticking with us through the next segment. If you are just joining us once again, equity futures, no drama here whatsoever. Only down by 1/3% on the S&P. Expecting some action in the bond market. You're getting it in Japan, not stateside. Yields higher here in New York City by just a basis point across the long end of the curve. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. President Trump declaring a 30% tariff rate for Mexico and the EU. The new rates are set to take effect on August 1st. EU Commission President Ursula von der Leyen has responded saying they are working towards an agreement but are prepared to use countermeasures, while Mexico's economy minister called the new levies unjust. Meanwhile, President Trump and his allies are ramping up pressure on Fed Chair Jay Powell. In addition to criticizing Powell for not cutting rates, they're now focusing on his handling of the renovation of Fed headquarters. The Fed says the renovations are designed to reduce costs by consolidating its operations, but critics are focusing on what they call extravagant design features. And NVIDIA CEO Jensen Huang says the U.S. government doesn't need to worry about the Chinese military using U.S. technology. Huang told CNN that China will avoid the technology because it may be limited by the U.S. at any time. Chinese military adoption is one of the key concerns Washington has raised as it ramps up restrictions on chip exports. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later in the hour. Up next on the program, a new line of attack on the Fed chair.
The bottom line is that this is the most expensive project in D.C. history, $2.5 billion with a $700 billion cost overrun. So the Fed has a lot to answer for.
We heard that on repeat over the weekend. Fed Chair Jay Powell's Fed very much in the crosshairs. That conversation up next, live from New York City this morning. Good morning.
The Bloomberg Brief is brought to you by Interactive Brokers. Invest globally in stocks, options, futures, currencies, bonds, funds, and more from one unified platform.
Wondering if the market will go up or down? The answer lies in the economy. In a bad economy, wages stagnate, spending drops, companies struggle, and the market takes a hit. In a good economy, wages rise, spending soars, companies thrive, and the market climbs. So, how can you predict what's next? Visit IBKR Forecast Trader, get up-to-date consensus insights, and trade your prediction on yes or no questions. The best-informed investors choose Interactive Brokers. Sign up today.
At Capital Group, we take care when crafting our active ETFs. Our portfolio managers and analysts collaborate to strike the right balance between strength, flexibility, and endurance. We believe this hands-on approach sets our active ETFs apart so they can make a difference at the core of a portfolio. Because we don't fit molds, we prefer to cast originals. Capital Group, actively different, active ETFs.
At Fisher Investments, we may look like other money managers, but we're different. How so? We're a fiduciary, obligated to act in our clients' best interests, so we don't sell any commission-based products.
Then how do you make money?
We have a simple management fee, structured so we do better when our clients do better.
The clients really come first then, huh?
Yes, we make them a top priority by getting to know their finances, family, health, lifestyle, and more.
Wow. Maybe we are different.
At Fisher Investments, we're clearly different.
Whether it's care before or after school, or a sitter for date night, you don't have to hire just anyone. You can find a background-checked caregiver who's the right fit for you. Join now for 20% off care.com.
Equity futures doing okay, down by 0.3% on the S&P 500. The upgrades, the price targets keep coming. Lori Cavacina of RBC now looking for 62.50. That's up from 57.30. Follows similar moves from Bank of America, from Goldman, HSBC, and Max Kender just last week. Two words: buy more. The Nasdaq's down by about 1/3 at the moment, even with the additional tariff threats and this. Under surveillance this morning, a new line of attack on the Fed chair.
I think if Jerome Powell stepped down, it would be a great thing. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
It's the latest this morning. President Donald Trump and his allies zeroing in on Fed Chair Jay Powell's handling of the renovations of the Federal Reserve's headquarters. Administration officials building a case to possibly fire him.
The bottom line is that this is the most expensive project in D.C. history, $2.5 billion with a $700 billion cost overrun. To put that in perspective, the cost overrun for this Federal Reserve project is about the same size as the second biggest building overhaul in American history, which was the FBI building. And so the Fed has a lot to answer for.
Peter Chair, the Fed has a lot to answer for. Where's this one going?
I have no idea. It does feel politically that he's going to be under a lot of pressure in the coming days, weeks. You know, and I do think he probably should have cut rates or be on the pace. We should be cutting in July, I think. I don't like the jobs data. So I don't agree with all his policy, but I think pushing him out and this pressure, markets aren't going to like it, the world's not going to like it. So I don't love that strategy.
What do you think the cost is? What's the price of firing the Fed chair? Not saying it will happen. If it happens, what is the cost? And is it so high that it prevents it from happening?
You know, unfortunately, I don't think it's going to be that high. Front-end yields probably go down, right, because whoever's going to come in is probably going to implement cutting. You see yields go higher maybe at the back end, but how much can you 2s, 10s go out? So I think it's actually going to be a muted reaction. I think there's a lot of fear that we're going to blow up the Treasury market. I just don't think that happens right away.
And part of the reason why is because people say there's a whole committee full of Fed members that all have a vote, and yet Kevin Warsh, who previously was on the Fed Board of Governors, came out and said we need regime change, we need an overhaul, and started talking about the strategic shift that he would like to see at the Federal Reserve. How realistic, how feasible is that?
You know, I've often wondered for the last decade why we don't have more behavioral economists on the Fed, right? We have the traditional macroeconomists, and yet when you look at the Nobel Prizes, they're going out to the behavioral. So I think a shake-up and kind of some different thinking wouldn't be a bad idea. Again, I'm not sure that it should be done in this kind of, very quick and rough way. But I think there are things. How do we think about the world? How do people respond? I think a lot of traditional macroeconomics has failed us, and we've kind of missed the GFC. We missed European debt crisis. So bringing some new types of thinking might not be a bad idea.
There are two things that you're sort of alluding to here. And one is the fundamental economic justification for both a rate cut and a rethink of some of the economic modeling on the Fed. The other is the political jawboning that leaves people concerned about a Turkey situation, Erdogan-like pressure, talking about what happened with Arthur Burns that led to the highest pace of inflation that we've seen in modern history in the United States. So how do you distinguish between the two, and does this kind of pressure make it less likely that they can cut in a way that might be appropriate economically?
So I would have said before this weekend, I felt they would be pressured not to cut because they didn't want to be bowing to this. But it does seem like this is a whole new line of attack. They're kind of going down different avenues to get that sort of change. And if that happens, then I think we do get cuts very quickly because whoever comes in will try and say, well, this has to be our mandate. It's probably the most confusing I've ever had because we've never, I think, had to figure out the political ramifications of the Fed in such a way.
Kevin Hassett was asked about this over the weekend. He says they're being looked into, whether or not if there's cause, he could be fired. But this would be about issues regarding renovations at the Fed. Does it matter to the markets what the potential issue is that they think they have a legal standing to fire the Fed chair?
I think it does make a difference. And I do think one thing, Powell was very successful independently before he joined the Fed. So I think he probably has a lot more stomach to fight this than someone who didn't have, his own personal wealth, isn't coming into this job very strong. I think he is very committed to what he's doing. So, I find he will not go down easily.
If he's not going to go down easily, then do you think he sticks around to finish out his governorship to 2028?
I think that's such a long way away in this environment right now. It's like we have trouble living week to week.
Right, but he won't tell Trump administration officials, he won't tell reporters. He's repeatedly asked about this and doesn't give an answer.
I think there's no reason for him to give an answer. Why make it easy on anyone? It's his kind of little bit of leverage. Maybe it's what makes him happy when he's fighting with this. So I feel it's all a bit of a sideshow to what we should be looking at, and that's not good.
The price of this. Now, you said it wouldn't be that high. George Saravello said it's 30 to 40 basis points in a fixed income sell-off in the following 24 hours. For the FX market, it could mean a 3 to 4% move in the trade-weighted dollar. Lisa brought up the experience in Turkey. If you go back to spring of 2021, when Erdogan fired as then central bank governor, I think the following day we had an 8% move on the Turkish lira. Are you not expecting anything like that in the following 24 hours?
I think it'll be hard. Like, you want to sell off. I think that I agree on the FX. I think it's going to push people away from the dollar. I think that makes sense to me. But why would T-bills sell off a lot, right? Clearly, you're going to get someone coming in, and I think that will anchor the curve a little bit. I think maybe you get this
initial... anchor the front end. Tell me what happens further out along the curve. I'm not interested in the front end. I want to know what happens to 10s and 30s.
Maybe it widens a little bit. I don't see a 30 to 40 bip. I would not be surprised to see markets actually remain more calm than all the hype, unfortunately. I think that gives the whole ammunition, but I think there's just so much more going on than the Fed share. Now, if we believe that someone's going to come in and cut 100 bips immediately and get us down to 2%, that's a different story. But I think if you think someone's going to cut 50 and try and get down 100 bips by September, do we really sell off that much? Like, that's kind of more in the ballpark what I think the Fed should be doing anyway, so I'm not going to react that negatively.
Are we setting, though, a precedent that becomes dangerous for the bond market going forward? And I say this not just from the U.S. perspective, but globally, at a time when you see all of the long bonds around the world in developed markets selling off in the prospect of more spending and politicians that don't want to have to raise taxes or cut spending in order to reduce the deficit. Isn't this a fundamental problem that increasingly politicians will just jawbone their central banks as opposed to actually taking the pain?
Yeah, and I think it's like a lot of things. We've had executive orders skyrocket over the last 20 years. Everything's kind of being done a little bit backdoor, maybe not quite by the official channels. So I think those are all risks. One thing I keep, we've been arguing to our customers probably for 3 years now. You're supposed to be, if you're investing in 1 year and in paper, heavily overweighted towards corporate debt, commercial paper, because corporations actually have good governance, right? Corporations that are there to make sure their bills are paid on time. So I would be overweight. I think you're getting that extra spread, and I think there's going to be more and more conversation about what should one of these top companies trade versus the U.S. dollar, or sorry, versus T-bills. I don't think we're
trade through.
I don't think we're there at this point, but I could see us approaching that. Right, it's happened in some third world or EM countries in the past for a variety of reasons. We're not there, but I think you're getting free spread almost when you look at some of these AA, AAA, even single A companies who are issuing commercial paper. I would own that all day long instead of T-bills. I think it's less hassle.
Peter, if you don't think there's going to be a massive implication to the markets if they fire Fed Chair Jay Powell, what's holding them back then from doing it?
I assume there's legalities in how to do it, whether they're allowed to do it, and I'm sure that's being worked on.
Pete, it's good to see you, as always. Thanks for dropping by. Peter Chair there of Academy on a big situation with the Federal Reserve, potentially, and the latest tariff threats. Just on the Federal Reserve, Pete kind of alluded to this. What's important here, of course, not just whether he's fired or not, who replaces him. If it would be someone super credible inside the FOMC, say a Governor Waller, for instance, maybe there would be a level of comfort there. Perhaps we should acknowledge. But I have to say, the base case, the overwhelming consensus view right now, if you get rid of the Fed chair, you'd see some fireworks in financial markets.
Especially given the fact that you have auditioning going on right now and people are trying to out-hawk each other with respect to how quickly they're going to fire Chair Powell and out-dove each other with how much they would cut rates and potentially replace other Fed members. I mean, I thought that was really notable. Kevin Warsh amping up his rhetoric maybe to get the front seat when it comes to replacing Jay Powell.
Well, the two Kevins first in line to replace him are the ones who were piling on the pressure over the weekend.
And it's as if one of them was trying to one-up the other one in terms of, he is making a Versailles, as we were just talking about, and the potential for replacing other Fed members, really raising the pressure significantly.
Certainly not the base case this morning, with futures down by about 1/3 of 1% on the S&P. Up next on the program, we'll catch up with the former senior White House trade advisor, Kellyanne Shaw, on President Trump's latest tariff threats. Plus, Yahira Anand with your morning movers. Kraft Heinz shares rising as the company weighs a breakup. That stock is up by 1.7%. From New York, you're watching Bloomberg TV.
When investing leads to questions, JP Morgan Wealth Management has powerful tools, research from expert analysts, and a single view of your banking and investing accounts right in the Chase mobile app. When you want to take control of your financial future, the answer is JP Morgan Wealth Management.
Hello, I'm Veronica.
My name is Darvin.
I'm Courtney.
I'm Jackie.
And we switched to Consumer Cellular.
My previous provider was terrible.
Surprise, we've changed your rate.
We wouldn't get to talk to a person.
And then all of a sudden it disconnects.
Now with Consumer Cellular, no problems.
Better customer service. They tell me exactly what I'm paying and why I'm paying for it.
It's within $1 of being half.
of my old bill.
With Verizon, I was paying about $150 a month. With Consumer Cellular, I'm paying about half that.
Okay, this is doable. This is affordable.
I'm getting the exact same coverage for half the price. That's a beautiful thing.
Done deal.
I got to keep my phone. I got to keep my number.
Switching over took about 20 minutes. That's it.
It's month to month, very simple.
It's been amazing. I was now a Consumer Cellular customer.
And I've been bragging to my friends about it, too.
Call 1-800-325-6449 to switch and save up to half with Consumer Cellular. Plus, new customers can save $25 when they switch today.
This is the one who never stops. She works around the clock and knows when it's all on the line. Having the right supplies makes all the difference. The industrial-grade products you need. Call, click Grainger.com, or stop by. Grainger, for the ones who get it done.
Right. Locked in for this meeting. Total focus. Double booked? All good. Otter AI gives meeting notes and insights, even on meetings I can't attend. Dang it. I picked the boring one.
Otter, the AI meeting agent.
Have a great trip.
Do you think they'll be okay?
Honey, nothing's gonna happen. And if it did, your parents would take care of the kids. Our money, our house, everything would go to them.
Doesn't count. It's a solid plan, but what you need is a will. Luckily, Trust and Will makes creating a will easy. It's an attorney-designed, official plan that states your wishes if you died, and it actually counts. Slugbug, get started at trustandwill.com and make it count.
When expectations are high, there's no room for uncertainty. To maximize impact, your logo needs to look great, on the right gear, and arrive on time. And that starts with 4Imprint. To get your brand noticed, visit 4Imprint.com.
4Imprint, for certain. You know what our kids don't want? Our spoon collection. Or my holiday decorations.
We spend a lifetime collecting things we love, but the best thing we can leave behind? Peace of mind. If you thought you couldn't afford life insurance, you can with Physicians Life Insurance Company. Plans start as low as $570 a month. Call or go online for your free info kit with all the details.
Who knew coverage was so affordable?
Thanks to Physicians Life, our final expenses can be squared away.
Getting coverage is simple. Guaranteed acceptance, no health questions, no medical exams.
Feels great knowing I'm leaving good memories, not unpaid bills.
Affordable protection for your loved ones when they need it most. In minutes, you can lock in up to $30,000 in coverage for life. We all want to leave behind things that matter, but sometimes leading security is the greatest gift of all. Call or visit physicianslife.com for your free info kit and final wishes planner. Physicians Life, simple, affordable coverage, because the last thing you leave should be a gift.
Physicians Mutual, Physicians Mutual.
Where did the weekend go? Trump time. Weekends just don't seem to happen, do they? Equity futures right now in the S&P, negative by 1/3%. We're down by a similar amount on the NASDAQ 100. Just missed out on a third week of gains on the S&P 500 last week. Going into a big one in the next 24 hours. CPI just around the corner and lots of bank earnings for you. With 3 hours until the opening bell, let's get you some morning movers with Yahara Anand. Hey, Yahara.
Good morning, John. We start with Kraft Heinz. Shares are up 1.7%, adding to Friday's gains after reports surfaced that the food giant is preparing to break itself up. The packaged food company is said to be weighing a spinoff of its grocery business in order for it to focus on other faster growing areas like its sauces. We've talked a lot about deals or possible deals in the packaged food space lately. We had Ferrero buying WK Kellanova last week, so this is the next big one to watch. Meanwhile, we take a look at crypto-linked stocks, all rising, riding Bitcoin's latest move higher. MicroStrategy and Coinbase are among the stocks getting a bid here as Bitcoin soars to record highs, breaching $122,000 this morning. This is coming as the U.S. House of Representatives gears up for what it's calling Crypto Week, where it plans to take on legislation in crypto. And last up, we end on the automakers. They are all weaker this morning on fresh tariff uncertainty by President Trump. But I want to highlight General Motors, which is down 1.6%. It confirmed a Reuters report that it's pausing production for weeks at one of its key plants in Mexico that sells its top-selling Silverado and Sierra trucks. And while it's normal for automakers to halt work at factories due to maintenance, Reuters does point out that weeks of downtime at a key plant like this one is unusual. John?
Yahira, thank you. A little bit more from Yahira later on this hour, in about 15 minutes or so. On our radar this morning, our top story, President Donald Trump announcing a 30% tariff on goods from the EU and Mexico, set to take effect on August 1st. Trump then saying if the countries retaliate with higher tariffs, he'll add another 30%.
And this should come as a shock to people, given the fact that he had talked about potentially getting a deal done with the European Union. There had been much better mood music around Mexico. It raises a question, is this just trying to ramp up some of the pressure to get a better deal? Is this the actual rate? And when will the market wake up to this? Or has it already, given the fact that you haven't seen the ramifications and profit margin contraction yet, or necessarily in the CPI prints?
The NEC director, Kevin Hassett, basically signaled that at this moment they are negotiating. Even in the president's own letter, he said, if you open up your markets, we will then amend the tariff rate. With the European Union, my head is spinning. 20% April 2nd, ratchet up to 50%. Now we're back to 30%. In the middle of them having negotiations, what they say every single day. What I think is more interesting about this story right now coming out of Brussels is the other capitals they're calling to try to get other trading partners in line with them to then go to the White House, Japan, Canada, others in Southeast Asia, to say we should approach Washington together as a collective group.
I want to live in Ed Bastian's world over at Delta Airlines, where things are stable and everyone has clarity to invest in the future. That's a very interesting world he's living in.
Well, you should go to the C-suite because they cannot survive on headline roulette. And that's what you're seeing. A lot of them are just taking a pretty steady look. Consumers are still spending. And you know what the truth is? We're all a little exhausted from headline roulette. And so a lot of consumers are saying, we got to look past it and live our lives. Let's go on vacation. The kids are off school. So, you know, we'll deal with all this stuff later. And I do think there is an element of exhaustion. What was it that you said a couple weeks ago? Is this the strategy? Just exhaust your trading partners until they're like, whatever, you want that?
I'll take the 10, 15%. Let's move on. I think it was Kellyanne Shaw last week who said, grab a beer. Ignore the next 2 weeks.
Amen.
She's going to join us in about 5 minutes' time. Hopefully hasn't been drinking beers this morning. We'll come back to that in a moment. President Trump ramping up criticism of Fed Chair Jay Powell, saying he hopes Powell should quit his role. Trump is joined by the NEC director, Kevin Hassett, and the former Fed governor, Kevin Walsh, in calling for change. It was the two Kevins. It was the vice president of the United States. It came from all corners over the weekend.
In this Alice in Wonderland land, a lot of people are wondering what the political implications of this are. Is it just the Kevins auditioning? Is this Trump trying to set up a fantastic scapegoat? Is this trying to pressure the Fed to cut rates more significantly? Or is this a serious look by the administration to truly oust the head of the Fed at a time when they have been highly critical of the unwillingness to cut rates? Look, I don't know that the market is really taking this as reality. Because right now, I agree with you, John, and I agree with George Saravelos. It does seem like there would be a much more significant reaction in the dollar and in the long end of the yield curve, akin to what we saw last year.
Well, what's the reaction, even if they put someone in place, if the market doesn't seem credible? And Jonathan, you've been asking this question every single day. Neil Dutta over the weekend said, for all the talk of shadow Fed chair, if either Hassett or Walsh get the nod at the rate they are going, they may well end up being a, quote, chairman in name only. So basically, not sure of all of this public auditioning to the extreme is potentially going to help them if they were to get jobs.
Given the threats over the weekend, not seeing much price action whatsoever stateside, yields are higher by a basis point or two. If you want to see a big move in the bond market, check out Japan overnight. Global debt markets very much on alert given developments in the Japanese debt market. Yields higher across the curve there, on the 30-year up by some 11 basis points. Going into this election in the next few weeks, the real risk of more spending and higher bond yields.
Look, this is the uncomfortable truth, and it's happening around the globe. It is that politicians do not want to cut spending, and they do not want to increase taxes. And right now, the political party that is winning in Japan is one that is promising more spending, while not necessarily increasing taxes, in fact, by cutting taxes. And this is really a question that is increasingly relevant given that President Trump is pushing a lot of the trade partners to increase spending on defense, to increase infrastructure spending of their own. So all of a sudden they have to borrow more. And nobody wants to say, we're going to take something away from you. And that is what the bond market is getting nervous about.
The fact is, coming out of Japan makes everyone that more nervous. We've had 25 years of this being a dominant anchor around the neck of the global debt market, holding yields lower. That's being released in a way we haven't seen for a long time.
So does this set the bar a lot higher? It's notable that U.S. long yields are not rising that much. They're not rising nearly as much as what you're seeing in Germany with a similar type of dynamic. It just goes to underscore a bond market getting yippy is not just a U.S. issue. And whether it continues with yields permanently at a higher pace, as
collectively, the market is dealing with a lot of debt from developed markets and really not a plan to pay it back.
No yips in the Treasury market, at least so far this morning. Let's turn back to trade. The EU stepping up engagement with countries hit by US tariffs following President Donald Trump's announcement of 30% levy set to begin on August 1st. The former senior White House trade advisor Kellyanne Shaw writing, the president believes he still has a long leash when it comes to tariffs. For countries that don't have deals by August 1st, I do expect tariffs to go up. Kellyanne joins us now for more. Kellyanne, welcome back to the program. I think you told us all to get a beer and take a break last time, and then everyone gets fired up after the announcements over the weekend. How seriously are you taking some of the threats this past weekend?
Yeah, good morning. And I think I have the same advice today that I had last week, in that, this is not for us. This is not for business. These tactics are really for other governments. And I think that Director Hassett said it well on Sunday when he said the president was trying to squeeze every last drop out of some of these deals. So that to me is really what these letters are about. I'm still relatively optimistic we'll land somewhere with the European Union. The Mexico letter was a bit of a surprise to me, given that they weren't negotiating one of these full reciprocal deals. It was really about steel and aluminum. But that said, we've got 2.5 weeks to go, and I expect to see a bunch of deals. And for those countries that don't have them, I expect to see those tariff rates go up.
When you say you do think this is the president trying to squeeze every last ounce out of these trade negotiations, say it comes to the European Union, what is he after?
Well, with the European Union, there are a number of sticking points. And I think everyone's expectation is that if the U.S. and EU were going to be in a position to agree, that it would be to basically a subset of issues and not every irritant. But I had been hearing some consternation about agriculture in particular, and some frustration on the U.S. side that the EU wasn't willing to cut some of the more sensitive tariff rates. And then a lot of disagreement over those Section 232 carve-outs and what those might look like on auto, steel, pharma, semiconductors. And then, of course, the president has long talked about Europe's treatment of U.S. tech firms, and from state aid to the DMA and DSA. And so those are going to continue to be difficult points between the U.S. and the European Union.
The European Union, we have this story, is preparing to step up engagement with other countries, potentially approach the United States with other allies. Do you think that tactic could work with this administration?
I mean, I think it is a unique administration who negotiates in ways that are not typical in terms of diplomatic relations. So why not? Why not come to the United States as a bloc and say, here is a potential solution and a potential way forward? Because what is clear from President Trump's tactic in terms of taking the sledgehammer to the global trading system and negotiating bilaterally with every government on earth is that the current global trading system, the World Trade Organization that has 166 member countries, just doesn't work. And so if there are a subset of countries who want to join together and approach the United States, I think the administration could be open to that.
Kellyanne, you said a key word there, tactic. And this is what the market is viewing all of this as, at least in terms of the muted reaction that we're seeing this morning, a tactic to negotiate a better deal. Is this negotiating with the trade partners, or is this negotiating with the market?
I think it's predominantly negotiating with the trading partners, but I do think that the market is playing a role. And right now, the fact that the market hasn't reacted as significantly as it did in the aftermath of April 2nd, coupled with low inflation, positive job reports, and overall good economic indicators, I think does embolden the president and gives him a longer leash on his tariff strategy. Now, if the markets were to totally go the other way, I do think that that might have a bit of a mitigating impact on some of these tariffs. But I think the market is reading the situation exactly right, which is the president is sending these letters out, announcing these high tariff rates in the hopes of actually getting deals so that he won't have to impose those tariffs.
So, Kellyanne, that's where I think there is some confusion. What is the tariff strategy? Is it to get deals that are specific and have certain parameters, or is it just to see how far someone can push before you get revenues on the tariff side and markets don't freak out?
Yeah, I think it can be a little bit of both. I mean, certainly the pressing task right now is to create this action-forcing event that by August 1st, these tariff rates will be exceptionally high unless countries are able to get a deal. I think that's really first and foremost on the president's mind. But the second line of messaging that we're hearing is about this revenue and the fact that the tariffs have been good for the U.S. economy, that prices haven't gone up, and we're going to use it to pay for some of these tax cuts. I think that's about softening the message on tariffs tariffs so that for countries that don't get deals, it's not viewed as catastrophic, the sky is falling, that there might be some positive benefit there. But I do think at the end of the day, it would be best case scenario for everyone involved to find some sort of landing zone in terms of these bilateral negotiations with countries and to see a bunch of deals get inked and see those tariff and non-tariff barriers come down.
Kellyanne, appreciate the update, the catch-up. Thank you. The former senior White House trade advisor, Kellyanne Shaw, there on the latest. Just to build on what Kellyanne was saying, it's not just the market giving them the green light at the moment. So far, and I stress so far, things can change, but it's the economy as well. The economy hasn't changed too much in the past few months.
Which is the reason why this is a pivotal week. We get the latest read, and people say that in the June CPI and PPI, we'll have a better sense of just how much those tariffs did cause prices to go up. And you've got earnings, so you can see how much that hit corporate profits. Right now, they might have a green light. Going forward, I think the key question is people might agree with the ultimate goal, but the strategy that's being used leaves people trying to understand what the framework is because it keeps shifting.
That last point, though, from Kellyanne Shaw really shows the branding of this administration. If they get a deal, great. They can have a Rose Garden or Oval Office event like they had with the United Kingdom, and I was there for that one. If they don't, then they come out and say, well, look at all the revenue we're bringing in, and this is going to help bring down our deficit and offset the tax and spending bill that we just got through Congress.
And there's a lot of revenue coming in. Let's be clear about that. In the bond market at the moment, yields are a little bit higher at the long end of the curve by a basis point or two. In the equity market, down by only 1/3% on the S&P. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump says the U.S. will send more Patriot air defense batteries to Ukraine. Kyiv has said it needs the aid to protect itself from Russian airstrikes. The move comes before Trump is expected to make what he's calling a major statement on Russia later today. Meanwhile, former President Joe Biden is pushing back on President Trump's claims about his mental acuity while he was in office. In an interview with the New York Times, Biden said he made all the clemency decisions that were recorded with an auto pen and that he orally granted all pardons and commutations issued at the end of his term. Now on to the latest on the flood disaster in Texas. The search for victims is expected to resume today along the Guadalupe River after recovery efforts had to be put on hold yesterday after another round of heavy rains. More than 160 people may still be missing after the July 4th floods that left at least 132 people dead. That's your Bloomberg brief. John?
Tragic. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, bracing for tariff impact.
The president is getting the message loud and clear. The economy can absorb a lot of these high tariff levels without a huge downturn, and I think that means he's going to keep going.
Joining us next, Leo Feller of Numerator, live from New York City. This is Bloomberg.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs
are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years, and how long a period both is this uncertain environment and how long are the tariffs going to last? Now, the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
A lot of threats over the weekend on 2 fronts, trade and central bank independence, and this market doesn't blink. Equity futures on the S&P down by 1/3%, on the Nasdaq 100 down by a similar amount. Under surveillance this morning, we're bracing for tariff impact.
The president is getting the message loud and clear. The economy can absorb a lot of these high tariff levels without a huge downturn, and I think that means he's going to keep going. They're working in that the president can put them in place without any negative consequences, and the economy is doing great. This is a rebalancing of stuff that was broken in the U.S. economy for decades.
So here's the latest this morning. Investors are waiting inflation data for a read on how tariffs are impacting the economy. Leo Feller of Numerator, a research firm focused on the consumer, writes the following. We still don't expect to see much of an effect of tariffs in the CPI. This doesn't mean that we're in the all clear. Leo joins us now for more. Leo, good morning.
Thanks so much for having me.
We've had 4 softer than expected prints, 4 in a row, a nice string, a nice run of things. And a lot of people came on the program and said, this is not signal, this is noise. Wait until the summer. Summer's arrived. Does it change?
I think it will start changing, but very, very, very slowly, right? One of the things that we saw coming out of the pandemic inflation starting in 2021 is that it took about 14 to 16 months for inflation to peak between when consumers went out and started spending all their pent-up savings, after we had the mass vaccinations, until we got peak inflation. 14 to 16 months is a long time, right? We're only about 3.5 months out of the initial tariff announcements that were then paused, right? It's still too early for us to really to start to see a wave of inflation. We might start to see a small trickle of inflation showing up in the data.
If that's the appropriate time frame to think about things, just describe through an industry, a sector, how this could cascade through the economy in the next 18 months.
Yeah, so one of the reasons that we haven't seen the tariff impact yet is that a lot of manufacturers have contracts with their suppliers, right? So their suppliers can't pass on higher aluminum prices quite yet, right? They're locked in, or they have hedges that protect them from these higher input costs, right? Then a lot of the suppliers have contracts, or manufacturers have contracts with retailers that prevent them from passing on prices to retailers. Once these contracts start resetting, right, which takes about 6 months, then we should start seeing higher inflation prints in the CPI. And the last thing to keep in mind is that one of the CEOs that I spoke with said we have one bite at the apple, right? We can't walk into a retailer and say we are increasing prices, right, by 10% or 20%, and then a few weeks later say, oh, never mind, right? Tariffs aren't as high as we thought they were going to be. We're going to, raise it by something else. Oh, never mind, they're now actually much higher. We're going to raise it by something else, right? And so it takes time for all of this to first develop more certainty, right? And then for suppliers, manufacturers, and retailers to start reacting and passing on these prices to consumers.
The chain of events that you're describing is incredibly important to hear because there are some people saying you're either going to see it in CPI or you're going to see it in consumer and in company earnings. You're going to see it in profit margins getting compressed. What you're pointing to is something else. There is a lot of other venues that are offloading some of the tariffs for now, but that potentially will not be there going forward. Can you talk about what % of the tariffs are getting offloaded by just contracts that are forcing it onto suppliers that aren't going to take it once those contracts are up?
Yeah, I think it's most of the tariffs right now are actually being absorbed by suppliers, right, and not being passed on because they're simply locked into contracts that don't allow that to happen, right? And the other piece is that a lot of suppliers built up inventory in anticipation. We're seeing this with copper right now, right? With suppliers front loading a lot of the supply of copper that they might need going forward. And so this is one of the reasons that I think almost none of this has really had a reason to be passed on to manufacturers and then on to consumers, because it's in such early stages that it's not overall impacting even profit margins yet for manufacturers.
One argument for why this won't be quite as inflationary as some people expect is from consumer pushback. They're sick of getting tariffed. They're sick of, not necessarily tariffed, they're sick of inflation going up and really eating into their real incomes. Do you think that they have more capacity to absorb price increases than many people believe?
You're absolutely right. So this is very different than coming out of the pandemic, right? Coming out of the pandemic, there was so much pent-up savings, right? There was so much pent-up demand that consumers basically shrugged off the higher prices and went out and started spending anyway. And that's gone, right? There is no excess pent-up savings that exists today for consumers to use as a buffer. So consumers are actually being a lot more discerning. And we're seeing this with a greater focus on private label items, right? Shifting towards lower cost retailers. We're also seeing it in consumers doing a lot more research, right? We just came out of Amazon Prime Day, and one of the things that we saw in the numerator data is that, even for things like paper plates, consumers were looking at Amazon, but they were also looking at Walmart and Target to see where they could get better prices for paper plates, right? Like, this actually takes a lot of time for consumers to be able to research where to get the best prices. And the fact that consumers are actually using this time, right, putting in the investment to figure out how to save a marginal dollar here or there, just signals that companies are not going to have the pricing power that they had coming out of the pandemic.
But at the moment, they are still spending. And you say when it comes to retailers or any sort of company, they're waiting to take that one bite out of the apple. How do they decide when to sink their teeth in?
I think this is a really difficult, question, because first they're going to be timed into contracts, right? And so they have to take it when there's a moment that they have a window to renegotiate with or to negotiate with their retail partners. And then they're waiting for more clarity, right? What is the final tariff? Now, one of the things that I've heard from one of the companies that I work with is that they have set tariff pricing triggers into their contracts, right? So since they don't know what tariffs are going to be, they have various scenarios with their retail partner that says, look, if tariffs are X, we are going to raise prices by this amount. If tariffs are Y, we're going to raise prices by this other amount. And that's already baked into a contract. It's going to be, right, for, September onwards. And so it even should not show up yet, at this point in the data.
Well, April 2nd became July 9th, becoming August 1st. This timeline can be extended. We don't know how long. Right. But many people think Trump can be in negotiating mode for more than just 2.5 weeks.
But the tariffs are already hitting, right? So we're now at a 15% effective tariff rate. And if you look at, this year so far relative to last year, we've collected about $50 billion more in tariff revenue. If that were to be passed on to consumers, which it hasn't yet, right, that would be another $400 or so per household that they're spending so far this year, right? Not an astronomical amount yet, right? Estimates from Yale Budget Labs say that if this is going to get passed on to consumers, it might be an extra $4,000 or so, per year that consumers are paying in higher prices for consumer products, right? It hasn't really started showing up in a way that would really suggest the consumer is truly feeling this. But I expect that to start happening once we get into back to school season and probably Christmas.
One missing piece in this whole conversation, just a final question from me. How much success are the companies that you speak to, how much success are they having putting the pressure on the exporter to drop prices?
The exporter has barely dropped prices because we can actually look at the data and look at the prices before tariffs are implemented. And those price levels are the highest that they have been, right? So we're not seeing this come down at all. And part of that might also be, right, maybe they are reducing prices a little bit, but don't forget, the dollar has lost about 10% of its value, right? And so even if they've dropped their prices by effectively 10%, the rising, the decline of the dollar means that import prices are about 10% higher. On top of that, you're adding tariffs, right? So this is a really, the effective tariff rate at 15%, plus a 10% decline roughly in the value of the dollar means that we should expect about 25% higher import prices.
The FX move has compounded the problem. We've seen that all year.
And frankly, some people will say that it'll be felt in the CPI coming up on Tuesday.
Leo, this was great. It's good to see you. Thoughtful stuff. Thank you. Thank you very much. Leo Feller there of Numerator. Up next on the programme, Tom Becker of BlackRock, Henrietta Trays of Vader Partners, Vito Spaduto of RBC Capital Markets, and John Lovallo of UBS. From New York, the second hour of Bloomberg Surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The president is getting the message loud and clear. The economy can absorb a lot of these high tariff levels without a huge downturn.
The U.S. economy is likely somewhat bigger than policy until you get to a certain level.
We'll see the low-end consumer continue to remain fairly sluggish, but the rest of the economy should be okay.
You've got a little bit of a disconnect, and it's kind of a tale of two cities.
You have the ability to adjust quicker than people think. And this is really what sets the U.S. economy largely apart.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, your second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures on the S&P 500 negative only slightly by 1/3%. On the Nasdaq 100 down by 0.3% also, and a similar move on the Russell 2000. Following a weekend full of threats, this market still isn't blinking and going into a week full of event risk. We've got bank earnings on deck and CPI tomorrow morning.
This is a market hoping for a compass at a time when some of the policy discussions have felt a little bit, I don't want to say rudderless, but lack of clarity has certainly been a theme. This week we'll get maybe a little bit more clarity, although that will be debatable in terms of what type of solidification we get in CPI, how much consumer prices do go up on the heels of tariffs, and then how much companies are absorbing it, or can they just keep adjusting and adapting and moving forward the way that a lot of people are pricing in.
Never mind companies, how are countries going to respond to all of this? Over the weekend, a threat of a 30% tariff on the EU. You've got three choices. You can negotiate, you can retaliate, or you can coordinate with trade partners. An extra lane being added over the weekend.
Yeah, over the weekend, what we heard is this potentially third scenario that Brussels is working out, having some calls maybe with Japan, Canada, India, trying to coalesce with other trading partners to then confront the United States as a more united front. Will this work is the key question, especially when you have the Treasury Secretary going over to Japan at the end of the week and the president himself and his team in negotiations with some of these other countries like Mexico. Their economy minister basically is back and forth between Mexico City and Washington. But it also could be used from Brussels as a threat. Look, if you're not going to lower the rate from now, it's 30%, went to 20 to 50 to 30, then potentially we are going to do our best to go after all these other capitals and try to make your life more difficult.
Lots of trade threats, we're ignoring them. Lots of threats on Chairman Powell, we're ignoring them. That was seriously a full court press over the weekend. Kevin Walsh, Kevin Hassett, the Vice President of the United States, putting the pressure on the Fed chair.
And shifting the tone of exactly how they were going to fire him, painting a path to actually have the legal standing to do so for cause because of renovations that they say were excessive. They went up when they initially started. The estimates went from $1.9 billion to currently $2.4 billion. There has been an increase. There's a big back and forth. A real question here, it depends who they put in Jay Powell's seat and whether they touch the composition of the rest of the Fed seats. Can they do that? Can Congress push back? French Hill, a Republican from Arkansas, over the weekend said, look, this is Congress's job. We're going to have more strict oversight, but they don't have the power to do this.
Bond yields higher by a basis point on a 10-year. You'd have no idea any of this was going on. On a 30-year, up by 2 basis points. The fireworks are in Japan once again. We've got to track that story. The Japanese government bond market kind of breaking down. Very slowly, but breaking down.
Yeah, you're seeing the 30-year yield close to 3.2%, the record high, as you have politicians saying we need to cut taxes, increase spending, and they are actually getting the running seat. They are seeming increasingly popular as a result. This goes to an existential question. Where is the anchor going to be in the global developed market bond market at a time where everyone has caught the wind of what the U.S. strategy has been? Borrow, 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 spend, 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 and never take the medicine that's required to actually pay your bills.
Well, it's not the U.S. right now, and it's certainly not Japan. That's for sure. More on the bond market in just a moment. Coming up, we'll catch up with Tom Becker of BlackRock, looking for a strong CPI print tomorrow morning. Henrietta Trays of Vader Partners as President Trump slaps a 30% tariff on Mexico and the EU. And John Navarro of UBS on the potential for a housing recovery in 2026. We begin this hour with stocks down on President Trump's latest tariff threats. Tom Becker of BlackRock writing, our read of the data is that we'll get a stronger month-over-month CPI read on Tuesday. This earnings season is an opportune time for the companies to provide guidance on how and when tariff costs will be passed through to consumer prices. Tom joins us now for more. Tom, welcome to the program. Let's start with that first line. Why are you and the team expecting a pickup in inflation as soon as tomorrow?
Morning, John. Good to see you. Yeah, I think we've had a couple months here, a quarter of weaker CPI prints. And from our take, that's been related to companies not really knowing what the effective tariff rate is, not wanting to antagonize consumers, not really wanting to potentially lose market share and step out ahead of their competitors, where others are maybe a little bit more cautious with raising prices. And as your last guest said, consumers are pretty savvy. Inflation expectations and behavioral changes around inflation are embedded into behavior now, and I think companies are aware of that. We think with the increasing certainty that companies have about some of the effective tariff rates, we think some of the pass-through is going to start happening in this June CPI this week.
Tom, let's say you're right and inflation firms up through the summer. Is it the kind of inflation you can look through, or the kind of inflation that you should expect to hang around and maybe continue to pick up?
From a policy setter's perspective, this is the worst kind of sequencing you can imagine, because you're having these deals negotiate over the course of months and quarters, which looks like a slow bleed in of inflation into the economy rather than 1 month, one and done. When the tariffs first came up, we were thinking about this as like a VAT hike as a framework to kind of think about how this might affect the economy. So it's a tax hike, it's on consumers, it's on a subset of the things that they consume, but it's seeming more like it's going to be a more continuous bleed into the data. And so that's trickier for policymakers to say, come next June or July, oh, the tariffs are no longer in the data. We think it's going to be much more of a gradual process, keeping prices closer to 3-4% for a while here.
You know, for the past couple of months, everyone kept saying that the United States will bear the brunt of all of these tariffs in terms of slower economic growth. Are we rethinking that now, especially as other countries are being forced to spend and borrow at a faster pace?
Good question. I think there are three potential parties that can pay the tariffs. You can have exporters pay the tariffs. You can have U.S. consumers pay the tariffs. But the actual parties that have been paying the tariffs thus far are U.S. corporates. So last month, tariff revenue in the U.S. over $27 billion, $20 billion more than a year ago. That's $20 billion that somebody's paying. And if it's not in consumer prices, it's been much more on margins. And so I think, the quote you brought up at the beginning, just thinking through how companies are going to explain to shareholders, how are you going to navigate these prices? How are you going to keep margins? I think the U.S. is uniquely in that position of having to think through which parties bear the tariffs. And to date, it's been companies. We think more of that's going to shift over to consumers.
Do you think, though, that it's companies just in the United States, or do you think that there has been a sort of overly sanguine attitude by investors toward how much of a hit German companies are going to take, Japanese companies are going to take, and just around the world?
I think if you look at share price performance here today, Lisa, it seems that people have been sanguine about the demand hit, and you've had foreign companies outpace U.S. We've been positioned for more U.S. equity performance here in the summer in this earnings period. We think it's set up a little bit better. So yeah, I think there is there's been a rating, a multiple re-rating in foreign companies year to date. They're going to need to start showing some earnings. And if you think about the medium-term incentives here, tariffs aren't going away. You're seeing CapEx intentions and sourcing intentions move. I think your previous guest talked a lot about kind of how this is embedded into the system, and I think that's the right way to think about it here. But as you're thinking about multiple years of tariffs, I think these slower moving decisions of do I source my products from abroad, like currently potentially, or shift more of that to the U.S., I think that's a very plausible outcome is you're going to get more domestic production, more activity in the U.S. over time.
Tom, tariffs aren't going away, and the president almost seems emboldened now. We're seeing some rates that are higher for some countries than they were on April 2nd. But after April 2nd, we saw a reaction in the market. Do you think the market at some point will start to push back?
So I think on the bond market, it's been a pretty range-bound year and pretty interesting to think about what some of the catalysts have been for some of the shifts in the range. You were just talking about the 30-year Japanese government bond moving up, but Friday's move in the U.S. was pretty big. I'm not really sure if it was that the market got around to reading Governor Waller's speech on Thursday, which talked about having a much lower duration balance sheet. But you've had these yins and yangs of kind of shifting the market winds. Initially, it was fears of inflation, and then the market got okay with some of the inflation prints and thinking maybe tariffs weren't going to be so bad. We think it's more of a delay here on kind of the bond market, recognizing if the economy's okay, which I think the data has definitely borne out the last couple of months in terms of activity, and you start to get inflation here, are these fair levels of yields to compensate investors for maybe the Fed not having to cut this year, and then the long end having to deal with all the issuance and the supply and the inflation risk kind of continuing for a couple of years here?
Tom, we saw equity markets do well following the pandemic with a pickup in inflation. Nominal growth exploded. Tom, I wonder from your perspective whether you'd expect something similar or if it's slightly different this time, and in what way?
I think in terms of getting exposure to a nominal, like you say, John, a nominal asset, equities are great, particularly to the extent that they can kind of keep margins high and pass some of these costs on to consumers. I think we are, the global economy, we think is in this kind of swim lane of higher nominal growth than it was in the previous decade. So we think that's continuing. We think it's broadening this year. Equities are a great asset to capture kind of that expansion. There's a bit of a TINA element potentially here where people look, they're like bond yields. Do I really lock in 4-something% with inflation heading above 3 again? Or do I lever myself again to kind of the asset that's going to give me exposure to that growth? And also companies have been super nimble about dealing with these tariffs. There was a news last week about Delta moving engines like across borders.
Yeah.
I wouldn't underestimate the ability of U.S. corporates to navigate these and find ways to kind of deliver shareholder value back.
Tom, what you're saying, though, I think is important. Just a final question. There is an underlying assumption here, and that it's the traditional inverse correlation between stocks and bonds reasserting itself. How convinced are other people by that idea, given the dynamics we've seen over the past few months?
So across the BlackRock platform, we're seeing less and less of a conviction that we're headed back to that negative stock-bond correlation. We're seeing lots of flows into diversifying liquid alternatives that are navigating kind of these equity blips a little bit better than bonds. And I think part of the reason why that positive correlation between stocks and bonds has been so sticky and persistent is it's related to kind of this inflation risk, the institutional risk. Historically, that's when you see that correlation shift to be more positive. And I don't think anyone thinks we're going back to kind of a QE ZIRP type environment, which is kind of the ideal environment for that diversification from fixed income. So broadly, we're seeing kind of investors, shift assets to speak to that kind of higher correlation between those two assets, which means it's harder to find diversification in your portfolios. And that's what investors really want to find these days.
Tom, thank you, sir. Appreciate it. Tom Becker there of BlackRock, giving us plenty to think about. Might also speak to some of the moves we've seen in gold and in Bitcoin over the past year.
You raise a really important point, which is what is the counter-cyclical response of bond markets at a time where a lot of governments have already been borrowing a lot of money? Can they borrow more to have a fiscal response to that negative growth shock, that whatever it might be when it comes down the pike? And if they can't, what does that do to bond yields and that inverse correlation?
Bond yields this morning only higher by a single basis point, the 10-year 4.42. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara, who has more. Hey, Yahara.
Hi, John. We start with our top story. President Trump declaring a 30% tariff rate for Mexico and the EU. The new rates are set to take effect on August 1st. EU Commission President Ursula von der Leyen responded saying they are working towards an agreement but are prepared to use countermeasures, while Mexico's economy minister called the new levies unjust. Meanwhile, President Trump and his allies are ramping up pressure on Fed Chair Jay Powell. In addition to criticizing Powell for not cutting rates, they're now focusing on his handling of the renovation of Fed headquarters. The Fed says the renovations are designed to reduce costs by consolidating its operations, but critics are focusing on what they call extravagant design features. And Amazon's Prime Day sale, which was doubled to 4 days this year, helped boost overall online spending in the U.S. by 30%. The data from Adobe included sales for Amazon and its competitors Walmart and Target, which hosted their own sales. Consumers mostly stocked up on household items rather than pricier goods like electronics. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, EU tariff tensions.
The European Union is talking to us. They want to open up their country.
We must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures.
That conversation up next with Henrietta Trace of Vader Partners, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
A quiet start to the week. It gets busier tomorrow morning. CPI 8:30 Eastern Time, Tuesday morning. Sandwiched between a lot of bank earnings Tuesday and Wednesday. Equity futures right now negative by a third of 1% on the S&P. We're down by 0.4 on the Nasdaq 100. Under surveillance this morning, EU tariff tensions.
The European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. So some of these deals, maybe I'll change them and maybe I won't.
So here's the latest. The European Union preparing to respond after President Donald Trump threatened 30% tariffs on the bloc as talks with the US drag on.
I intend to speak with my U.S. counterparts again later today. The current uncertainty caused by unjustified tariffs cannot persist indefinitely, and therefore we must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures to restore the balance in our transatlantic relationship.
Joining us now is Bloomberg's Tyler Kendall. Tyler, the EU versus the US, it was all very, very quiet. Now it's got a lot louder.
Yeah, exactly, John. Although it is perhaps the EU taking a more measured response here going forward, saying that they will delay their own retaliation until August 1st in a bid to keep negotiating with the U.S. But it was interesting to hear. You heard the EU trade chief there. He went on to tell reporters that there is a new sense of urgency, in his words, for the trading bloc to engage with its other trading partners. And Bloomberg News had reported earlier this morning that contacts with nations, including Japan and Canada, could lead to potential coordination between them against the United States. We know that the EU Commission President Ursula von der Leyen will be speaking with her Canadian counterpart, the Canadian Prime Minister Mark Carney, later on today. It's also probably worth mentioning that the EU actually reached a preliminary trade framework with Indonesia over the weekend, as EU officials have said perhaps there could be more of a focus on Southeast Asia and the Pacific. This tariff letter from President Trump really did appear to dampen perhaps the negotiations, considering our understanding had been that there had been progress and that the EU was moving up in line when it came towards the potential for a deal. The thing is, as you well know, there are just so many sticking points here. We know the U.S. has wanted to see greater market access for its agricultural products, for one example, and the EU has really been focused on those sector-specific tariffs. John, we know there is an emphasis here when it comes to autos, but it's also probably worth pointing out that some of the tariffs that haven't even been enacted yet, those tariffs under Section 232 on the grounds of national security concerns that we are still waiting for, like pharmaceuticals, are also still hanging over these negotiations.
Tyler Kendall with the latest in Washington. Tyler, thank you. To Tyler's point, still waiting for the sectoral tariffs from the White House.
Exactly, and they have been signaled from this administration a number of times. We did get copper, we have aluminum, we have steel, but what's going on with chips and what's going on with pharmaceuticals? And for some trading partners, like the European Union, like Japan, that almost potentially could be more important than the across-the-board, what they would call reciprocal rates.
Well, let's stay on Europe. Here's the view from Henrietta Tracer, Vader Partners. Quote, there has been a split view in the EU over whether to retaliate against or negotiate with the United States. Since President Trump announced 30% tariffs on the EU, the retaliate team has been getting louder. Henrietta joins us now for more. Henrietta, welcome back to the show. That last word, retaliate, what about the prospect of coordination between the EU and partners?
You know, with trade, it's all about the negotiating partners, whoever the party is.
expanding the cards in their deck. So if you can retaliate and you can also coordinate with other partners, all the better. And that's plainly what the EU is doing. And they are working, as Tyler just pointed out, to reach deals with Indonesia and other Asian trading partners to find a way to offset the, very clear permanent negatives that are coming from the United States in terms of these tariffs. And the only question I really have is whether the rate stays at 10% for them or whether it rises to 25%. And those sectoral tariffs are much more damaging and really create huge tensions within the EU bloc to negotiate. How do you strike a deal that works for autos but not pharma and leaves out Ireland, for example? Those are all the issues on the table.
Henrietta, when it comes to coordination potentially with Brussels and other capitals around the world, is it going to help or hurt their hand in Washington?
Honestly, I'm not sure how much worse it can get. They are holding off on retaliating. They did go back and forth for a couple hours yesterday morning, which was interesting to watch. As I mentioned, the retaliate team is getting louder. But I think that they are trying to deploy as many alternatives to the United States as possible to strengthen their hand. Because frankly, the president is not moving away from the tariff struggle. The market is giving him free rein to do so. And the EU basically has to do whatever it can to try to increase the cards in its deck.
Well, is every card being used? Like the German defense minister visiting Washington today at the same time that Berlin is in talks with the U.S. about providing weapons for Ukraine and footing the bill?
Yeah, so the Ukraine component is, I think, a really big deal. And the president is under extreme pressure from not just the EU on that front and getting support from France and other nations saying that they're going to increase defense spending, but he's also under pressure from the United States Senate. And there are 83 senators or more who want a really robust sanctions bill to pass, which not only requires a 500% sanction that would go into effect on any nation helping Russia, but also would sort of hamstring the president in terms of what he can do unilaterally and force his hand. And that's exactly what the president does not want. So the EU does have some allies on its side when it comes to being pro-Ukraine and anti-Russia. And that's coming directly from, sort of inside the building from the United States Senate.
Henrietta, how cohesive is Europe right now when it comes to how to counter the United States? And I ask this as the German Chancellor, Friedrich Merz, said over the weekend that if 30% tariffs would go forward, it would hurt Germany's industry to the core, and so they would have to even postpone key aspects of their economic development plan, really kind of saying, look, we need to find another solution.
Yeah, and that's exactly the strategy of the United States right now. The purpose is to split the EU bloc. And I think if you talk to some folks in D.C. or in the administration, if that's their strategy, they wouldn't be mad at it. I mean, they want to go after very specific sectors to try to get Germany to exert pressure on Italy, or to get Ireland to exert pressure at wherever it can over pharma, or France, whatever they can do on the agricultural front. So it's really about going after as many individual players. And that's why you have 232s across 8 different sectors right now, from steel and aluminum, which hits the EU, autos, pharma, coming on a whole host of other sectors, including aircraft and jets and engines. Those are all the levers that the U.S. is trying to pull to fracture the EU to the extent possible to eke out the best deal.
Henrietta, always great to get your views. Henrietta Trace there of Vader Partners. Headlines you don't expect to read: China, record exports, record surplus in the first half of the year, even with the trade relationship between the U.S. and China collapsing, the exports from China to the rest of the world exploding.
Yeah, where in particular Southeast Asia, and you saw a 16% decline in exports to the United States. We have to dig in to understand exactly how much is going to Europe, and there are lots of people who will raise questions about the credibility of this data, but...
As they should.
As they should. But there is this question about transshipments and how much of that exporting volume to Southeast Asia is just getting rerouted right back to the United States, and whether that's going to be something that the president can stop.
Exactly. For the month of June, it was down 16% going to the United States, but those Chinese goods are still somehow ending up in the United States. And I wonder if you're a U.S. official looking at this data, you're thinking, where do we need to go after when it comes to transshipping? They're trying to work this out with Vietnam. Who else?
Need to force it on everyone else for this to work. Equity futures right now in the S&P down by 1/3 of 1%. Up next, RBC Capital Markets US head Vito Spaduto on the outlook for M&A ahead of earnings season. Plus, Yahaira with your morning movers. Fox getting an upgrade on its advertising pricing power. Live from New York, you're watching Bloomberg TV.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Equity futures so far in the S&P negative by 1/3%. A small week of losses on the S&P 500 last week. With Friday's losses, we just missed out on a third week of gains. A third week of gains would have been the longest weekly winning streak of the year so far on the S&P 500. On the Nasdaq, we're softer by 0.4%. Similar move on the small caps on a Russell 2000. With 2 hours until the opening bell, let's get you some morning movers with more. Here's Yahara. Hey, Yahara.
Hi, John. As you said, futures are lower, but I managed to find some stocks bucking that trend. And we start with Fox. Shares are up 3 3/4% after Wolf Research upgraded the stock to peer perform, pointing to the strength of Fox's news and sports businesses. They're saying that NFL broadcasts continue to deliver strong and stable audiences for them, and that they see no signs of an advertising slowdown for now. And we move on to shares of Synopsys. They are higher 3.5% after the chip design company secured approval from China to buy another company, Ansys, for $35 billion. The deal between these two U.S. companies needed Beijing's sign-off because China, as we know, remains one of the largest markets for semiconductors, and regulators there wanted assurances that Synopsys with this deal would not cut off Chinese customers. So a big hurdle cleared for them. And we end with some more optimism. Take a look at crypto-linked stocks, MicroStrategy and Coinbase, all higher, riding Bitcoin's latest move higher as it soars to record highs, reaching $122,000. And this is coming as Congress gears up for Crypto Week, where they plan to take on crypto legislation. John?
Yahara, thank you. Appreciate the update. On our radar this morning, our top story, President Donald Trump reiterating his call for lower interest rates, saying Fed Chair Jay Powell should quit. Administration officials also ramping up criticism of Powell's handling of an expensive renovation of the Fed's HQ.
They're throwing everything at him, and they're trying to find justification for why they can fire him, and the market is sort of shrugging it off and saying either this is just theater optics for some of the Kevins to audition more publicly, and maybe this isn't something that could actually change the dynamic of the FOMC just simply because it's not just a one-person FOMC. There are other members too. To me, the fact that Kevin Warsh brought up a regime change for the Fed, talking about some sort of shift in the composition of the committee and overhaul, that made me take notice. Maybe that's just he wants to get into the front seat in this race.
That made me take notice to the fact that what they really do want is more seats to fill people that have their worldview, which makes me think that it is going to be someone like Governor Waller. Because if Powell decides to leave when his chairmanship is up, because he could stay until 2028, they want that seat for someone else to agree with people like Governor Waller that are currently on the board.
I've got no idea who's going to be chosen, but if you wanted a credible voice for someone making a credible argument for lower interest rates, he's on the Federal Reserve already. His name is Governor Waller.
If you put a Hassett in, I think the market will respond pretty dramatically because it will be considered somebody who is a political ally of this president. Warsh, you say the worldview. What is his worldview, considering that he was relatively hawkish? The bigger question is, how much does this affect the dollar more than even yields? Because it really goes to the heart of credibility of the United States. And if you start drawing too many parallels with Turkey, that's not a great thing.
Right now, it's not affecting anything. Bond yields are higher by a single basis point. Let's turn to trade. The EU planning to engage more with other countries hit by President Trump's tariffs. Sources telling us here at Bloomberg, the bloc could potentially coordinate with Canada and with Japan. This is a change.
This is a change, and they're looking for leverage at the same time that they're trying to get the European nations to coalesce around some sort of plan of how they're going to counter the United States. This, to me, was one of the most interesting things. Henrietta Trey is really highlighting this is the strategy of this administration, to split the defense. This is sort of the classic football move to use, or soccer move. You want to try to create dissonance among the European allies so that they come together and actually have to accept it or negotiate and accept pain. I'm going to keep watching to understand exactly how they're doing that.
It's that forever question. If you're sitting in the White House, you want to call Europe, who do you call? Who's answering the phone? Is it Ursula von der Leyen? Is it the German chancellor who's sending his defense minister to Washington today to talk about Ukraine and defense? Or is it someone like Giorgia Meloni, who we've seen, had this outreach to the Trump administration, individual who's made her way to Mar-a-Lago before he wasn't even inaugurated? It's a challenging moment for the European Union because it really is hurting cats when you're dealing with all of these different countries.
You mentioned Germany and defense. Worth mentioning this story that the president is saying the U.S. will send more Patriot air defense batteries to Ukraine. His comments coming ahead of what he described would be a, quote, major statement on the war later on today.
So he said he haven't agreed on a number yet, but he said he's going to send these Patriot defense missiles. The big question going today is, will he send anything that's more offensively? And also, when you have the German defense minister, Boris Pistorius here, they're the ones that are saying maybe we can help pay for some of this that's going to Ukraine. The second thing to watch for today is, does the president signal that he is in favor of this bill that is working its way through Congress? The number of Republican senators want to see, and this will make it much more challenging for Russia to export crude to China and India, basically the two biggest economies they're going to.
And by the way, does he link the two issues on trade and on defense? If we do this for the Europeans for Ukraine, what are you going to do coming back? And by the way, we don't like what we heard in a Bloomberg News story earlier this morning that you're looking to coordinate with trade partners to make it more difficult for us.
I absolutely think the president views all of this as one and the same. He will say, we are doing something for you on Ukraine. Now you need to help us when it comes to trade.
Three of the big stories so far this morning. Let's turn to deal making. The M&A market in focus ahead of a big week of bank earnings. Vitos Baduto of RBC Capital Markets saying M&A activity is delayed, not derailed. Writing the backlog of M&A opportunities continues to build. Deals will happen. They're just not happening as quickly as many had expected. Vito, it's good to see you. Good morning.
Thank you for having me.
The difference between those two words, delayed and derailed. What inspires confidence that this is just a delay and not a derailment?
Well, I think the fundamental conditions have continued to be very solid. I think the corporates are sitting flush with cash, more so than they have historically. I think for clients, for instance, we're open to lend to clients to support their transactions, much like we were earlier in the year. I think people have gotten comfortable with the current environment. They are operating in an environment of constant uncertainty. And so when you talk about whether it's tariffs or other policy coming out of D.C., you have to plan for multiple scenarios. And so what we're finding with our clients is that they're preparing for transactions. There's a fair amount that they'd like to do. They're continuing their plans. It's just a question of when do you make the decision to do it. And so it's delayed to the right. It's not being taken off the table. And so I think there's a fair amount of activity when the window does open.
A lot of people said it was a wait-and-see economy, and then Delta Airlines happened. And Ed Bastian came out and said that things are stable, businesses have clarity, they're investing again. Have we broken out of that wait-and-see economy?
I think some have. I think we're seeing it certainly. I take a look very closely, for example, at the CEO Confidence Index out of the Conference Board. So the median there is 50 on a scale of 0 to 100 in terms of the inflection point. In the first quarter, which was taken in February, CEOs were at a 60, meaning that they were confident in the forward outlook. They felt positive about it. The survey that was taken in mid-May dropped to 34. It's the biggest quarterly drop that you've seen. So what happened between February and May? Liberation Day. So that tariff and policy uncertainty, concerns about geopolitical instability, and then also an uncertain regulatory environment in some cases has driven them to not make decisions. And so when they looked at that, a very high number of them felt that we were in a worse position versus 6 months ago back in May. But what we are seeing is that, look, I think you look to Trump 1.0 versus this, it took a full year of the first administration for people to get their arms around what it meant. I think it's happening quicker now, and I think the better companies are prepared, and they're going to enact policy.
The pipeline is rich. The pipeline is there. Look, I think that one reason why a lot of people are looking at this is because we are going to get the earnings from JP Morgan and Citi tomorrow, and Wells Fargo, and then from Morgan Stanley and Goldman Sachs on Wednesday. And people are wondering how much of a boom this is going to be to them, considering that heading into this year, it was supposed to be the year of M&A. Didn't happen. How much has that been derailed?
Well, I think you're seeing, if you look at M&A volumes this year, announced volumes, it's actually up versus last year. But a lot of those transactions in the first quarter were things that were already on the books about to happen. And so you have U.S. M&A announced volumes are up 16% this year. Globally, it's up 26%. But it's really larger deals, $1 billion plus, are driving that. And the smaller deals, sub $1 billion, are actually slightly down in value. So what's happened is a lot of it's just been, like we talked about, pushed to the right. People should not be surprised by this. Like I said just now, this is what happened back in 2017 during the first administration. But what we are seeing is that where we sit today versus the beginning of the year is that there has been a tightening of the bid-ask spread. I think parties that are prepared and feel confident are out there doing transactions. I think sellers that need capital and need to, for instance, if you're a private equity firm and you need to return capital to your LPs, you're looking at various alternatives. It might not be a traditional sale, but maybe you look at a continuation vehicle. Maybe you're looking at some structured equity. Maybe you're looking at a minority sale or taking a loan on your net asset value. And you're finding ways to return capital because that's the lifeblood of what they need to do.
I wonder how much the scenario for how people are financing these purchases has changed with yields where they are. Have you seen people less willing, or companies, not people, companies less willing to incur debt to make those purchases and wanting to do it in all stock or cash or whatever, just simply because of the fees?
I think if you go back 2 years ago, a year ago certainly, I think people had not accepted this new level yet. I think they've accepted it now. So they understand rates higher for longer. I think if you look at where the calls are, for instance, our rate desk just pushed out their call last week that instead of a first cut happening in September, it's now going to be December. Just because it's too short of a window to August 1st or to the September meeting to really see any statistics that will allow the Fed to cut. And so as a result, I think companies are saying, I'm going to be in this environment longer. I need to make the right decisions for my business. It's too soon to just focus on 26 and beyond, but I think a lot of folks are looking at their more longer-term plans. And as a result, you're seeing them make decisions that are strategic. I always like to say, good strategic transactions will happen, and we can find a way to support them and finance them. And we're seeing that with our best clients.
But Vito, what's the risks in delaying?
The risk in delaying is that someone else takes advantage and you're sitting on the sideline and left behind. And so we're seeing a lot of activity in some sectors where folks are feeling that, for example, if you look at the technology sector, I think folks are trying to build their pipelines from an AI perspective, and they're looking and saying, I need to be in here quickly. I can't wait to develop this on my own. I'm going to acquire it. If you think about some other sectors like industrials, they're looking to diversify their supply chains and think about making sure they've got ample supply in various geographies and so that they're tariff resistant. And they know they have to operate in this environment. We know it's going to not necessarily be what's out there in terms of a headline today, but we don't know what that's going to be. And I think they're planning for various scenarios.
Just finally, Lisa brought up the price of money. Do rate cuts make a difference? Do they move the dial?
I think, as I started before, I said we're looking for a signal for sort of people to make decisions. I think certainly rate cuts would be a good signal to the market and to buyers and sellers that this is an environment where we're ready to transact, and there's a level of confidence there. M&A is about aligning many different factors. And so you need your management teams, you need your boards, you need them all to have confidence in the forward outlook. If they feel that the Fed's giving a strong signal like that, I think that's a positive. But at the same time, I think the better companies are prepared to act in this environment. And so, again, I jokingly say we always have a pretty full pipeline. It's pretty full right now, but I'd love to see a lot of that transition to announced transactions.
You're certainly not alone. It's good to see you, sir. Thanks for dropping by.
Thank you for having me.
Vitas Baduta there of RBC Capital Markets with an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. An initial report on the crash of an Air India aircraft last month says fuel supply to both engines was switched off just seconds after takeoff. The report does not reveal why the fuel switches were moved to a cutoff position on the Boeing Dreamliner, nor who did it. The crash killed all but one of the 242 people on board. Meanwhile, Elon Musk says he's planning a shareholder vote on Tesla's investment in his own AI startup, xAI. In a post on his social media platform X, Musk said if it were only up to him, the EV giant would have invested in xAI a long time ago. His comments came after the Wall Street Journal reported that his other company, SpaceX, had agreed to invest $2 billion in xAI. And top-ranked Yannick Sinner defeated Carlos Alcaraz 3-1 to win his first Wimbledon championship and the first for an Italian. It's his fourth Grand Slam title overall. The contest was a rematch of last month's epic French Open final that saw Alcaraz come back to win. This time, it was Sinner's turn. That's your Bloomberg Brief. John?
Yahara, thank you. The resilience of tennis players to bounce back from the French and the loss that Yannick just had. We've got 10, 15 more years of this. 22 and 23 years old. Just amazing.
To bounce back from the French, you mean just tennis players or the Italian tennis player who took the helm? Just want to say.
The Italian player that bounced back and everyone that's been following
against the French.
All right?
Okay, carry on.
Everyone's supporting him. Okay, we're done. Up next on the program, housing, disinflation.
Inflation's coming down. Of course, we get a big CPI report, but we're at the lowest level since 2021. There's significant disinflation coming from the housing side. I wish more people were talking about this right now.
We'll talk about it in just a moment with John Navarro of UBS from New York. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, And if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
You just sense confidence this morning, confidence that the price of tariffs this high is too high and they won't follow through. Confidence that the price of firing Chairman Powell is too high and they won't follow through. Equity futures this morning down by 0.25% on the S&P, on the Nasdaq, a similar move. In the bond market on a 2-year, 10-year, 30-year, you'd have no idea the kind of pressure Chairman Powell was under. Yields are higher by just 2 basis points, the 10-year 442.73. This from the team at Evercore. We doubt Trump will actually fire Chairman Powell. Besant likely warning of the mayhem this would cause in markets. Serious doubts the Supreme Court would even uphold the decision.
Which maybe explains why yields are up just marginally in the United States, even as they're up much more around the world for other unrelated reasons. Question is, are we playing a big game of chicken, where people are waiting for people being President Trump, waiting for the markets to respond, and when they don't respond, he says he has a green light to just keep going?
Keep pushing, keep pushing. Yields this morning pushing higher by just 2 basis points. Tomorrow morning, inflation data on deck. Under surveillance this morning, housing disinflation.
Inflation's coming down. Of course, we get a big CPI report, but we're at the lowest level since 2021. There's significant disinflation coming from the housing side. I wish more people were talking about this right now. We have the most homes on the market since 2020. Demand is slowing in the face of unaffordability. There's enough disinflation on the shelter or housing side to potentially overcome any goods-driven tariff inflation that we see.
So here's the latest this morning. Shelter costs in focus going into tomorrow's CPI report. John Lovelo of UBS writing, investor sentiment appears to be improving and the focus is shifting towards the prospect for a housing recovery in 2026. John joins us now for more. John, good morning.
Thanks for having me, John.
Emily Rowland just there. Let me read out some of that. Inventory, homes on the market, the most since 2020. Demand is slowing in the face of unaffordability. How would you describe the current backdrop?
I think it's, I've said this before, but it's a tale of two markets. I mean, existing home inventory is still very low. New home inventory has picked up in certain markets. We could talk about the I-4 corridor of Florida between Orlando and Tampa. You could talk about Austin. You could talk about Phoenix. But the builders had done the rational thing, and that is try to fill the gap of not having enough existing home inventory. Now, things have slowed a little bit more than people had expected. And again, they're doing the right thing, and they're pulling back on production. So our view is that as we work through the end of this year, that inventory is going to be in a lot better spot.
Housing recovery. What does that mean? Does that mean prices going up? Does that mean more transactions? Or does that mean that there's just going to be a balancing where you're not going to see as much inventory in a number of the places that you're talking about?
Lisa, I think it's a little bit of all of those, right? I mean, I think you see inventory get worked through, but most importantly, look, consumer confidence appears to be stabilizing, right? And along those same lines, investor sentiment is stabilizing. And as as that quote said, they're looking towards a 2026 that could be a little bit better. And just as importantly, I think that there's an expectation that we may see one more cut in earnings, but it will be less pronounced than it's been in the second quarter here, and it will be the final cut. And that is generally when you want to get involved. So I think inventory gets better. I think consumer confidence improves, pulls buyers off of the sidelines and back into the market. And we start to see a little bit of an improvement in the overall housing market.
But to Emily Rowland's point, there has been a disinflationary force given how much inventory has built up in a lot of places and the fact that a lot of people feel locked out of the housing market because rates are too high and prices are too high. And even people who want to have renovations, they worry about the cost of materials and things of that nature. I'm just wondering how much you see people absorbing higher prices if you see this as a source of inflation or ongoing disinflation.
Yeah, it's a really interesting dynamic where this disinflation is being driven by several factors, right? If you think about it, historically, new homes have commanded 17 to 18% premium to existing homes. That is zilch. They're equal. But now keep in mind, what's driving that is a lot of mix. And what I mean by that is the builders are realizing that, hey, affordability is a real challenge. So what we need to do is build smaller homes, a little less amenitized, a little further away from the city to bring these prices into ranges where people can actually transact.
Can you get a housing recovery without a Fed rate cut?
I absolutely think you can. If you think about the 30-year right now, we're at 6.8%. If you think about last year when we had a really strong market, we were over 7% for most of the year. I think what's most important is stabilization. Think about it, the volatility we're seeing in mortgage rates makes it very difficult for consumers to go out and purchase, makes it very difficult for the businesses, the companies, to actually figure out how to plan their businesses. And, you know, there's just this uncertainty is not good for anything.
And you think part of that uncertainty is also driven by what's going on in Washington in terms of tariff policy. What makes you think, if you think there's a recovery in 2026, that the tariff uncertainty will actually stop?
That's a good question. I don't know that tariffs play into it 100%, but if you think about the tariff impact on the housing market, it's actually a lot lower than it is for many other industries. We've estimated 5 to 6% of the cost of an average home. I don't think the builders shield or cover most of that. I think it gets spread throughout the value chain. I think it's more uncertainty about just the overall economy. And, you know, if you're thinking about buying or transacting upon the biggest purchase of your life, which is a house, you want to feel good about things.
Makes the question why the home builders can't get off the map. Because we have seen a recovery in the index level on the S&P 500. Had a lot of guests come on the program and say similar things to what you're saying. Pricing the recovery for 26. A lot of people are doing that. Home builders are not. Why is that?
Well, we've had a pretty good run over the past couple of weeks, and I think there's a lot more to come. We're still trading at just over 8 times earnings. Historically, I would tell you an average PE multiple is closer to 11 or 12 times. So we have a lot of room to go. It doesn't take much to get this group going. It's just a little bit of kick in the tail, and you're going to see these things go off to the races.
Is there an income group you want exposure to, the likes of Toll Brothers? Is there a region you want more exposure to? What kind of exposure do you want to take?
I would say that, look, from an income group, and maybe this sounds a little counterintuitive, we still like the entry-level first time because that is the buyer that is most need-based. You know, think about it, getting married, having children. Now, sure, you could say that they're more reliant upon interest rates, but then if you think about it, there's a $62 trillion wealth transfer that's happening in the U.S. 25% of first-time buyers say that they receive down payment assistance. This buyer has also done things a little later in life, so they're a little better financed, and they are, again, they need that space. Now, to your point, though, John, we like the higher end as well. It's a sort of a barbell approach where those folks, the Toll Brother buyer, is still spending a lot on options and upgrades, and that's very accretive to margins.
I think you and I are thinking of the same thing, aren't we?
Yes.
Down payment assistance.
Yeah, you need rich parents, and then you're fine. That's
Bank of mom and dad. Bank of mom and dad.
100%. It's sort of like, you know, hey guys, you want, you know, tax-free, pass along the endowment. There you go.
First-time buyers. That's a data point that should be on the desk of every single politician in this country.
Yeah, especially for people who don't have, you know, the bank of mom and dad.
Precisely. John, it's good to see you. Thanks for dropping by. Appreciate it. John Lovelo there of UBS. Up next on the program, Julie Beale of Kane Anderson Rudnick, Sal Martinez of HSBC, Michael Dada of Roth Capital, and Mark Cabana of Bank of America. The third hour of Bloomberg Surveillance up next.
Going to get the debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt to GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, you know, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP. And that's got to be a major focus.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Investors are saying that everything is awesome and there's not a lot of risk.
We have a stronger stock market at this point, so that does embolden the president to go forward and be more aggressive now.
There will be very big differences if the tariffs come out at the higher level.
What the market is telling you is that, yes, we're expecting volatility.
We could spend a lot of time thinking about the noise, the volatilities out there. It hasn't paid off to just say, I'm going to stay off the markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. 90 minutes away from the opening bell. Your price action looks like this. Equity futures down by about 1/3% on the S&P and the Nasdaq 100. In the bond market, a bit of a snooze stateside for most of this morning. Yield starting to pick up now on a 10-year maturity, higher by 2 or 3 basis points at the long end of the curve. Going into a very busy week, including lots of economic data. It's not just bank earnings, CPI on deck, retail sales as well, and another look at jobless claims.
Key question here, how much are we seeing inflation pick back up, or is this going to be a story of disinflation? Mark Cabana, who's coming up of Bank of America, put it this way. Is it tariff inflation? Is it the ghost of tariff inflation or the disinflation deity? It's sort of which fiction are we living in? And right now the market's trying to toggle between both of those while looking at policy uncertainty and saying, we're going to have a beer and take the summer off.
Bank of America, no cuts this year.
Right.
Morgan Stanley, no cuts this year. Wolf Research, Stephanie Roth on this program in the last week or so, no cuts this year. Wait until the middle of next year. If you think the pressure is big right now on Chairman Powell, wait until later this year if they still haven't cut interest rates.
Especially if you don't see that inflation pick up in the CPI. If there is a lagged effect on the economic data and you are not seeing some sort of hit to companies, well, what is the argument to actually cut rates if the economy is still chugging along? At the same time that you might not have an inflationary pressure, it just raises this question for the Fed. How much do they have to cut? and then also fend off some of these political discussions.
A big question mark, too, for the Fed, and they continuously talk about this, is that they do not know the end game when it comes to tariff rates. Right now, we see over the weekend more hot rhetoric when it comes to the European Union. The European Union has jumped since April 2nd from 20 to 30 to 50, back to 30. When it comes to Mexico, they're now at 30%. Everyone is signaling this is a negotiation time. Well, if there's still a negotiation, they don't settle on a rate, what is the Fed supposed to do with that?
Going through the research over the weekend, there's a few words that pop out. Here's one: complacency. This from Julian Emanuel of Evercore. Tariffs likely to pressure complacent EPS forecasts. We're actually going to see that this earnings season.
Well, maybe they'll have to. I think it depends on which sector. Are you going to see certain sectors start to indicate that they're going to make a little bit less as they try to avoid passing along some of those tariff costs to consumer? I just keep thinking about what we were hearing about earlier from Leo, the idea that companies already are offsetting this with the dollar depreciation, and that you are seeing sort of long-lasting contracts that make this really a lagged kind of process. My head's spinning. If I seem out of it, it's because you're trying to put all these pieces together and you think, how do we create a cohesive narrative? And that's why so many people are saying, you know what, we're just going to ignore it.
If you seem out of it, which you don't, it's a market with no weekends.
Fair.
That's what it is
true.
now.
Yeah.
There is no 2 days off anymore.
It's honestly some individual in the White House who has endless energy, who does not sleep, who seems to have the ability to just keep going. He is the Energizer Bunny. Kudos to you. I am a lot younger than you, and yet here I am, and I'm trying to keep up.
Half the president's age. Still exhausted.
Exactly.
Equity futures down by about 1/3 of 1% on the S&P. No big drama here stateside. Some drama in Japan, which we'll touch on later this hour. Coming up this hour, we'll catch up with Judy Beale of Kayne Anderson Rudnick on the risk of complacency, Sol Martinez of HSBC signaling caution ahead of bank earnings, and Mark Cabana of Bank of America as pressure builds on Fed Chair Jay Powell. We begin this hour with stocks lower as President Donald Trump ramps up trade tensions. Judy Beale of Kayne Anderson Rudnick writes the following: relying on aggregated data only spurs complacency. I don't think the markets are completely appreciating the impact of these tariffs. Judy joins us now for more. Judy, welcome to the show. And I have to say, a lot of people don't, for a lot of reasons, including the headline data. We've had a string of softer than expected CPI prints. What is it that you see beneath those headlines that concerns you?
I think my real concern is that the aggregated data can have an effect of ignoring what's happening in the middle. It gives you the high end. So if you see the consumer spending data, it looks pretty healthy, but that's really concentrated at the high end. And that's even if you cross out the Bezos wedding, right? The core consumer spending data is really being lifted by the high end, which is unusual actually. And it shows that there's a lot of weakness in the middle and low end consumer. So I think a lot of the data is hiding a lot of the morass that can be really affecting a lot of companies. A lot of the other issues, too, is that many companies did such a great job front-loading their inventory and holding on to it that I think that the effects of the tariffs are actually going to take some time. Some did better than others, and so I don't think we're going to get a ton of visibility into that, even for corporate earnings. I think many will be able to say, look, we're going to take it on the chin, 20, 40, 50 basis points, but we're going to be okay for the rest of this year. And those are the ones typically that have built a lot of their inventory reserves and are just hoping that cooler heads prevail by the time we get to the end of the year.
Julie, you said that with a straight face, but I really want to dig into that. Are you saying that the Bezos wedding could actually influence some of the retail sales numbers and even inflation?
No, I'm absolutely.
Okay,
all
right. But I'm just wondering, if you look forward, right? I'm just asking you this because we are seeing that skew from higher income consumers. And I just wonder, at what point you have to see some of the inflation, or you have to see a sort of top level deterioration in retail sales to say, okay, we're seeing an effect, or okay, maybe we're not going to see an effect, and actually the United States and the consumer can absorb these tariffs without seeing the hit that many people expected.
I think it's a matter of scale, right? And so if you assume that the tariffs are on the order of 15 to 20% for the foreseeable future, which is kind of what it feels like it actually could even be even higher, that's almost a doubling of the corporate tax revenue that we should be expecting, right? Because it's very clear that our trading partners abroad are not paying for it. You would typically see their currencies devaluing if that were the case, and that's not what's happening, right? Our currency is the one that's devalued. So it's either companies are going to be paying for it or consumers are going to be paying for it. And if you look at tax receipts last year on the corporate side of $525 billion, and you look at what tariffs would be, it's comparable. So that's a large increase, and someone's going to have to pay that bill.
Do you think that people are underpricing the risk to companies outside the United States? I'm thinking of Europe in particular, as they try to grapple with rates that are still in flux, but are inevitably going to be high.
Well, I mean, I think you guys talked about this on the last hour. So much of all of Europe is really trying to figure out who can our more reliable trading partners be, right? The U.S. is kind of acting like that gorgeous girl you remember from college, right? Who just thought she was unassailable, right? And then she gets like a weird nose ring piercing, right? And she just thinks she's so hot it won't matter. It won't matter. But everyone else kind of looks at her like, she doesn't look that great. And also now I question her judgment a little bit. It has long-term effects that we might not see right away, but I think it really has changed the tenor of the discussion in Europe, where people are banding together and looking to other countries. And the same is happening in Asia as well. That's not an immediate effect. That happens over the longer term.
It does feel a bit like high school, and that's the girl who you look back and the reunions and think, huh, really, that's what happened. I am curious, though, going forward about whether you do see this from a market strategy perspective as, really benefiting the rest of the world versus the United States, or do you think that it's a little facile to make this description, given the fact that the dollar still is the reserve currency and the tech dominance still remains in the United States?
I think that's why I make the metaphor, actually, right? Because the girl is still beautiful, right? The U.S. economy is still the most dynamic. It has the most stability to it. It has the most innovation. Our universities are bar none the best in the world. There's so much in this market that is really attractive and creates everyone to want to stay in relations with. But I think there's also this recognition of diversification being good, not just for our portfolios, but for the rest of the world in terms of the stability of their trading partners. And I think what worries me is that in the US, we are not accustomed to any kind of suffering or discomfort, right? You lose your internet outage for 20 minutes and you lose your mind. Europe and Asia, for sure, most countries in Asia, they're much more used to being able to buckle down for more communal reasons, and such as kind of the own pride of your own country. That's a difficult dynamic where they may be willing to walk away from easy profits in the U.S. towards having more stability and more comprehensive outlook.
So, Julie, just to be clear, what do you like right now? What would you be buying?
Look, I still like companies that have a lot of quality and durability to their earnings. And so they're in the more kind of sleepy industries. There are parts of software that I really like where they can benefit from AI, but you may not know them very well, like a Descartes that works in trade management software. I think the companies that you want to have a lot of clarity and confidence that their earnings are going to be there. Think of like a FICO or an Equifax. Those are the types of businesses that I think you're better off owning right now.
I'm not going to ask you who the hot girl with the nose ring was at college. We'll let you go. But I'm sure she exists. That felt real. That felt real.
It wasn't me. I wasn't pretty enough for it.
That felt real. Julie, appreciate it. Julie Bill there of Kane Anderson Rudnick. Thank you very much. That and Italian GDP, ex-Bezos.
Yeah, honestly, all I can say is it does feel high school. I think that's the reason why it's an apt analogy. I wouldn't say that that's college. I think that that's high school. I hope that people grow out of that whole phase of, who's hot and who's not and who got a nose ring. Oh my God, did you see it? Like that kind of stuff? Really?
Well, to the point is, the United States is still a hot place. The economy is still chugging along, even though we're in the midst of all of these back and forth, tit-for-tat trade headlines.
On a serious note, Microsoft in the past few weeks, look what we learned here at Bloomberg, saving hundreds and hundreds of millions of dollars, shifting, I think, call centers towards AI. That's the amount of cost saving we could see, not just for the tech players, but across the S&P 500 in the next few years.
This is the reason why people are saying how tariff dependent are some of these equity valuations, even if in the short-term profits don't increase that much, which was Lori Calvasina's point in that recent upgrade of the of her S&P target.
Nasdaq futures this morning down by only 1/3%. With an update on stories elsewhere this morning, we'll get back on track with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The EU is preparing to further relations with other countries hit by President Trump's tariffs. That's according to sources familiar. The EU competition chief said it is looking to deepen trade agreements with India and other countries in the Asia-Pacific region. The bloc suspended retaliatory tariffs on U.S. goods that were scheduled to take effect today. Meanwhile, Warner and DC Studios' Superman debuted at the top of the North American box office this weekend. According to data released by ComScore, the movie grossed grossing $122 million. The film starring David Cornsweet in the dual role of Superman and Clark Kent currently holds an 82% approval rating on Rotten Tomatoes. And Sotheby's New York has a new item going up on Wednesday. The auction house will be selling NWA 16788, which is the largest piece of Mars ever found on Earth, coming in at 54 pounds. The meteorite is believed to have been blown off Mars' surface by a massive asteroid strike before landing in the Sahara. The estimated auction price is between $2 to $4 million. That's your Bloomberg Brief. John?
Yeah, Hara, thank you. Sounds like something Elon might buy, right?
I have to be honest, I think that's really cool. I really do. I don't know that I would
prefer the Ken Griffin dinosaur.
Yes. That's actually pretty wild.
cool.
Yeah, but both are kind of awesome.
That's like living the 8-year-old's dream.
Yeah,
Give an
but-
8-year-old a fortune, they'd buy the dinosaur.
It's true. It's true. And at the same time, it's just, where would you put it?
Where is the dinosaur now? Do we know?
I don't
Museum somewhere?
I don't know.
I hope.
Or maybe it's
At
in his
least.
home. Maybe it's his living room.
I'll find out in the commercial break.
At the dinner table.
Big enough. Based on some of the housing that Kenny G's got.
Yeah, that's true. Fair point.
Up next on the programme, the morning calls plus Sol Martinez of HSBC signalling caution ahead of bank earnings. That conversation up next.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
He probably should have cut rates or be on the pace we should be cutting in July. I don't agree with all this policy, but I think pushing them out and this pressure, markets aren't going to like it, the world's not going to like it. So I don't love that strategy. I think it's actually going to be a muted reaction. A shake up and kind of some different thinking wouldn't be a bad idea. Again, I'm not sure that it should be done in this kind of, very quick and rough way.
Peter Schiff of Academy, making a headline in the last couple of hours. This stood out for me. It's actually going to be a very muted reaction if they fired Chairman Powell. I have to say, that is incredibly contrarian from Peter Schiff.
A lot of it depends on A, who they replace him with, but B, the composition of the rest of the committee, because barring some sort of constitutional change, doesn't seem like the president has the ability to open up more seats or make some sort of massive change to a committee that really is a committee.
It's very contrarian because you would think the one thing that is holding the administration back from already doing this, given the fact that they have so many problems with Jay Powell, is the fact that they're concerned about the market reaction.
No problems in the markets right now. Let's be clear about that, particularly in equities. very close to all-time highs, still only pulling back by 0.25% on the S&P on the morning so far. On the session, we're down by 1/3 of 1% on the Nasdaq. That's the price action. Time now for some morning calls. First up, Morgan Stanley downgrading CrowdStrike to equal weight, citing a full valuation and rising growth expectations. Your second call from Piper Sandler downgrading Best Buy to neutral, pointing to long-term competitor concerns in the appliance and TV categories. And your third and final call from Citizens downgrading Goldman Sachs to market perform, saying the bar is high for another leg up. That stock is softer this morning, going into results. Let's stick with the financials. Big banks kicking off earnings season this week, likely to benefit from market volatility and steady borrowing costs. Joining us now is Herman Chan of Bloomberg Intelligence. Herman, welcome to the program. What are you looking for this week?
Right, so regional bank earnings kicks off on Wednesday. We're looking for a pretty strong quarter. Loan growth is going to be something that a lot of banks are going to tout, especially on the commercial side. There's been a lot of activity over the second quarter as borrowers prepare for tariffs. And then net interest margin should be fairly stable. So it's going to be a pretty strong result across the board for regional banks.
Herman, we spoke to the capital markets piece of RBC earlier this morning, Vito Spaduto, and we talked about this pickup potentially of activity in the second half. You expecting that to happen? Do we have the clarity we need for these companies to make the decisions they want to make?
I think a lot of bank management teams are talking about a holding pattern. So there is there's more optimism relative to Liberation Day in April, but they're still in a wait and see mode as to how things shake out. There's still a lot of uncertainty, but on the bright side, things are banks are seeing transactions and credit quality is holding up really well. So blue skies on that front.
Long may that continue. Herman Chan of Bloomberg Intelligence. Herman, thank you, sir. Going into earnings, HSBC downgrading JP Morgan, Goldman, and Bank of America opting for a cautious stance after a major rally. HSBC's Sol Martinez joins us now for more. Sol, good morning.
Good morning.
That's quite a downgrade going into earnings season, and some of those stocks have now got the equivalent of a sell, I believe. Just help us understand why.
Look, we just think for the universal banks and for the investment banks, valuations are unattractive given this still elevated uncertainty on the macro side. So the money centers in Goldman and Morgan Stanley are up 20 to 40% over the last 3 months. They're trading at anywhere between a 10 and 50% premium on a PE basis to their 10-year historical averages. You sometimes get the point made that they're still trading at pretty big discounts relative to the S&P 500. But they're no longer at outsized discounts relative to their history anymore. They're trading at a fairly narrow discount relative to their 10-year average, or close to the 10-year average discount relative to the S&P 500. And obviously, keep in mind that the S&P 500 is over 20 times. The composition of the S&P 500 is very different than what it was in 5-10 years ago. It's more tech heavy. It's more growth stock heavy. So you do have to factor that into your views as well. The other thing I would mention is the deregulation side is certainly a positive. And one of the manifestations of that is buybacks. Banks are going to ratchet up buybacks. We increased our buyback estimates after the favorable stress test a few weeks ago, but they're buying their stocks back at 30% higher stock prices than they were a few months ago. And in fact, if you look at our estimates, we increased the dollar value of our stock buybacks, considerably going into the results. But our share count estimates didn't really change because it was fully offset by the fact that they're having to buy back stock at much higher prices. Those buybacks are dilutive to book value per share. They're dilutive to tangible book value per share growth, and and so we're not actually the number of stocks that they're actually retiring is not different than what we thought they were going to be a few months ago when our share buyback forecasts were much lower than they are today.
A lot to unpack there. I want to just stay on the deregulation theme. And there is this theory out there that for all of those years that you're talking about, a lot of them, these banks were treated as utilities, and they were not able to really generate the same types of pre-2008 profits that really made them more of a growth sector. Why do you reject the idea that some of the deregulation would allow them to behave a little bit more in that risk-taking way that could potentially lead the profitability to be much higher?
Well, I'm not making that argument. I'm not making the argument that deregulation is not good for them. I'm not making the argument that they're going to operate with less excess capital and that there's a potential to grow risk-taking activity, whether that be market making or lending. But they're not under-earning, Lisa. These banks are making returns on tangible common equities in the mid-teen range, high-teen range. they're generating value. They're creating value right now. They're generating, we did a report a few months ago where we looked at the ROTCE evolution or ROE evolution of big banks relative to 10-year treasury rates to see kind of what the spread is. And they're not historically low anymore. So I do think ROEs are going higher. I do think profitability will go higher. But but in some of these risk-taking activities like market making, they're generating very elevated amounts of sales and trading income as it is. So they're not exactly not allocating a lot of capital there. And loan growth is a function of loan demand as well. So I don't know that you can make the case that they're going to grow lending in a really outsized way anytime soon either.
What about the other side of the balance sheet? John was talking about what kinds of efficiencies could be driven by artificial intelligence and certain technological upgrades. And we certainly have seen JP Morgan at the vanguard of a lot of that. How much could that potentially be a surprise to the upside that hasn't been fully priced?
That's a good question. I do think, and to be clear, we're more cautious on where stocks are trading at relative to the operating fundamentals. We don't have a negative view of operating fundamentals. In fact, we've been pretty positive on the backs until recently. And I do think they will get, especially the big banks, are investing quite a lot. JP Morgan was $16, $17 billion annually, to over $10 billion for Bank of America. That does give the big banks a competitive advantage over regional banks and small banks. And I do think that, if they can grow revenues even low single digits, the efficiencies they get from technology and from the benefits of scale will allow them to generate some positive operating leverage. And that's that is part of the bull case of banks, as long as interest rates don't move down dramatically. If interest rates stay here, for the next couple of years, you do get operating leverage, you do get earnings growth, you do get EPS growth in the double-digit range. I think it's priced in, but that is a benefit for these banks.
You effectively undo some of the risk premium incorporated with tariffs, but your note came out July 7th.
Yeah.
That was ahead of this new end date we had timeline for the Trump administration. Now they punted to August 1st.
Yeah.
Do you need to put back in some concern about tariff?
That's a good question. You read the research now.
Page
yeah, we
4.
did. We did reduce our cost of equity forecast. That's nice. I don't think so at this point. But our call is that valuations are not attractive given still elevated macro concerns, and that is obviously one of them. I can't predict what tariff policies is going to be, but I do think the macro dynamics there is more risk than there typically is. And if you do see tangible evidence that tariffs are going to move higher and that it will affect economic growth, then yeah, you have to factor in that risk premium that we built in early April, then undid, and now you're doing again, right? But so if tangible evidence emerges that it is having a real economic impact, then we'll have to think about, what kind of risk, what kind of cost of capital we incorporate for these banks.
So this is Bloomberg. We always read the note. It's good to see you.
That's great.
Good to catch up. Thank you, sir. So
right.
there of HSBC. A little bit of news for you. Over the weekend, you saw that full court press. The administration going after Chairman Powell, putting the pressure on him big time, from the president to the vice president to the NEC director, Kevin Hassett, with regards to, of all things, the renovation project at the Federal Reserve's HQ. This from Axios this morning. The Fed Chair Jay Powell has asked the central bank's inspector general to review its $2.5 billion headquarters renovation project, which has become a key focus of Trump administration attacks. This according to a source familiar with the matter speaking to Axios. That's the latest on that front this morning.
Because he's getting a lot of questions about it. He wants to talk to the Inspector General, make sure he has the answers for why it is over budget.
Up next on the program, we'll catch up with Mike Dowda of Roth Capital as investors await key inflation data. Plus, you hire her back with your morning movers. Autodesk gaining after dropping M&A plans.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Yeah, up and about 60 minutes away. Here's a flavour of the stock action so far. We're down about 0.2% on the S&P, down by 0.25 on the Nasdaq 100. In the bond market, yield curve steeper. Yields higher at the long end on 10s and on 30s, up by 2 or 3 basis points on a 10-year and a 30-year. Check out Japan, though. The epicenter for global bond market jitters at the moment. Yields higher across the curve steeper, up 10 on 30s, up 6 on 10s. That 10-year last summer was 80 basis points at one point. We've doubled in the last year.
And it comes on fiscal concerns with politicians promising more spending. The global implications here are significant because the Japanese buyer had nowhere to go but outside of their nation for yield. If they can get yield at home and that flood of cash stays within the boundaries of Japan, what does that do to the rest of the global bond market that has relied on these investors to prop up their own prices at home?
Not just bonds, but foreign exchange as well.
Exactly.
That dollar weakness story we've seen so far this year, that might have legs, particularly against the Japanese yen.
And how much does that really affect the inflation story in the United States? Because anything that we do import would be on the margin more expensive. Is that one venue, one way to offset some of the tariffs and pass the cost along to the ultimate consumer?
Dollar yen this morning, 147.36. With 1 hour to go until the opening bell, let's get away from bonds just for a moment. Let's get back to the equity market and get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with shares of Autodesk. They are up nearly 7% here on our reporting that the software provider is no longer pursuing a takeover of its rival PTC. Talks of a deal had weighed on the stock in recent weeks, but no longer. But this deal, well, this merger would have ranked as one of the year's largest deals, not just in the software space, but overall. Next up, we have shares of Kenvue. This is the company behind Tylenol, Neutrogena, and Listerine. Shares are up nearly 6% as the company announces a string of changes as it faces mounting pressure from activist investors. The current CEO will be leaving, replaced by an interim CEO as they begin the search for a permanent replacement. Kenvue is also saying that it is looking for ways to simplify its portfolio. So another consumer goods company announcing some changes. And we end with Stitch Fix also surging up 7.6%. This is the company that gives you a personal stylist and sends you clothes. Well, it got an upgrade by analysts over at William Blair. Now they have the stock at an outperform, saying that they're gaining confidence in the new CEO's turnaround strategy. And I will note that this stock is up nearly 40% since its April lows. John?
Yahira, thank you. Some of the names to watch going into the opening bell. Lots of data to watch through the week ahead as well. Busy week. It includes CPI starting tomorrow. Later in the week, retail sales and jobless claims. With a look ahead, here's Mike McKee. Good morning, Mike.
Good morning, John. It is going to be a very, very busy week and an important one, too, for the Fed because much of the data are going to inform their decision that they have to make at the end of the month, the July meeting at which the president is going to expect them to cut rates. Unfortunately, the data are going to suggest otherwise, probably, at least according to the Bloomberg survey forecast. Tuesday, we get the CPI, and it's expected on a year-over-year basis to rise by a couple of basis points up to 2.6% from 2.4% now, and that would essentially essentially preclude any move at the end of the month. PPI may also show an increase, especially given the increase in equity trading over the last couple of months. The portfolio management category might be something to watch. We get the beige book, the anecdotal reports about what people are going to be doing, companies are going to be doing. And then, as you mentioned, retail sales. Retail sales expected to slow. That's a thumb on the scale. On the other side, we'll see. We get jobless claims. Do they start to move or not? And we'll see what Michigan sentiment tells us about people's thinking on inflation. The thing we want to watch for tomorrow is a pass-through of some tariffed goods into inflation. We haven't got much so far because there haven't been that many tariffs, but take a look at some of the categories to look for, even if we don't get a big move on CPI as a whole. Vehicles, parts, apparel, electronics, furniture, and household appliances, all things that come from foreign countries here. And then here's an interesting one, beer and soda. I'd sort of forgotten about this, but the tariff on aluminum raises the costs of the aluminum cans they come in. So those could go up as well.
Mike, the last read going into the next Fed meeting, there are some on the committee that might vote for a rate cut at the end of July. The chairman, based on his communications so far, certainly won't. He came in for a ton of criticism over the weekend, Mike. It looks like a new line of attack. Discussion so far this morning is the price of firing the Fed chair. Not a base case at the moment, still a risk and something we have to explore, Mike. How are you thinking about that at the moment?
Well, my guess is the markets would react quite negatively. The first question is going to be who takes over. And if it's one of the Kevins, as you've heard in a lot of the research, that might provoke a bad reaction from the markets. Now, if the president were to fire Powell, I don't think anything will happen in the short run in terms of the Fed, because the Fed will go to court to try to prevent it. The Supreme Court's already given them something of a carve out. And if you're going to fire somebody for a cause, you have to prove it. And I would just point to everything that's been happening in the courts and with Donald Trump. It takes a very long time. So this could take us into next year or longer for any kind of resolution. But if he were to have to leave, then John Williams would temporarily take over as the chair of the Open Market Committee, which is what's important. And Philip Jefferson would take over as the chair who runs the rest of the Fed. So there are procedures in place to keep the Fed going. It's a question of whether and when it could happen.
Mike McKee on tour. Mike, you enjoy yourself. It's good to see you. As always in a cabin somewhere.
So there are 2,000 people who live in Victor, Idaho. I had no idea. I was looking.
What is he doing in said Victor, Idaho?
I don't know, but it looks really beautiful. It looks like it might not have snow there.
Because he has the fireplace on, and it's very hot right now in New York.
We've said it a few times on this program. This market will get a vote on all of this long before a court decides or the Senate has a confirmation hearing. This market will get its vote.
At this point, though, the market needs to see the whites of the eyes of some reality versus just jawboning, because this market is sort of immune to some of the threats, just simply because there have been so many, and they have been fooled so many times that they just really don't want to get faked out again.
Tomorrow, we get some data. Mike Dada of Roth Capital writing this. Given the Fed's wait-and-see approach, prospective CPI readings may take on greater importance for risk assets in the months ahead. Mike joins us now for more. Mike, welcome to the program, sir. What are you expecting tomorrow morning?
Thank you for having me back on. So consensus is expecting a 0.3 rise, both headline and core. So I don't really think that is going to change the mood on the Fed. It's a very divided committee, as you guys were just discussing. I'm not super worried about a big inflation spike here. And the reason I say that is bond market inflation expectations are very low and steady. Some of the higher frequency data actually looks pretty good. There's a gauge called Trueflation, which is based on 80 million prices in blockchain technology. Super high frequency. So we have, year over year readings extending into almost mid-July here, 1.7%. So I don't think we need to worry about a repeat of that 3-year inflation overshoot, which was really an aggregate demand monetary policy story. The tariffs could definitely create some inflationary headwinds, but I think they are temporary, and the Fed probably is best to just look through them.
If that's the case, Mike, do you see this as a time for the Fed to be cutting, especially if this CPI print that we get tomorrow shows that ongoing disinflation, or at least not an inflationary trend?
Yeah, I think so. I think they're getting much closer to that point. Probably September. That's what markets are priced for. Fed funds futures are priced for just under 100 basis points of rate cuts over the next year. That sounds like a lot, but it's really not over a 12-month period if the economy is softening a bit at the margin. And I think, some of the data suggests that's the case. Not falling off a cliff for sure, but we are seeing a little bit of softness at the margin with, the most recent jobs numbers. And also, it looks like GDP underlying growth, real final sales to the private sector probably ran around 1% or so in Q2. So that's much softer than what we've seen over the course of the last 2+ years. So I don't think it's inappropriate for the Fed to be starting to consider lowering policy rates here. But I will say this, the hectoring from the White House is wholly unhelpful. I mean, even if the administration were to convince Powell to step away from the Fed and, this stuff about the construction project is just a fig leaf, it's pretty obvious what's going on here. It's completely out of line in my view. But even if you were able to convince Powell to step down and someone else takes over, it's a committee. They operate by consensus. So it's really very unlikely to dramatically change the rate path in any event. So
hold on a second, Michael, because this is actually one key question that the market has, right? That people are questioning whether the market is pricing in some sort of firing of Fed Chair Jay Powell, and would it have that big of a reaction at all? Peter Scheer was saying no, that it is a committee and that people would look through that. How much does it complicate a message that actually would go the president's way if he's followed the economic data, at least in your opinion? How much does it complicate that kind of messaging from a Fed that wants to appear independent?
Yeah, that's a great point. I think, if anything, this hectoring and the political pressure probably makes it more difficult for the committee to move forward with rate cuts. And because they don't want to be viewed as, a bending to political pressure. So I think, if anything, these kinds of shenanigans are likely to backfire. And it sets a terrible precedent going forward. I mean, the Fed should be an independent institution. We can look back at what happened with President Nixon when he pressured Fed Chair Burns to inappropriately run easy monetary policy, setting off a decade of inflation, which eventually culminated in double-digit interest rates. We saw a situation in Turkey where President Erdogan tampered with the central bank, wanted low rates, easy money policy, a currency collapse, and hyperinflation followed. So let's get back to basics. If you want low market interest rates, what do you need? You need price stability, and I think the Fed is well on their way to achieving that in terms of on-target inflation. And you need budget integrity. And the Fed has nothing to do with that. In the administration, in my judgment, and Congress are certainly not on that path with the so-called big, beautiful bill that was miles and miles away from an optimal outcome.
Jonathan's been talking about this Deutsche Bank note about the risks of, if Powell was to be ousted, are underpriced. What kind of market reaction could we see if we've come to that point?
Well, it's very uncertain. I think it's just a matter of setting a very bad precedent of political tampering, or the attempt to tamper with an independent Federal Reserve. And you look back at history, and politicized central banks don't achieve optimal outcomes. They might do something that helps the sitting administration in the short run. In the long-term, price is paid by the public in terms of higher inflation and lower real income. So it's really not the path you want to be going down. Very hard to say in terms of the very short term. I mean, what happens even if Powell were to step down? I don't think it really changes things dramatically in terms of where the Fed is headed here, given that it's a committee and the administration's not going to be able to completely politicize a majority on the committee anytime soon. That said, it's really a move in the wrong direction. It's totally inappropriate, and they should just stop it.
Mike, just to put a bow on it, given all the risks we've talked about, why are market-based inflation expectations so well anchored?
Well, I think they're well anchored because the Fed has achieved quite a bit of credibility here, right? I mean, they obviously had a big goof in 21-22 where we had inflation shoot up to 40-year highs. But, they ended up correcting that with 550 basis points of rate hikes, and we're somehow able to achieve a soft landing, avoid a recession, and now inflation has come down to much lower levels historically. So the bond market is giving the Fed the benefit of the doubt. The institution has really regained and re-anchored its credibility, and that's another reason not to tamper with the Federal Reserve in a political way, because if that credibility is lost, it could be very difficult to re-achieve. They certainly got very fortunate with this episode a few years ago. You know, why keep playing Russian roulette with credibility? It doesn't make any sense whatsoever.
Mike, appreciate your time. It's been too long. Let's do it again soon. Michael Dowder there of Roth Capital. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. We start with the latest on the flood disaster in Texas. The search for victims has resumed along the Guadalupe River after recovery efforts had to be put on hold yesterday following another round of heavy rains. More than 160 people may still be missing after the July 4th floods that left at least 132 people dead. Meanwhile, President Trump will head to the UK for his second state visit of his current term. In September, King Charles III will host the president and the First Lady at Windsor Castle from September 17th to the 19th. Trump called the invitation an honor and said the king was a, quote, beautiful and wonderful man. And 24-year-old Aussie Grace Kim produced one of the most impressive comebacks in golf to win at the Evian Championship in France. The former Youth Olympics champion recovered from 4 shots behind in a dramatic final round to defeat the world's #2 Gino Fittipaldi. In Kim's 3rd season on the LPGA, she only had 1 top 10 finish in her previous 11 starts. That's your Bloomberg Brief, John.
Yahira, thank you. Appreciate it. Thanks for this morning. Up next on the program, we'll set you up for the week ahead, plus Mark Cabana at Bank of America, as the pressure builds on Fed Chair Jay Powell and why they don't think this Fed cuts this year.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, And if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
I'm still relatively optimistic we'll land somewhere with the European Union. The Mexico letter was a bit of a surprise to me, given that they weren't negotiating one of these full reciprocal deals. It was really about steel and aluminum. But that said, we've got 2.5 weeks to go, and I expect to see a bunch of deals. And for those countries that don't have them, I expect to see those tariff rates go up.
That was the former senior White House trade advisor, Kellyanne Shaw. Her message this morning: the weekend's news is not for you. It's not for you. It's for trade partners. This is a negotiation. It will continue for the next several weeks and maybe beyond.
And guess what? The markets got the message before she even said it, because they said, look, we've seen this movie before. We're not going to freak out. We're still having a beer on the beach, and that's kind of where we are this morning.
No freak out at all. 41 minutes away from the opening bell. Equity futures negative by just 0.25% on the S&P. Similar move on the Nasdaq. Likewise on the Russell. The Russell, the small caps, down by 0.4%. As we count you down to the opening bell, your week ahead looks like this, and what a week ahead. Later on today, President Trump to make a statement on the Russia-Ukraine war. Tomorrow, CPI, plus JP Morgan, Citi, Wells Fargo kicking off bank earnings. Wednesday, PPI, more bank results from B of A, Goldman Sachs, and Morgan Stanley. Thursday, retail sales, plus another round of jobless claims. And heading into the weekend on Friday, you, Mitch, consumer sentiment. Fed Chair Jay Powell under increasing pressure from this White House. Mark Cabana of Bank of America writing this: recent soft inflation readings raise questions of whether tariff inflation will emerge. If it doesn't happen by the September FOMC, the Fed may have to give up the tariff inflation ghost and start cutting. Mark joins us now for more. Mark, good morning.
Good morning.
That's not your base case, though, is it?
It is not the base case. The base case is that we will see inflation emerge, and we think we'll see some signs of that tomorrow. We think that what you will see in CPI is that there are a bit of uptick in core goods, especially with used cars. We think that you'll see some core services tick up as well. And we think that that'll give the market a bit of pause and cause the market to really ask itself, can we justify these 15 or so basis points of rate cuts that are priced in September, or almost the 2 full cuts that are priced by the end of this year? And we think the market will realize no. And then furthermore, on Thursday, when we get retail sales, our credit card data is pointing to a rebound in consumer activity. Our economists have core control, I think, at 0.9 month over month. Consensus is 0.4. So if you get both of those things, a bit of an uptick in inflation and signs that the consumer is stabilizing a bit, we think that there are very good cases for a market to start to question whether or not the Fed should be on hold. And let's not forget the fact that the most recent unemployment rate reading that we had was 4.1%. If you look at the full range of outcomes that the Fed has in the summary of economic projections, the lowest unemployment rate reading at the end of this year was 4.3. So we're out of bounds as far as a tight labor market is concerned right now with regards to the Fed's projections. So if you start to see this combination of data, then the market's going to start to pare back more meaningfully the almost 50 basis points of rate cuts by the end of the year. We think that'll result in some modest upward pressure on rates, some modest flattening bias on the curve, and we think it's going to justify our 10-year forecast for the end of the year at 4.5%.
So you believe in tariff inflation, not necessarily the ghost of tariff inflation. You're sort of rejecting the disinflation deity. I have to give you just a round of applause. Really, that was fantastic. Good job. But I'm just curious, at what point, if you do not see the inflation pick up, do you have to rethink your thesis?
Yeah, so as Jonathan noted, that quote that we posted, at some point, if you don't see it, the Fed's got to start to give up the ghost. And there are 3 CPI prints before September. September may well be the time. Now, I do think that we're all looking for tariff-related inflation. No one exactly knows when it's going to show up. There are anecdotes that say, especially if you talk to our retail analyst, Lorraine Hutchinson, she's been saying, why would you expect to see tariff-related inflation right now? Because retailers are still selling inventory that was acquired pre-tariffs. If you look at the most recent FOMC meeting minutes, there is a line in there that says something very similar. So the Fed is here. Call it a deity, whatever you want to. I do think that those anecdotes really matter, and the Fed is going to rely a lot on those. And given how pronounced it showed up in the minutes, if you go back and read that tariff-related paragraph, it sounds like they're hearing this not just from one or two individuals in the economy. It sounds to me like they're hearing it on a pretty broad-based level.
So in the realm of hypotheticals, of ghosts and deities, there's this question of what happens if the Fed cuts rates by 1 or 2 times this year. And you do see that stickiness in inflation. What happens to the long end of the yield curve?
It should steepen. You should price more inflation risk premium, much more than you're seeing right now. And that's one of the reasons why we like being long intermediate tenor inflation. If you look at the inflation swaps market, or if you look at break-evens right now, much of the inflation is really priced in the first year or so. So the markets believe that inflation is just a one-time impact. It's going to come and go, and then we're going to be back at 2%, no problem. But I think what we're seeing is that you're not getting that one-time shock as cleanly as you thought, right? If you listen to Fed officials and most economists talk about inflation, oh, it's a one-time shock that the Fed should just look through. But we're not seeing it as a one-time shock right now. We're collecting tariff over $100 billion that we're collecting this fiscal year. It's a lot more than last year. So the revenue is being collected, but we're not seeing that clean impact straight away. So why should the market think that we're going to see a clean drop-off in 1 year's time? The risk to us is that we see a more persistent impact of inflation, less sharp in the near term, but it very much could stick around for a while. And if you look at some of the supply disruptions that we had with COVID, we all looked at the supply chain disruption index. The New York Fed has one, others have some. It went up quickly and then it faded real fast. But inflation went up and then it stayed somewhat elevated. It came down quite slowly. And we do see risks that you're going to see that with inflation. And businesses are extremely thoughtful and savvy about how they pass this through. So why would we think that it's just going to go up and down nice and neatly? We don't. We think that you want to be long inflation in the belly of the curve. It's not pricing that type of outcome. And we do think that if the inflation sticks, it's going to be around with us for quite some time. It's going to make achieving 2% inflation for the Fed a lot harder than what the market is likely pricing right now.
45 seconds on the clock. You had a word there, the long end of the curve. I want an additional one from you on T-bill auctions versus coupon auctions. How's that going to change in the next 12 months?
Yeah, so we think, and our clients believe, that the U.S. Treasury is going to rely a lot more on short tenor issuance versus long tenor issuance. We titled our weekly this past week, "The Wambulance to the Rescue," because I know you like that, don't you? I did. Katie Craig, shout out on our team, great title. But the market believes that the weighted average maturity, or the WAM, of the U.S. Treasury debt will be going lower. And if Scott Bessent has been charged with lowering long tenor issuance, he doesn't have a ton of tools, but issuance is a really big one that he has. And so there's all this focus on WAM right now. And there was an extremely elevated amount of focus.
I wish I hadn't asked because I'm running out of time.
Okay, just give me a few more seconds. But
literally got 10 left, and that's it. Then it goes bang, and commercial break begins. Mark, I got to go.
Okay,
I appreciate it.
WAM, shorter.
Mark Capana, Bank of America. It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in.
No,
They think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years, and how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
And futures are down. Trade worries back in focus. 30 minutes until the start of trading. I am Shanali Bassett.
And I'm Danny Berger. Matt Miller and Katie Greifeld are off. Bloomberg Open Interest starts right now.
And coming up, dialing up the pressure. President Trump announces a 30% tariff on imports from the EU and Mexico. Meanwhile, the president and his allies open a new front against Jerome Powell, criticizing his handling of renovations at the Fed headquarters. And the view from corporate America. Wall Street braces for the weakest earnings season in 2 years. Danny, it's crypto, though, that's taking it away today.
It is. If you were looking at risk assets, you'd be surprised to know what crypto is doing today. Trading above 122,000. And all those crypto-linked stocks, they are soaring with that all-time high in Bitcoin. Shanali, Congress currently weighing multiple crypto bills this week.
You know what? We're also looking at M&A. There's a lot going on under the surface, spin-offs and activism. Kenvue is making board director Kirk Perry its interim CEO effective immediately as the company announces a strategic review on the heels of activist interest. But back to this morning's big headline. President Trump threatens that 30% tariff for Mexico and the European Union. However, he's keeping his door open for a deal.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
For the latest, we're joined by Bloomberg Washington correspondent Tyler Kendall. Bring us the latest and how this is going to play out through the course of this week.
Yeah, hey, Shanali. Well, now that all of these trade letters have been sent out, we're waiting to see how negotiations are going to evolve from here. And of course, the big news over the weekend was that 30% tariff threat against the European Union. And we heard from the EU's trade chief saying that he will speak with his U.S. counterparts later on today. And the EU is going to hold off on its own retaliation until August 1st to let these negotiations continue. But a really key point here is that he went on to say that there is a new sense of urgency, in his words, for the European European Union to engage with other trading partners. And Bloomberg News broke the story this morning that contact with other nations, including Japan and Canada, could be used for potential coordination between the nations against the U.S. We know that the EU Commission President Ursula von der Leyen, for example, today is meeting with Canadian Prime Minister Mark Carney. And it's also worth pointing out the EU did reach a tentative trade framework with Indonesia over the weekend, as we expect them to start to sort of shift focus here to perhaps Southeast Asia countries as well as the Pacific. Now, the 30% tariff is, of course, much lower than the 50% tariff that the Trump administration had been threatening. But still, our understanding has been that there was progress in these talks when it came to the European Union. Shanali and Danny, as you well know, the sector-specific tariffs enacted under Section 232 on the grounds of national security concerns really are a big sticking point here. The EU wants to see movement on autos, but I would also point you to the fact that some of these tariffs that haven't even come into play yet, like pharmaceuticals, are still hanging over these negotiations.
Meanwhile, in Washington, D.C. over the weekend, Tyler, it was a White House that continued to step up its criticism of the Eccles building, of the renovations happening there for the Fed. Is this a White House trying to lay the groundwork in order to oust Powell?
So this does seem to be a new argument that the White House has added to their list of criticism that goes beyond the idea of economic stewardship or the demand to lower interest rates. And the president and other members of his administration, including the NEC Director Kevin Hassett, as recently as this morning, are elevating this accusation that you're discussing, that the head of the Federal Housing Finance Agency, Bill Pulte, is alleging without details that Powell misled Congress during testimony about recent renovations to the Fed's headquarters here in Washington. This would appear to be setting perhaps the legal basis for a case to remove Powell, which would, of course, have to reach a very high standard. But now you have administration officials calling on Congress to investigate this particular instance. Now, we should say that Powell has said that the renovations were not extravagant, and a Fed official says that all of Powell's testimony has been truthful. In fact, the Fed is actually saying that the renovations are going to help lower costs because it will consolidate their operations. But we do have the latest figures, with critics pointing to rising costs. The Fed's budget documents show estimates for the projects have risen to $2.5 billion this year, up from an estimated $1.9 billion in 2023. These are the sort of arguments that the administration is now focusing on.
Tyler, really appreciate that update. That is Bloomberg's Tyler Kendall out of Washington. Now, elsewhere, U.S. markets, they will be facing a tough test. Corporate America is gearing up for the unofficial start of the second quarter earnings this week. Big banks will be leading the way. J.P. Morgan, Wells Fargo, Citi, all of them report tomorrow. Joining us with some of the themes to look out for is Bloomberg's equity reporter, Alex Semenova. Alex, what are you looking out for?
Hey, Danny, with stocks trading near record highs, investors will be glued to corporate America's report cards when they begin firing them out this week. Wall Street is actually bracing for the weakest earnings season since mid-2023. Analysts see second quarter profit growth of 2.5%. This is according to Bloomberg Intelligence data. The good news is that low bar gives scope for companies to surprise to the upside. Tariffs, of course, will be a key focal point. Analysts don't expect a material impact on company profits just yet, but they will be monitoring guidance to see how executives have handled sporadic tariff announcements. Margins will also be key. BI analysts expect S&P 500 net income margins to hit their lowest level since the first quarter of 2024. The good news is that impact is supposed to be fleeting, with margins expanding again next quarter into 2026. And of course, big tech will be a key focal point among investors. That group is still in the driver's seat. The so-called Magnificent Seven stocks are expected to post a 14% rise in profits in the second quarter. If you take out that group, S&P 500 profits are expected to slightly contract by 0.1% in the April through June period. That, of course, shows the influence that this group has on this equity rally. And AI spending has also kept up, even despite all the uncertainty around trade and macroeconomic conditions. One more important point is a weaker dollar is a welcome development for U.S. exporters. Morgan Stanley strategist David Adams called the weaker dollar a substantial and underappreciated tailwind for U.S. earnings, particularly for the large cap companies. Guys.
Alex Semenova, thank you so very much for keeping an eye on earnings season for us. We'll get more from you throughout the week. Let's dive into earnings more now with Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. When you look at the divergence between big tech and the rest of the S&P 500, how should investors be thinking about what will be hard hit so far in the tariff strategy that we see that keeps changing?
Yeah, it's a really, really tough call at this moment. I think it's been very tough for analysts in particular, where you saw analyst expectations just get crushed over the last 3 months. Most of that was in April and May, and they have yet to really rebound. We've not seen analyst expectations really come back. So there's a really great chance that expectations are very, very low for the second quarter, in particular for the banks, which really kick things off. There was an assumption in the analyst estimates that you'd see some pretty significant loan loss provisions emerge with the second quarter earnings season. Analysts did not take that back, so the banks are expected to post 9% decline year over year in earnings. A really rough earnings season relative to the rest of the index, which is expected to post about a 3% gain.
So a very low bar, something like a 3% gain. We're looking at the most expected weakness from earnings since mid-2023. But Gina, does that even matter if a bar is low, if we're trading at something like 24 times forward earnings?
I think that's a really good point, because you also have this conundrum of a divergence in what's trading so expensively. It really is mostly tech that is trading so expensively in the index, but financials is right there with tech as well. So you've got very expensive valuations, at least compared to recent averages. Some embedded assumption that financials is going to move into sort of a less regulated, more growthy kind of phase over the course of the next 12 months. That combated with a likely beat in the second quarter creates a little bit of a mix. When we get later into the season, tech earnings are going to be fascinating, because this is a space that is expected to basically hold up the index. Outside of tech, expectations are for a decline in index earnings on a year-ago basis on the second quarter. But tech is expected to really carry a heavy burden. That is also embedded in valuations. The expectations are very high for tech. Unlike the rest of the index, this is a very big outlier. So I think you're going to see a really big sea change as the season progresses, as you move from one industry to the next. Extremely low expectations for reporters in the early part, but much higher expectations as you get closer to the tech reporting.
Speaking of industries that have run up, if we look at the S&P 500, pull up the industries that have been rising throughout the course of the year, you can see industrials, yes, still info, tech, utilities, also materials, getting big run-ups as well.
Yeah.
How will they fare, given that they've already been given such a big bid by investors?
Yeah, I think it's been, if you decompose that into what's actually happened in the index, you've got a tale of two worlds. You've got pre-tariff announcements in March and April, post-tariff pause, and now we're moving into the pause is ending. So there's really several phases that have occurred in the markets. If you were to look at that chart back in April, you'd find that tech was a material underperformer in the first part of the year. Then we have pause, the tariffs emerge, the pauses emerge of those tariffs, and that's created a surge back into tech stocks, which have been basically the market's safety play in the pause era. If we go back to a post-pause era, you're going to see a disruption in trends as well emerge again. And I think that that's what we face in the third quarter is now we have tariffs reemerging. No one believes they're permanent. That's very clear in prices. If they become permanent, even for a short period of time, that's a big disruptor into the second half, where expectations are for recovery to emerge for the index at large.
Yeah, you really feel those warnings of maybe it's a market complacence starting to crop up. Gina, thank you so much for joining. Really wonderful to get your take this morning. That is, of course, Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. And a quick look on futures. Yes, we might be concerned. Yes, we might have gotten more tariff letter bombshells over the weekend. But maybe you'd be surprised to know that futures are only down 1/3%. They've been hovering around these levels all morning, Shanali. The NASDAQ down 1/3%, maybe Russell 2000 futures a little bit weaker. It has been Peter Scheer writing a note over the weekend saying that this isn't complacency that tariffs won't hurt equities. Instead, it is a market that is just looking for some de-escalation.
Yeah, and we should remember that the index actually ended last week 0.3% lower as well. So now we are extending some of that negative attitude. Listen, some movers this morning. Really interesting movements under the hood. We're looking at Boeing shares. They are climbing after a preliminary report of last month's Air India crash found no recommended actions to take against the company. Boeing up about 1.4%. And I promised you some deals. This one's a Bloomberg scoop. Kraft Heinz, big news in the consumer sector constantly over the last couple of weeks. Kraft Heinz is preparing to break itself up to combat shifting consumer sentiment, according to people familiar with the matter. And Kraft Heinz only up about 0.8%. Autodesk is another one, Danny. This one's really interesting, up 6% because it's no longer pursuing an acquisition of PTC, also according to sources familiar with the matter. Really fascinating. Sometimes the deals you don't do are worth as much as the deals you do.
And the bankers will still get paid for at least having investigated it. So good news for them. All right, coming up on the show, Elon Musk says Tesla shareholders will vote if it will invest in XAI. We're going to bring you the details next on Bloomberg Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
To the minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
And now to high interest, a look at what's making headlines around the world. NVIDIA CEO Jensen Huang said the U.S. does not need to be concerned that the Chinese military will use his company's products to their advantage because they know the risks. Huang says the strategy of restricting technology exports to China will backfire and spur domestic chip growth in China instead. And Tesla shareholders will vote on whether to invest in Elon Musk's XAI. He made the statement in response to an account on X that said the car maker must be able to invest in XAI to be fair to Tesla's retail investors. Musk didn't say when the vote will take place or offer other details. And Google will pay about $2.4 billion for top talent and licensing rights from the artificial intelligence startup Windsurf. This is after the collapse of Windsurf's agreement to be bought by Google rival OpenAI. That deal fell apart because of tension with Microsoft, a major OpenAI investor, Danny.
You know what that says to me? If you're looking at investing in an AI startup, why would you ever do it? If it's really good, Google or someone else is going to come swoop in and take all of your top talent and probably just collapse the company, more or less. Now, we also have some other movers on our radar this morning, and it is all about crypto, Shanali. Look at some of these moves. Coinbase up 1.5%, Marathon Holdings up 3.6%. Bitcoin crossing over the $120 mark. For the first time, the House will debate and possibly vote this week on the Clarity and Genius Acts. Just more things to really solidify the use of crypto. But you already seen some people this morning basically saying, look, it shows that crypto is a great hedge. When stocks go down, you can buy crypto. I'm not sure you can make that argument if it's Congress that seems to be moving crypto and Bitcoin this morning.
A lot could move forward this weekend in the coming months, but also a really interesting statistic about just how much Bitcoin has run up. At the market value that it is breaking into the world's most valuable assets. So that's the top 5: gold, Nvidia, Microsoft, Apple, then Bitcoin. So there you have it, Danny. Hard to ignore.
It's hard to ignore, but the problem is if this thing is volatile, you need shelter from what has been an extremely volatile market. Silver also trading at an all-time high. This is a market that is desperate for hedges. If a dollar isn't working for you, if it's a bond market more volatile, what can you turn to? So it gets this real desire for the crypto bulls to say, hey, we're part of this. But again, history would tell you that the volatility is something that's very difficult to touch.
It's linking closer and closer to the stock market when you have all of these Bitcoin treasury companies listing as well. And so there you have it. We're watching the crypto stocks, but also it's kind of the hot trade in terms of SPACs, mergers, and IPOs. So let's see how long that lasts. We saw the last SPAC boom come and go pretty fast. We're going to talk about high valuations next. Stick with us. We're going to talk about shrinking margins. We're going to talk about normal way companies, not Bitcoin ones, with this earnings season coming up right around the corner. Citi's Stuart Kaiser is joining us next. This is Bloomberg Open Interest.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Wall Street is bracing for its weakest earnings season since mid-2023. Strategists say that this is a stock picker's market. Morgan Stanley strategists say that investors should be more selective as views become more divergent. They prefer financial and industrial sectors due to strong earnings upgrades in recent weeks. At the same time, RBC lifted its S&P 500 year-end target to 6250 from 5730, though it remains neutral on stocks for the second half, expecting choppy conditions. Let's now bring in Citi head of U.S. equity trading strategy, Stuart Kaiser, to talk about all these views. But first, I want to show you something we were talking about in the commercial break, just how divergent stocks have been, the ones that are least exposed to tariffs and the ones that are most exposed. Because the ones that are least exposed, you see them soaring, right? And certainly since the April lows, but all year long, almost 20%, while the ones that have been lagging are still down almost 5%. Do you expect earnings season to pick this stock further apart, that the best will do better and the worst will do worse based on the tariff implications?
It's a good question. I mean, last earnings season, about 2/3 of companies said we don't know and kind of left guidance unchanged. So I think, that chart is frankly going to really be driven by what clients say, what companies say. Do they give us more insight into potential impact on revenue and margins, or do they kind of punt again, and do investors sort of tolerate that? So it's a tough one because you just extended the deadline out to August. So most companies are going to say, they just don't know. In my opinion, I don't think Wall Street should tolerate that again. I mean, I think if you're running an S&P 500 company, you should be able to give guidance on the outlook, and you would expect companies that punt to kind of be punished a bit this quarter. But again, they weren't last quarter. So a little bit of a wait and see. To be fair, I do think tariffs are at this point being treated as a buy the dip opportunity. And I would not expect that really to change at the macro level unless China-U.S. negotiations really break down.
Yeah, even some hard-hit sectors. You had Delta come out with guidance. It kind of makes it tough for everybody else, doesn't it?
Well, it's not only Delta, it's Amazon talking about how successful of a Prime Day they had. Stuart, there's been some real resilience among these companies, especially those exposed to the consumer. Is there any reason to believe that would change this quarter?
I mean, not necessarily. Unemployment rate remains pretty low. Job growth remains pretty strong. So it doesn't look like that low-end consumer is being hit that hard at this point. So in that sense, yeah, it should work. But if you go back to Walmart a couple quarters ago, they basically said, in a post-tariff environment, we think our cost advantage is at least as large. So to Shonali's point, there may be winners and losers at the stock level, but that doesn't necessarily mean the low-end consumer is under as much pressure as I think people fear that they might be.
So what does this mean for surprises? What's not being baked into the market today that could come up during earnings season?
It's interesting going into the earnings season. The earnings bar is actually relatively low. You're at kind of mid-single-digit EPS growth, which on both quarter-on-quarter and year-on-year. That said, that bar is actually higher than last quarter. So, there's a lot of moving parts here. What's not baked in? I think what's not baked in probably is companies coming out and saying, we're good. A 10 to 15% effective tariff is manageable for us, and we're leaving guidance where it is, and the consumer is maybe behaving better than expected. So it could be that the right tail is not effectively priced this time, whereas last quarter, I think you might have thought that the left tail wasn't.
But it's interesting, to your point, you had more companies punting than actually giving any sort of guidance or scenario analysis. But Stuart, it wasn't that they weren't only not punished for punting. They were punished if they gave some sort of outlook that suggested that they could be hit by tariffs. If companies don't know right now, what would be even the incentive to give a view into that lens, to say we will be hurt by X amount, if this is a market that is very willing to punish them for saying so?
I think it really boils down to, how much confidence do analysts and investors have in their own ability to forecast. So I think last quarter, people gave companies a pass because they also didn't know, right? Well, people have spent the last three or 4 months trying to figure out, right? So if analysts feel like they have a very good view on the impact on a company's sales and margins, and the companies themselves say, oh, we're gonna keep guidance where it is, I think those companies will kind of be under a little bit of pressure. So I think the risk here is last earnings season, analysts, the Fed, economists, policy makers, I think all had a tremendous amount of uncertainty, and for that reason, you were given a pass. That level of uncertainty is kind of squeezed in tighter now, and I'd be surprised if you were kind of, quote, given a pass at this point if you don't give a better update.
Stuart, you're going to stick with us. That is Citigroup's Stuart Kaiser. We are about to head into the open. Of course, we are looking at a down day in the S&P 500. Danny, really interesting here. You have the S&P 500 futures not as low as they were a little earlier, but still 0.2% lower. Of course, yields are higher as well today. You have the 10-year well above 4.4%. You're at 443. Risk appetite is not showing up in the market, at least today, ahead of earnings season with sky-high expectations.
Yeah, and those higher yields may very well be the reason why it is small caps that are under pressure this morning that are underperforming. Bonds have a lot going against it, be it some of the concerns out in Japan of fiscal issues, of more spending, something we know is happening throughout the world, and threats coming from Chair Powell.
And I want to clarify, sky-high valuations, but very, very low expectations.
Correct.
So interesting for this setup into earnings season. We have the big banks tomorrow, but to your point here also, the bond market digesting that Powell news will be pretty interesting because higher yields floating into the market. We've seen this story earlier in the year.
It feels like, though everyone believes for equities, it is just a melt-up into the summer. We'll see if any of that changes. We'll continue the conversation with Stuart Kaiser ahead.
debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt to GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP. And that's got to be a major focus.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
And we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Sonali Basak. You are looking at futures lower on the morning as we head into the open. And of course, we are looking them reverse some of those losses. So we can actually open higher potentially. Really interesting morning here. Markets digesting, of course, the tariff strategy on the EU and Mexico, EU's potential retaliation. And we are also watching how markets are going to be digesting pressure on the Fed. There you go, opening bells. You have ADMA Biologics at the NASDAQ, biotechnology being a very hot sector this year. A lot of M&A in that world as well as listings. So keeping an eye on what's going on, a lot of excitement. And over here, over at the New York Stock Exchange, HNR Block. And as we open as well, let's take a look at some of the stocks we are keeping an eye on, Danny, this morning.
Also, does H&R Block have a mascot of like a tax accountant? They could think of something more creative, maybe like an Excel spreadsheet as a mascot or
Could
something.
belong in Disneyland. That exciting. I don't know.
H&R Block, Disneyland. What's the difference? All right, as you mentioned, Sonali, some really interesting movers. You've been talking about some of the changes happening at consumer companies. Kenvue, it has made board director Kirk Perry its interim CEO that is effective immediately. Shares are up 4.3%. The company has been announcing a strategic review. Again, a lot to watch, a lot of very interesting company news. We've been talking about the first half of the year, companies sitting on their hands. Some big changes happening, though, or potentially with what you're looking at, a lack of change and a decision to go against what they originally thought.
Activism, spin-offs, and deals not happening. We're watching Autodesk rise almost 6% at the market open. It is no longer pursuing an acquisition of PTC. People familiar with the matter have said it would have ranked as one of the year's largest deals. PTC down almost 4.5% as well. We are back now with Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser, on how to think about this earnings season, but also how to think about positioning heading into it. Really interesting. Liz Ann Saunders of Schwab this morning sharing the CFTC positioning data. I'm wondering what your own positioning data is saying about how funds are positioned. She says she's seeing mostly net short, actually closer to max net short positioning seen in 2022, the bear market. So pretty tough in some places. How are you feeling?
Yeah, I don't know. I mean, I think like CTAs and those types that tend to trade futures, those are all max long in most of our models. So we think there's some length there. The way we measure futures flows, at least for the last month or so, you had about 10 consecutive days of pretty solid inflows. Last week was a little wobbly. I don't know. We would put positioning as kind of a modest positive for markets at this point. I think, retail is largely re-risked. I think institutions have largely re-risked. That said, some of the more macro discretionary tactical investors we talk to, when the market's up 50 basis points, they're calling and saying, why is the market up so much? And that suggests that potentially they don't have as much kind of that upside on as they would potentially like to have. So I would never, the pain trade is always lower, don't get me wrong, but it does feel like even a modest move lower will put some pressure on people to get some more risk put in.
I'm sure people are freaking out when the S&P or markets are up 0.5%.
Yeah.
That feels like nothing, Stuart. I mean, what does that say about the event risk that we might have and potentially people unprepared for big moves? We've been talking about earnings, bank earnings starting. You have CPI tomorrow too. You also have increased continued trade talks. Is there really big event risk for this week? What are you watching out for?
I mean, there's a lot of stuff on the calendar. Whether that stuff is risk, I think, is open to debate. CPI tomorrow, we actually think will ultimately be probably a positive catalyst for markets. Our economists are about 30 basis points. I think consensus is just below that. If you get core CPI around 30 basis points, we do think markets will move higher on that. That'll probably really firm up a rate cut in September. The markets will like that. We actually like small cap stocks going into that. If that's the case, then the FOMC meeting is largely going to be about them messaging the fact that they're going to cut. So that will be sort of a neutral to slightly positive event. And then you get into payrolls and earnings. Earnings, as Shana mentioned, I think will be a little bit more of a single stock idiosyncratic event. That payrolls report's going to be, very, very important. We're coming off a better than expected payrolls print. If you get another one of those, if you have the unemployment rate at 4.1% and you're cutting rates, I mean, this is a market where equities are going higher, and that's why people feel the pressure to the upside, I think.
So I want to pull up WIRP on the Bloomberg terminal because that's where you have the interest rate probability pricing, and that September rate cut currently has only a roughly 65% chance right now. So for the bold bettors out there, keeping an eye on that CPI to get to that 1% chance of that, or 100% chance of that September rate cut. What does this all mean in context of the pressure that the administration is putting on Fed Chair Powell? How does the market read through that type of uncertainty?
Well, first off, that pressure is not going away. I mean, even if they cut rates, I'm sure the White House is going to pressure them to cut rates further. I was a little surprised by the reaction to the headlines last week. I mean, Chair Powell's been very, very clear that he's not resigning and is not leaving early. I think, the White House putting pressure on him to cut rates is, I mean, we could go back to 2018 and they probably would have had the same conversation. So I don't think there's a ton of new news